What they're actually responding to there. The Anglo-American piece is interesting, though. Do you start to see a more violent reaction in the copper market off of that kind of capacity constraint? Is that a big hit, or is that a boost to the stock in terms of simply lower supply?
We'll see how SAP opens as well. A number of stocks then, we've been through a few of them. SAP, Novartis, we get numbers out from all of these businesses. SAP dropped in the US session and then recovered. So we'll see where that one takes us. Opening calls had suggested we might be a little bit higher on SAP this morning. So markets are open across Europe. We're up by around 0.1% on the FTSE 100, the up at new records, FTSE 100 as it was from yesterday. John Author's writing about that overnight, actually talking about the counterpoint between the real nervousness around geopolitics and the way that the FTSE comes through with a new record in Monday's session. Is that how do we assess the juxtaposition of those two things? Broadly, then, the story for Europe is a little bit stronger, up by 0.3% on the stock 600. The CAC is up by that amount, so on par with that gain, and the DAX up by 0.2%. So modest gains across these European markets.
Go ahead.
Yeah, I think it's interesting that I think you need to currency adjust all of this as well, which I think is something that we need to pay attention to. The FTSE 100, everybody's got very excited about the fact that it has rallied in the way that it has.
Yeah.
Back out the currency, maybe that story doesn't look quite so advantageous.
It depends.
Depends where you're investing.
Yeah,
if you're a UK investor, then you don't really mind too much because you're basically swapping one for the other. But if you're an international investor, are you really picking up that much here?
Yeah. 123 on cable as we speak. I want to point out on the FTSE, though, you are seeing the underperformer this morning being a lot of the commodity sectors, Rio Tinto, Glencore, and, of course, Anglo-American. So not a positive then from those numbers coming out on the copper space as well. But your healthcare, your commodity story as well is leading to the upside in terms of oil. Shell is one of your major index contributors to the upside. AstraZeneca, GSK as well. This feels like a Novartis read-through on the gainers.
This is a huge upgrade. They have really... There was an expectation. Are they not going to beat and raise?
Yeah.
Well, they've beaten and they've raised by an order of magnitude way beyond everybody's expectations. So yeah. I think the read across is that this is very good news for Novartis, but is there really a read across into the rest of the space?
It feels quite specific, doesn't it? I mean, Novartis shares, they're up pretty strong, up nearly 4% as they jump out of the gates this morning. But it does feel quite specific to this business. The conversation we were having with Sam Fazeli earlier on was that this is, it's great for Novartis if you can fend off that generic competition for a little bit longer, but that doesn't have much read across into other corporates, perhaps. Technology doing really well, though, this morning. So maybe the read across there from the US session of yesterday.
And I was going to say the SAP numbers as well, right? Like the fact that ASML and SAP tend to trade hand in hand. It's also that the banks are doing quite well as well. This actually feels like a fairly broad rally that you were seeing.
There's not many sectors in negative, only two.
Yeah.
So gilt yields are higher this morning, and the rest of the market, well, treasuries aren't, but gilt yields are higher. So this extra supply obviously is going to require extra payments, and as a result of which we see yields moving higher. That seems entirely logical.
What is the read-through then from that massive auction you're going to see in the States today? Is there one in about 24 hours' time into the gilt market?
Yeah, and how much are they trading in reflecting each other, as we were discussing at the top of the programme?
I think they're probably... I think the two stories are the same in some ways. Yeah. We are in need of... We're going to have to push some extra supply out into the market. These are huge auctions in the States. Absolutely huge. And supply has been an issue. There have been bottlenecks in terms of some of that supply story. So I'm intrigued to see how some of these auctions go in the States. Let's talk a little bit about where we are with these markets. We have seen this significant sell-off that has taken place over the last few days in US markets. That didn't happen yesterday. But that is raising questions about what you do in terms of getting out of some of the concentrated areas of the market, particularly in technology. Anna was just mentioning that, and maybe looking elsewhere. We spoke to Helen Jewell yesterday from BlackRock to get her take on if you are going to get out of some of those concentrated areas, where do you go and where should you be looking?
The European names, this really could be an interesting time for these names. The broadening of the market, much more relevant in Europe. The valuation gap, which is now at 40% versus a more traditional 20-25, could be interesting. And if the ECB does cut before the Fed, which is now basically what's being built into consensus, could also give us a bit of a pivot for the small caps.
BlackRock CIO for Fundamental Equities in EMEA, Helen Jewell, speaking to us this time yesterday. Joining us now, George Maris, CIO and Global Head of Equities at Principal Asset Management. Nice to see you.
Great to be here. Thank you.
If you are going to diversify, do you think you should? And if you are, where should you be looking?
I do think you should diversify. I think there's going to be a broadening of market returns, especially within equities. The narrow concentration we've had has been partly a function of great fundamentals, but partly because we've had opaque economic environment, right? 2023 was a challenging year. You had bank troubles everywhere, whether it was Credit Suisse, Silicon Valley, et cetera. So there was a hurting behind anything with good fundamentals. We didn't see that narrow out. We've seen a broadening out of economic fortunes. I think we're going to see a broadening out of economic returns as a consequence. And so it does mean you want to start hunting at places that haven't done particularly as well as others.
If we do see drops, though, like the 10% drop we've seen in NVIDIA, isn't there less reason to diversify? Isn't there a reason maybe to actually think of that as an opportunity?
I think you could say that. I would push back and say, if you look at where momentum has been in the first quarter of the year, we've had, the second highest momentum number we've had in 100 years, right? So we've had an extraordinary hurting with respect to momentum as a factor in markets. Strong markets, I think there has been a winner-take-all mentality. I don't think that's been right. So a retrenchment from some of these companies like NVIDIA, et cetera, which have skyrocketed to super highs. A lot of this based on very short-term trading activity does present opportunity to redeploy capital elsewhere.
What is the bear case for European equities right now? It feels like the consensus, at least from the folks that we've been talking to on the show, has been you've got a rate cut in the works, you've got currency depreciation, and you've got a broader makeup of the indexes. So therefore, Europe as kind of the American catch-up trade is a no-brainer. What's the bear case?
Well, I don't. First of all, I am sympathetic to that, but I don't think it's a no-brainer.
Okay.
Right? I think you continue to lack relative to the U.S. the most dynamic elements of innovation, right? So artificial intelligence still seems spurred in a particularly American phenomenon. If you even think about cloud-based development, it's a particularly American-based phenomenon. If you think about the advantages in biotechnology and therapeutics, even though a lot is happening in Europe, we're playing it that way, there's still the eminence of that is in the United States. So you're seeing the cutting edge happen in the U.S. I think the argument here is, have valuations gone way too high? And I think this week will be a very interesting week with 6 of the Mag 7 reporting. I think earnings will likely be very strong. I think it'll be interesting to see is what reactions are. And I think it's that part that's going to be really that part of the behavioral element is going to be what's at play.
Are valuations way too high?
I think for the concentrated few, they certainly seem stretched. I think for the aggregated market, less so. And in fact, even during some of the sell-offs, we saw a healthy breadth.
Is that for tech in the States, or are you referring to Europe?
I'm arguing for tech in the States,
okay.
But I would also argue that for the select few of, let's say, bulletproof companies, there's been a hurting that has maybe been less valuation sensitive than it may otherwise should.
George, good morning. So interested to hear about your view on China, because you mentioned this in your notes. You say that this is a highly intriguing market at this point. When you visit and talk to clients globally, what are they looking to China for? Because, thinking has moved on a lot since 10 years ago, where investors would maybe buy European names for the growth of the middle class consumer in China, and that's the way they'd do exposure, or they'd go in and buy Chinese property, both of those perhaps coming under a little pressure as investment themes right now. So what do you buy China for? How at this point?
I think what's intriguing here is how the narrative has shifted so dramatically. Everybody, everywhere is negative on China, whether it's on the Chinese economy, the geopolitical situation, the constituency of the economy. It's negative every which way you go, and yet the underlying, first of all, it's still the second largest economy in the world. It is still growing. There's tons of innovation happening. A lot of the geopolitics, which are creating onshoring and nearshoring around the world, are also creating onshoring and nearshoring in China. So there's a lot of development opportunities there. And from a valuation perspective, it's at least the cheapest, if not among the cheapest developed markets in the world, trading at a substantial fraction of what you see in the U.S., even at a discount to the continent. So again, I think the opportunities are intriguing.
But if you're worried about the geopolitics, maybe that just overwrites all of what you've said, all of those solid arguments you've made? Or is there a point where you say, yes, I accept the geopolitical risk and the other reasons are so compelling you buy anyway?
So I think the geopolitical risk has always been present with us. It's present everywhere you are in the world. And look, we have a hot war on the continent, right? And so geopolitical risk is everywhere. I think the geopolitical risk with respect to China feels overstated, substantially so. And with that, these are opportunities that are extraordinarily compelling.
When do I start positioning for the U.S. election?
That's a tough one because I don't know how that's going to play out. I think the U.S. election is, if you look at where markets are, the markets are indicating a toss-up. I think this is an election that will matter. It will matter for markets. And so I think you start thinking about buying companies that are, resilient, that are not terribly expensive, because it is going to be a volatile period of time.
Is that a question you're getting here in Europe? What's the number one question you're getting when you're talking to people here in Europe?
The question in Europe is, when will European equities rally? When will they catch up to the U.S.?
Is that where we started our conversation?
And it's been a question that's been foremost on people's minds for several years now. Is when are we going to close this gap? I do think the opportunity now is more intriguing than it's been in a while.
George, nice to see you. Thanks for stopping by. Next time you come to London, make sure you come and see us. George Maris, CIO and Global Head of Equities at Principal Asset Management. Thank you very much indeed. Novartis, the stock is up. The Swiss drug maker raising its full-year outlook. We are going to speak to its CEO, Faz Narasimhan, is going to be joining us next. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology. the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
This is Markets Today. We're about 14 minutes into the European trading day, seeing a fairly positive start, more momentum building in the FTSE 100, green on the screen across the board, and a fairly broad one at that. Your only sector in the red, at least on the FTSE 100, is going to be materials, perhaps a lot of that coming off the earnings story of Anglo American, what the read-through is for some of the other commodity names, but plenty of other earnings stories to keep an eye on. SAP higher, for example, even Renault moving as well, and of course Novartis, Anna, coming in with a pretty hot share move this morning.
Yeah, absolutely. The Novartis share price up by 4.6% as the company upgrades guidance and in some style, upgrading the sales line and the core operating profit line. Let's talk about optimism for 2024 then with Vas Narasimhan, who's the Novartis CEO and joins us right now. Vas, very nice to have you on the program as always. So you've upgraded your guidance today, expressing some confidence, some clarity perhaps around the threat from generic competition. Does this push challenges into 2025? Is this what we're seeing here, or are you just broadly more positive about the outlook?
I think, Anna, we're broadly more positive about the momentum we're seeing in the business. One, we saw very good performance across our growth drivers, both established medicines like Entresto and Cosentyx, but very strong growth from our recent launches, Kesimpta, Kisqali, Pluvicto, Leqvio. So when you have that broad base of medicines all growing really well, that gives us confidence for this year, but also for the years to come. In addition, we saw our performance broad-based from a geographical perspective. Very strong performance, U.S., ex-U.S., Europe, China, Japan, also giving us a lot of confidence. So while there was a small contribution from generics getting pushed out, we're reiterating our confidence in our 5% plus sales growth guidance out to 2028 and our 40% plus margin guidance out to 2027, along with the various guidance raises you just mentioned.
Can I ask you about Pluvicto then, Vas? There's clearly one of the drugs, a cancer drug that you have high hopes for. It does seem as if sales came in perhaps just a little shy of expectations, but I wonder if this reflects a broader concern about convincing the market to pivot towards a new type of targeted radioactive therapy. Are you concerned about how long it's taking to convince the market that this is the way forward, or do you not have concerns there?
No concerns. We feel very confident about the Pluvicto outlook. We saw strong quarter-over-quarter growth, and it's important to know we're just now coming out of a supply disruption we had last year. Now in the first quarter, we had 99.5% on-time delivery of the medicine. We're seeing a broadened base of growth in the United States from treating centers that are getting comfortable with this new technology. It is a very novel approach, and so oncologists need to understand they can refer patients for this therapy, radioligand therapy, for prostate cancer patients. The other opportunity we have in the second half of this year is this medicine will go global. We'll have the opportunity to take Pluvicto outside of the U.S. at scale, and that will give us further growth. The most exciting part of the Pluvicto story and our radioligand therapy story in general is moving into new cancers and new cancer settings. So with Pluvicto, we confirmed earlier this year that we will file for the PSMA-4 setting for Pluvicto. That will allow us to broaden the indication base. And we've also done a number of deals and have in-house programs to bring more radioligand therapy forward, therapies forward. So we think this will be a significant market opportunity for the company.
Faz, good morning, it's Guy. So a big beat and a big raise, and the market likes it. What gets you the big beat and big raise in 2025? What are you most excited about? What's going to deliver the same performance that we're seeing now next year?
A couple of things, guys. So one, these growth drivers that we have that are really taking off with new indications. So you have Cosentyx that really outperformed, and a significant outperformance in quarter one. And that's driven off new indications for this medicine. And this is a medicine we expect to be $7 billion plus over time, by the end of the decade. Cosentyx will give us a lot of momentum. And then you have this group of recently launched medicines that are going to get new indications. So you have Kisqali, you have Pluvicto, you have Scemblix, you have Iptacopan. Each one of these medicines, we believe, have multi-billion-dollar potential. They have new indications coming over the course of this year or early next year. That gives us another wave of growth. And then also exciting is we have a full pipeline. We had 10 positive phase 3 readouts in 2023.
Yep.
And as those readouts now come into submissions, that will give us the third leg to grow through the end of this decade.
Can I ask you a slightly sort of left field question this morning? Is Novartis still a Swiss company? Yeah. Let's keep you on your toes. Is Novartis still a Swiss company? I know where you're based, but you've now got an American-Italian chair coming in. I'm wondering how that's going to change the culture. You reported dollars. You're domiciled in Switzerland, but increasingly you don't feel like a Swiss company. Certainly maybe compared with Roche. Your CFO is still Swiss. How is the culture of the company going to evolve going forward from here? Is that Swiss heritage still strong, or is it being diluted, do you think, at the moment?
You know, guys, it's interesting. We have deep Swiss roots. This is a 250-year-old company that's roots are in Switzerland and will remain in Switzerland. But we're also a global company. And the interesting thing is we've been a global company for over 100+ years. And so we want to maintain that global footprint, global talent, get the best people into the best roles, while still maintaining our Swiss roots. And I think we strike that balance well. We have a few members of our executive committee who are Swiss citizens. I've lived in Switzerland for a decade plus. And so I think we have those deep Swiss roots. But it's important to remember, we are a global company. We compete in global markets. For our shareholders, they want to see a world-class global leading pharmaceutical company. And that's the balance we'll keep working to strike. But I sit here in Basel today, and that's where we're going to stay.
Faz, it's Kriti. Talk to us a little bit about the cash on your balance sheet here. There's a lot of positivity coming from you this morning, from your share price as well, even from the analyst commentary off these results. Talk to us a little bit about where you stand on, 1, buybacks, and 2, restructuring. Does that continue?
Yeah, we have a really strong cash position, and we feel really good about our shareholder-friendly approach to capital allocation. We maintain an approach of bolt-ons, and we look at really sub-5 billion bolt-ons. But if you look at most of the deals we've done, they've been in the sub-$1 billion space, and that's where we want to stay. We have an ongoing $15 billion share buyback that we expect to complete over the course of next year. And we continue to see buybacks as a critical part of our capital allocation strategy. The strong and growing dividend in Swiss francs will continue, and we maintain our investments in the business. In terms of restructuring, now what you see in the company is just ongoing adjustments. We completed a major reorganization a few years ago, and that's bearing fruit. I mean, that's what you're seeing in the financial performance and overall operating performance of Novartis. But we also recently announced a few other adjustments in our R&D footprint, and that's, I think, normal course of business. We'll, of course, always make those adjustments. But we think we're set up in the right way now through the end of this decade to drive the growth that we've outlined.
Talk to us then about that bolt-on strategy as well. Morphosis getting a lot of attention, that acquisition. How confident are you that it's going to pass kind of the regulator's ire? And if it does, how many more deals are in the pipeline?
Yeah, we feel good about the bolt-on approach. I don't want to comment on any specific company, especially because we're, especially the Morphosis, we have the tender offer ongoing. But overall, we feel very good about this approach of bolting on. We've done over 15 deals in the recent quarters, mostly focused in our core therapeutic areas or our core technology areas. You saw many deals in radioligand therapy or RNA therapeutics. And so we think this is the right approach to take those bets earlier on in the development life cycle of a drug or in a company, and then bring them into Novartis, and then we do the later stage development. We find it harder and harder to create value for larger acquisitions where, and I think that the drugs are already on the market or they're very well modeled by the street. So that's the approach we're going to continue to take, I think, for the coming years.
What would change that? Would a large deal in the space change that, proving it can be done? What is? I hear what you're saying in terms of the understanding of the science and you being able to model the kind of outcomes that you're looking at. But do you feel that the industry is being held back because of regulators or science right now in terms of its approach to M&A?
I think first on the first part of that question, there's always this question of does the industry need further consolidation? And I think the biggest topic with respect to that is where do you really get better R&D performance? And it's not been historically shown that when you bring large companies together, large portfolios together, you get better replacement power and innovation performance. Often you have two disrupted R&D organizations and two disrupted pipelines. So that's been, I think, the difficult thing to solve in our sector when we think about very large M&A. Now, when we think about more bolt-on M&A, this is primarily a science topic in my mind. While we know the XBI continues to hover around relative lows from where it's been in the last decade, we still are primarily driven not by valuation, but by the quality of the science. And I think what we're seeing now is as capital has flowed out of the biotech system, we see a lot more scrutiny and a lot more pressure on biotechs to actually have to show, do they actually have strong data? And when we look at that data, that's really what's driving our M&A and BD&L approach. So that's why we think the biggest opportunities are earlier stage. These companies that are early need some support from a large company like us that hopefully can bring these innovations forward.
All right, Vas Narasimhan, Novartis' CEO, we thank you so much for joining the program this morning. We go from the micro to the macro. We are getting some headlines coming out of France here. The PMI is crossing the Bloomberg terminal. April manufacturing PMI at about 44.9. The forecast there was 46.8, so you are seeing some weakness there. But the services PMI coming in hot, rising to about 50.5 of a rating. The forecast there was 48.9, seeing a bump in the euro off the back of that. We are now at 106.60, Guy.
Really interesting that we see this outperformance on the services side. I mean, manufacturing still in the doldrums, it seems, but outperformance on the services side. Yep. The German PMI, which we're going to get in a few minutes' time, that's already back over 50 on services. And I think it was Gwen Doss you were pointing us towards at the top of the top of the hour, doing interviews with the French media. He's talking about the services sector and that, the largest remaining threat stems from services inflation.
That's where the stickiness is. That's where the problem is, and that's why they cannot be sure at this point in time that they can progress much further than June. June looks like it's nailed down, and De Guindos is talking about that this morning. But where do you go from there? Particularly with the Fed potentially on hold, some sticky services inflation. That's where life gets a little bit tricky, and it's interesting to see the reaction we are getting, quite a strong reaction we are getting in euro dollar this morning to all of this coming together. Let's take a quick look at some of the stocks that we're watching here, the core six that we watch around Europe. Remember that LVMH has gone ex-dividend today, so just be aware of that. That's why you're seeing the weakness. But elsewhere, some broad strength coming through for European equities.
Okay, let's have a quick look at what is on the move then this morning. I mean, broadly, we're moving higher across European stocks, up by 0.6% on the Stoxx 600. The FTSE 100 echoes that a day after we saw a record on the FTSE 100 in terms of its performance. We are once again talking about strength across European stocks. The futures picture then for Criti for the US looks flat to positive. We're waiting for the next leg perhaps of the earnings story. We're in that here in Europe. We're in it in the United States. We move more and more towards the tech theme over in the US. And that's going to be really informative.
Yeah, Tesla reporting tonight, but I would also bring your attention to the bond market here as well. 461 on that 10-year yield. A lot of questions even just this morning about what that $69 billion auction in the States means and the ripple effects that you see not only in the yield picture, but also in the stock picture as well. Coming up on the program, you do not want to miss our interview. Christoph Schweizer joins us, the CEO of Boston Consulting Group. We're going to talk about, well, a little bit of everything, frankly. You don't want to miss it. Stick with us. This is Bloomberg.
Season 2 of The Circuit. We're walking with the titans of banking.
Hello! You guys love these meetings.
Yes, we do! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging on for dear life.
driving a Hummer is pretty badass.
That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
General advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Surely starting to see some of the metrics pick up. You mentioned the PMI. That's good to hear. Yeah, I'm glad to hear that news. In fact, I do believe that there might be some more positive news coming about Europe over the coming months and quarters.
Okay, so you have a slightly more positive outlook, things improving around the European growth story. Let's go from that to the sort of real big picture thinking that no doubt C-suite execs are doing right now around AI. And I know that this is just something that you're working on a lot. You're pivoting increasingly your workforce. You're hiring towards that. How big is the AI business going to be for you? Take us forward, Christoph, a few years, 5 years, 10 years. How much of what you do is going to be centered around AI?
Well, what we observe is that it's a very interesting point in the kind of adoption curve of AI and generative AI in corporate settings. We are at this point that the kind of Gen AI experimentation of 2023 is now turning into a company-wide and function-wide transformation of what companies do and how they operate. And that's a very interesting moment in the history of that technology. And we anticipate that there will be some companies that are true winners who make this a very productive and high return on investment technology, and then others who are going to be laggards and who are left behind. As BCG, we do advise companies on their biggest and most complex challenges, and not surprisingly, technology, AI, and Gen AI is one of those items. It's very high on the agenda. We are approaching 20% of our revenue in 2024 coming from AI and Gen AI, which is one of the biggest growth vectors and frankly, one of the biggest growth stories we have ever seen in our business in 61 years.
I mean, that's very quick.
I mean, absolutely. Well, we've been investing in AI for about a decade. Yeah, it's not that predictive AI is totally new, but generative AI came in as an additional vector over the past 18 months. And so, look, we are getting close to 20%, and we anticipate that that'll double over the next few years. And so it's becoming a major part of our business.
When we talk about the regional breakdown, though, walk us through where that growth is coming from the consulting business in particular. It feels like the Middle East is the hot spot lately. What challenges do you find there?
Well, the Middle East is an incredibly important growth vector for so many industries. I mean, if I talk to CEOs of any multinational company right now, also of the leading banks and financial services players, I mean, the Middle East is very high on their growth agenda. That's true for professional services firms as well. It is a major growth vector, but I mean, it's still a relatively small part of the overall mix. What we are observing is that in our type of services are in demand, and actually in growing demand in every part of the world. It's not that there are a few countries that drive it and others that don't. We see, I mean, the whole question that we just spoke about, AI and generative AI and tech, that's the same question for companies in Japan and in the Middle East and in core Europe and in the US and in Brazil. So it doesn't really differentiate that much.
Talk to us about the labor picture then. BCG is growing, but perhaps not growing as fast as it did, say, a year ago. In 2023, I think the stat is something like 2,000 employees hired. It's 5 times fewer than the previous year. Why that slowdown?
Well, the 2,000 is just the net addition of capacity and growth of our team. We actually continue to hire very significantly, and we will do that, and we are doing that also in 2024. We are very proud of that. I do think it was an important year to show to our team that we believe in the growth and in the opportunity out there. That's why we expanded. That's why we keep expanding also in 2024. And look, ultimately, I mean, any talent business moves, I mean, relatively slowly. You hire people, you train people, you develop them from one role to another, and you do not change that in quarterly increments. And we are very committed to our long-term people agenda, and quite successfully so.
Morning. Do you think AI will need fewer people, though? Do you think you're going to need fewer people in the future? Is this going to be a productivity boom for you? And if so, to what extent will that impact headcount?
Well, I do not fall in the camp of the people who predict that millions and maybe hundreds of millions of jobs are going to be made obsolete. In fact, at the companies that we advise at the moment, they all aspire to productivity gains, there's no doubt. Part of that productivity gain, however, materializes in the form of higher top line and higher growth. And it's not that, I mean, you immediately lay off large numbers of people. Some of that is going to happen for sure, but then on the other hand, new jobs are emerging, right? I mean, you need people who can program and code the respective AI and generative AI tools. You need people who do all the upskilling. You need completely different types of talent in your workforce. So, I mean, you're going to see kind of shifts in what talent companies have and where they recruit and where they rather reduce.
So what does that mean inside a consulting company?
For a consulting firm?
Inside a consulting company, you're going to need to hire more AI people initially, but can you hire them enough? And hanging on to them is going to be difficult. Where are you going to see, where's the productivity coming from within your business that AI is going to have a material impact? Because you look at the hiring curves, they went up, they're coming back down again. Does that trend sort of generally continue within the industry? I'm not talking specifically about your company, as AI starts to have an impact. And how does it shift within the consulting world to reflect the AI reality, how you hire, where you hire, and the numbers you hire?
Well, for sure, any professional services firm is as exposed to the opportunity and also to the downsides of a big technological transformation. And for us, that means that we, already have been hiring over many years a lot more tech talent. We talk about data scientists, we talk about AI engineers, we talk about designers, etc. So the number of profiles in that space is constantly going up. We have our dedicated unit for that, BCGX, with more than 3,000 people. I guess some other job profiles going to be fewer in the mix going forward. Absolutely, yes. So we take our own medicine and we very boldly embrace new technologies. Actually, all 33,000 BCG staff have access to a suite of Gen AI tools, and I'm blown away by the adoption and the use, and it's quite remarkable.
Christoph, let me talk to you about, so this is one area clearly of huge growth, AI globally. We've talked a lot about that. In terms of geographies, we're seeing quite a lot of consultancies growing substantially in their Middle East businesses. I wonder how you're positioned in that particular area, whether you're growing there, and any particular cities in particular. What's the Middle East experience for your business at this point?
Well, we are growing in the Middle East. I do think many companies of all sorts are growing in the Middle East. It's become such an economic powerhouse in many industries, obviously in the energy industry, but now increasingly also in industrial goods, in financial services, in the broader investment industry, now also for services. So, it's been a good market environment. But, again, let's stay calibrated. It's still a relatively small part of the overall global consulting industry and the overall global professional services world.
Okay, we're going to wrap it up there. Christoph, nice to see you. Thanks for stopping by to see us. We look forward to seeing you again. Thank you very much indeed for stopping by to see us here at Bloomberg. Christoph Schweitzer, the CEO of the Boston Consulting Group. Okay, coming up, I want to get back to this Apple story. We'll do that in just a moment. Apple's iPhone sales in China suffering the gadget's worst performance since COVID. You'd normally expect iPhone sales to be doing well at this time of the year. This is a kind of seasonal boom for phone sales in China. Other brands look like maybe they're taking some of the bonus here. We'll talk about that next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation will work.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
The decision that has been taken by the U.S. to provide support for more than $60 billion is very valuable, and this joins also the previous decision of the European institutions to provide 50 billion euros in the Ukraine facility, which we will manage at the European Investment Bank, and I think it will provide much valuable support for the reconstruction as well as the military effort.
European Investment Bank President Nadia Calvino, they're speaking to the Bloomberg surveillance team in the States. She's very positive about the aid. It's in line with what you've seen from a lot of the European leaders as well. I'll point out, however, that when you talk to some of the Baltic kind of foreign ministers as well, and the foreign leaders there, they have a far more concerned rhetoric around it. They say, well, it's great that the aid's coming. We still have a battle along the way. At least those are the words of the Lithuanian foreign minister. And that caught my eye, that you are starting to see some real panic here. Is that, okay, we have the aid come through. When are we going to see it show up in kits, in troops, in defense spending, et cetera? What does that delay look like?
Yeah, Germany putting pressure on the US and others to increase supply of Patriot air defense systems, very specifically to Ukraine. And with that in mind, we know that the UK Prime Minister is in the region. He's in Poland, he's then in Germany. And he's talking about this, well, it's going to be, it adds up to the single biggest package to Ukraine from the UK, scaling up the domestic defence supply chain within the UK to try and deliver on that as well.
I think the key thing, and Critty put a finger on it here, is that there are gaps in the air defence system that Ukraine is currently operating, and there is an idea that maybe we need to pull in some of the more some more Patriot systems out of Europe. I think Greece is one of the countries, Spain is maybe one of the other countries. I can't remember exactly which countries to provide that kit, but speed is absolutely critical here. Now we've gone through that key vote, and it's a Senate vote today, isn't it?
Yeah.
It clears the Senate today. And then I think it's Biden's indicated that the speed at which this is going to be delivered will be pretty quick. Yeah. And I think it's going to be interesting to see just how big an impact it can have and how quickly it will have an impact on the battlefield.
It is, and there's a market read-through to this as well in that, and I think our producer Dan Curtis pointed this out to me yesterday, that some of the U.S. defense stocks have actually rallied to kind of record highs or 52-week highs on these headlines on this prospect for aid as well. So RTX, I'm trying to think, what is the actual name? I'm thinking tickers. Raytheon.
Used to be Raytheon.
I know. I'm thinking tickers. I'm sorry. Lockheed Martin was another one as well, rallying off of this. The delay is interesting. I still coming back to that capacity story. Where's the commodity input, the aluminum, the steel, the raw materials that you need for this kind of longer term bet?
And therefore, and so it is interesting that in the midst of that UK announcement about what they're delivering to Ukraine, they do talk about the ability to scale up the supply chain, to speed up the delivery of these things. So we'll continue to monitor that. Other things we're monitoring for you today, of course, back to the markets, a big US 2-year auction worth $69 billion US. How that goes down will be watched very closely. As we've mentioned, UK Prime Minister Rishi Sunak will be visiting Poland, and then he's on to Germany. We've got European earnings coming later on in the day, so don't be fooled by the end of trading. We will still have some earnings coming from the likes of Caring on the luxury space. Over to the US, Tesla, Visa, PepsiCo, Texas Instruments, a lot of different themes around the earnings story to focus in on. And then we'll have some ECB speakers, some BOE speakers as well, speaking later on today. Hugh Pill amongst them. We haven't heard all that much from him, the chief economist at the Bank of England, so that's going to be certainly something that we will watch. I suppose that could be interesting in itself, couldn't it? We've seen this increase in gilt issuance being announced this morning, and where gilt markets trade, obviously important for the Bank of England at this point, and the trajectory for UK rates, very important. And does it continue to tack a little to the US, or does it, fall back to where the European story is?
Just going back to the supply side. The DMO is going to be issuing more gilts at the same time as the Bank of England is continuing with its quantitative tightening program. So there is, if you think about what's happening in terms of just the mechanics of the market, there is an awful lot of supply coming back into the market at this point. Can the market absorb all of that? And how long is it going to take for the market to kind of work out what the new pricing regime looks like, given just how big a supply story it's going to be looking at here. And there's no guarantee. We don't know. We're about to have a general election in this country. We don't know that the Labour Party sounding like it does want to be fiscally conservative on the other side of that election. But how long does that ultimately last for remains an open question here and in the United States.
This insatiable demand for bonds that we were promised 6 months ago around the world has not manifested. And I'm curious, even as we talk about rate cuts in Europe in particular, where that bid even comes from and why that narrative has changed when we're actually talking about not only cuts here, but weakness in growth, when we're talking about even the U.S. Treasury market perhaps not being seeing the bid that it traditionally would get. Where is that insatiable demand? And we heard our guest earlier this morning talking about the fact that 5% yields are very plausible but not much higher than that, starting to be in kind of the traders' chats and the narratives as do you start to talk about even higher 5%.
Right, and I wonder how any kind of economic recovery in Europe fits into that narrative. What does that do to demand and the demand story around? Because we've got the euro really responding this morning to that better than expected services data.
And you put that with the Guindos comments. We're watching what's happening with the Fed. The market's now pricing in a non-negligible, I think it's around 20% chance of a hike being the next move from the Fed. The ECB cannot go too far if that pricing gains traction. And we get June. Then what?
Well,
what's the gap look like?
Yes, June is the expectation, but do we... So let's assume we get June. That is what the market is assuming.
80% is
price. But if you only do June, and then you stop, and then the future in the US path looks very, very different, you wonder what history, how history looks back on that one rate cut in June, if that's all you get.
But
and what effect will it have?
Yeah. But there is now precedent for... a kind of stop-and-go approach. You saw that in the hikes with the Federal Reserve, which at the time, I want to say about a year ago or so, the conversation was, if you hike once, you have to hike every meeting. You can't do the stop and start. And Goldman, I remember, was the contrarian at that point. And it feels like now there's a precedent to kind of do that.
There are some on the ECB Governing Council that are talking about 3-4 rate cuts this year.
Yeah.
As being a realistic objective. De Guindos feels like he's pouring an awful lot of cold water on that idea right now.
How does that all factor into the stock story as well? There's a bond story, there's a stock story, there's a global consumer story at its core, and of course, how does that hit the major tech stocks, which brings us nicely into one of the major ones we watch. Apple, of course, we're going to follow up on that story. The headlines crossing earlier in the hour. Their first quarter iPhone sales in China have suffered the gadget's worst performance since COVID, dropping 19%, according to Counterpoint. Let's bring in Edwin Chan, Bloomberg's managing editor for Asia Technology. Edwin, walk us through the decline here.
I think this is the first kind of real snapshot of what's happening in China that we're getting. What it is Apple's popularity has been steadily declining. I think around the time, but certainly not just after Huawei released its now infamous Mate 60 smartphone, the one with the advanced made in China chip. And I think what that was kind of a wake-up call to many consumers within the country that local brands can outperform. And I think since then we've seen a resurgence of demand for local brands like Oppo and Vivo and Honor and Huawei itself, of course, and that steadily eroded Apple's market share. At the same time, you see a lot of news reports, including our own, about how the government is actively encouraging or discouraging the use of iPhones within the workplace, particularly at more sensitive agencies and corporations. So it's kind of a perfect storm of negative factors that are kind of depressing Apple sales in China.
Is this a product story, i.e. the opposition is better at producing products that the Chinese consumer wants at the moment, or is it that politics? And what are they buying? What are the Chinese consumers buying if they're not buying Apple?
I think that's the thing, as I was alluding to, this has been a steady transition. There has been a process. I think over the past 2, 3, maybe 4 years, a lot of Chinese brands have begun to escape the perception that they are cheaper and lower quality, inferior alternatives to Apple and Samsung. Speaking of Samsung, they barely have any market share left, whereas Apple is starting to see a decline. And I think companies like Huawei have managed to get a lot better at not just catering to Chinese tastes, as you mentioned, but also coming up with genuinely high-quality products good cameras, for instance, longer lasting batteries, better memory, that sort of thing. And I think Chinese consumers are responding.
Okay, so China still remains one of the company's biggest markets, as you've spelled out. It's still important to Apple, but things are becoming more difficult, and geopolitics does play a role in some of that. So, is this the direction of travel for the foreseeable future, or does this change?
I think it depends on a number of factors. One is how hard Beijing, the Chinese government, pushes consumers away from Apple. But the second, perhaps more important factor is what Apple does in response. I think there is, right or wrong, a perception, at least within the Chinese market, that Apple is lagging in a few areas, not least in terms of integrating artificial intelligence into its gadgets. I think a lot of brands have gotten good publicity around what they like to call the AI phone. AI computing, edge computing, if you will, and Apple is perceived as a laggard in the generative AI race. So it depends what Apple does to overcome that perception, and not just in China, by the way, but globally as well. At the same time, the consumers do need to see an evolutionary upgrade in the next lineup of iPhones, whether you want to call it the iPhone 16 or whatever. There is a growing sense that there has to be a bigger leap forward to really get consumers excited again.
Edwin, thanks so much. Managing Editor for Asia Technology, Edwin Chan, joining us there with thoughts on Apple and a challenging market that still remains.
Mark Gurman had a really interesting piece over the last couple of days talking about the fact that Apple may need to change tactics here and may need to go for a more low-end, sort of price-sensitive phone, which it's never done before. Up until now, it's kind of chased margin. It may have to shift tactics here and start chasing the top line and the volume story. How does that kind of upset the longer-term story? How does that upset the services? I don't know, but I think it feels like people are talking about a pivot for Apple.
Feels like our expectations are always so high with regards to Apple. I mean, a business that's really reinvented our lives in so many ways. How do you live up to your own hype in that situation?
Yeah, it's
you innovate. You innovate. You have to keep innovating, and that's where the struggle is.
But I'm also wondering if they start to change and transform their business model a little bit, right? Because I think 30% of Apple revenue comes from services. It's like the Genius Bar as well. So it's kind of the Apple Cares, the screen fixing.
But that's what there's so much regulatory pressure in that space.
There is. But we keep talking about Apple as kind of this hardware company. Does it ultimately, in say 10 years' time, become a services company to offset this kind of weakness, this kind of exposure?
Increasingly so, perhaps. I mean, from one increasingly services company to a company that does do tech services, and that's SAP. It's the best performer on the Stocks 50, I think, today. It's certainly up by 4% this morning. So we've got some outperformers, and Novartis doing also pretty well as well. So we have spoken to the CEO of Novartis already this morning. He was talking pretty confidently about the outlook for that business as they really strongly upgrade their guidance, and we will be hearing from SAP shortly. 9:30 at UK time, we'll speak to Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle. You don't want to miss his thoughts, of course, on the commodities market. And later this morning, we'll be speaking to the CFO of SAP, Dominic Hassam, that on the back of these numbers that have sent this stock up quite strongly, up by just over 4% as the pivot towards the cloud continues. That is it from us. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
And market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. European earnings season gets underway. Swiss pharma giant Novartis raises its forecast as sales of its blockbuster drugs outperform. Renault of France also exceeds expectations. Well, Apple falls to number 3 in China's smartphone market after iPhone sales plummet 19%, and German private sector activity grows for the first time in 10 months, adding to signs that a recovery is slowly taking root in Europe's biggest economy. Well, April's Euro area PMI data is also out shortly. And then at 9:30, we'll have a special deep dive on commodities with Jeff Curry, the Chief Strategy Officer for Energy Pathways at the Carlyle Group. We'll look at the impact of geopolitical risks on oil and metals and what, of course, it all means for inflation. So don't miss our half-an-hour special. But first thing is first, let's take a look at the European markets map. Now, a lot of the indication, of course, comes from earnings. We've had a couple of sectors that have really beat expectations. So stocks on the back of that are actually gaining. If you look at U.S. futures, they're pretty much flat. Now, there is optimism that a lot of the big tech companies will deliver some pretty strong earnings this week. If you look at some of the other things we're watching out for, the focus on corporate earnings comes after a rout fueled by geopolitical fears, but also we have had a lot of signals from the Fed that it will be in no rush to lower rates. If you look at the U.S. 10-year yield, 4.6189, there are quite a lot of auctions as well for treasuries at euro dollar 106.75, and then gold holding at around 2,307. I also want to watch out. So gold actually extending some of the losses after this biggest daily decline in almost 2 years. That's, again, on the back of the Middle East. And the Fed will also talk about oil nudging higher. Traders, again, weighing some of the next steps between Israel and Iran. Now, we're also getting a little bit of data out of the Euro area April services PMI rising to 52.9. The forecast was a little touch below that at 51.8. Anything above 50 actually indicates expansion, and then that April manufacturing coming in at 45.6, a little touch below expectation. So it's interesting to see the two halves on whether you're in services or manufacturing. Now let's get more on these markets and the path ahead from JP Morgan multi-asset solutions strategist Tushka Maharaj. Tushka, as always, thank you so much for joining us. Now, I think you're staying quite constructive in these kind of markets. Are you worried that we're expecting too much from U.S. growth?
We are pretty optimistic and constructive, as you say, Francine, and yes, thank you for having me on. If we are correct, this week we're going to see the 7th consecutive quarter of above-trend growth in the U.S. So when we get that PCE data later this week. And I think two things we've realized about the U.S. economy in the last 12 months. One, population growth or immigration has surprised to the top side. We are now seeing immigrants entering the U.S. on the order of 300K per month, whereas the forecasts were less than half of that about 12 months ago. So that's been a positive boost to the labor market. And the second is the resilience of the consumer. I would even call it a robust consumer outlook. And so we've been positively surprised on the growth front. And for us, that's a very constructive environment for risk-taking. We have a preference for both U.S. equities as well as credit markets, given this view that recession risk is pretty low and actually moderating further, and growth is very robust.
So, Tushka, what does that mean on how you're constructive on portfolio? I know you're pretty overweight actually on credit. How long does that remain for?
Well, essentially we of the view that we're seeing an extension of the U.S. cycle. We prefer carry, as you mentioned, high-quality parts of high yield, the shorter end of the credit spectrum. What's been interesting in the last, let's say, 3 to 4 months is even though issuance has picked up in this space, we've seen very strong demand. And the second is even as default rates rose at the end of last year, spreads continued to tighten. And this is partly a structural point, but also we're seeing it play out cyclically, where the average credit quality, the median credit quality in high yield is now a much higher quality than it was previously. So it's on average double B instead of single B. And that's now helping that market stay resilient.
Tushka, I know there's been quite a lot of thoughts on repricing, given what we heard from the Fed. I've been spending quite a lot of time trying to find R+, and I know you've been spending quite a lot of time looking at the neutral rate. What does that suggest in terms of what the Fed does in 2024 this year and then beyond?
Yeah, Francine, that definitely is a question in motion at this point. We had previously expected the Fed to be delivering between 2 and 3 cuts this year, starting in the middle of the year. I'd say that's now moved to 1 to 2 cuts. And I think, as you say, the question is about the timing of when they start easing, but also where do they end up? And our view is that, yes, they could start cutting rates purely as inflation moderates further, but it's uncertain. And the terminal rate has shifted higher. Markets are now pricing the terminal rate 2 years forward around 4%. That was previously around 3.5%. So it has moved up in market terms. The Fed long-term dot at 2.5% still looks too low to us. But it is fair to say that the near-term R-star measure has moved higher. Very hard to put a number on it. But this is very positive for us, both in terms of growth, but also in terms of the equity market or risk market outlook.
And Tushka, it seems the ECB is really intent on actually cutting, most probably on June 6th. At least that's what the markets are pricing in. How do you play this divergence between the Fed, the ECB, frankly, the Fed and everyone else?
Yeah, good point, Francine. I mean, we've talked a lot about the U.S. here. It has been exceptional in that economy, and we are expecting more divergence between the U.S. and the rest of developed markets, whether that's the Bank of Canada, whether that's the ECB, and whether that's the Bank of England. And yes, we are expecting the ECB to diverge from the U.S. Fed. It has happened in the past. We've had the precedent in 2016, 2017, where they moved in actual opposite directions, right? So it's not unusual for this to happen. We do expect the ECB to be cutting on the order of 2 to 3 times this year. I think what the market is grappling with today is, yes, we have conviction they're going to start easing, but how quickly they ease, how fast, what's the pace of those cuts, and where's the terminal rate, I think is in flux. Today's PMIs gives you a sense that growth data is bottoming out, but it's still not consistent with at-trend growth. There's a difference between the soft data improving, but the hard data is still lagging. And so, yes, we have been playing that divergence theme more in the bond market, where we're preferring Italian bonds and German bonds over US Treasuries, rather than playing it through the currency.
I mean, Thirska, the number one, of course, geopolitical event, but frankly, political event is the U.S. election. I know it's difficult to read China, given the change in possible tariffs coming from the U.S. Where's China right now? Is it still deporting deflation, or could it actually be a source of comfort of central banks across the world, or are you seeing an uptake in growth that could only become sustained from now on?
Yeah, I think we have positive view on the U.S. economy. We're seeing a bottoming out in the euro area. But I would say in China, it's harder to get constructive at this point. So you will see this divergence in our views, where we have quite a spread out views across different regions. We're like Japan for many reasons, cyclical and structural factors, but we're struggling to find those catalysts for a strong, fundamental-driven rebound in the Chinese equity market. What's been notable is that while the economic data has been relatively stable, our view on the forward expectations for fiscal stimulus are moderating. And without consumer confidence returning, it's hard to turn more positive in that market. So yeah, you will see that difference in expressions of our views, where we prefer the US, the euro area, and Japan over parts of emerging markets.
Thirska, do you think earnings will actually drive markets in the next couple of weeks?
Yes, Francine, we've already seen that in the price action. We've had a big re-rating, so over 70% of the returns between October and, let's say, the end of March have come from multiple expansion. And our view is that even at these valuations, it's now time for earnings to take over that baton of driving returns. And earnings up to now have been constructive. They are realizing in positive terms. But it's those forward expectations, those 12-month forward expectations. Can they beat these already elevated market consensus views? And I'd say we have started to see some technical wobbles in equity markets. That to us was a healthy sign. It's not something that turns us necessarily negative on markets from here, but it's a well-made point that from here to expect valuations to drive this market, I think that's harder to see. It's going to have to come from earnings delivery and margin protection. Essentially, our view is that nominal growth will be robust, over 5 to 6% in the US, and that's going to drive that earnings growth.
Thirska, as always, thank you so much for joining us. That's Thirska Maharaj, a JP Morgan multi-asset solutions strategist. Now, earnings season, I was just discussing with Thirska, really, truly well underway. Let's bring you a roundup with Joe Easton from our equities team. So, Joe, good morning. What stood out for you?
Morning, Fran. So we're going to start with Renault because it's been a really volatile open to trading in Paris this morning. The headlines initially from their earnings look really positive. Revenue beating expectations at 11.7 billion euros above the analyst estimate, and electric vehicles still the star of the show. Around 48% of their sales now comes from EVs. But you remember they recently scrapped the IPO of their EV business, citing a slowdown in demand. And when you look deeper into the statement and in the analyst notes, there are still concerns around demand for EVs at the moment. So as such, that stock was declining over in Paris a few moments ago. It has had a good run into the earnings release as well, so potentially some analysts booking some profits on that, down around 1% at the moment. It did gain around 40% from the back end of last year. So as I say, booking some profits. Here's that rally on that screen there. Not a surprise maybe that it's coming down very slightly in terms of that one. Then we're going to go over to Germany. We've got SAP. Now this is all about cloud sales, cloud software, really strong for the company. Revenue in cloud up 25% in the latest quarter. And they say their order backlog is at a record high. So really positive on cloud. The only real negative is wage costs and other expenses coming up, and that is trimming some of their EBIT numbers, according to analysts over at Morgan Stanley. But nonetheless, we saw a decent gain out of that stock this morning. The cloud business is now their biggest part of their unit, according to the latest numbers. We brought up a pie chart here. We can see software and software licenses before were a bigger part of the business, but now it's all about cloud, and as such, we're driving a stock gain in that one today. I believe it was up around 4%. There it is, up 4%. The best performing stock on the DAX index this morning. Then we're going to go over to fast fashion, take a look at AB Foods. This is, of course, the owner of Primark, and look at that, a 9% jump for the company, seeing strength across the business. Every region in their market is actually reporting growth, and every unit in the company as well. AB Foods also has groceries. It owns Twinings Tea and some of the bread brands as well that you see in shops, and also, importantly, sugar. Now, they say that the agricultural trends in sugar have been better than this year, and that is boosting the sales there. But Primark will take the focus. Those sales continuing to drive high and drive the stock higher. That's the best stock we've got in London today, Fran. AB Foods is up 9% this morning.
Joe, thanks so much for the terrific roundup of some of the earnings that we had. Bloomberg's equities reporter, Joe Easton. Now, Apple iPhone sales in China also fell 19% during the March quarter. It's their first, or actually their worst decline since COVID struck around 2020, another sign of cooling demand for its flagship product. Now, according to the estimates from Counterpoint Research, Apple has now fallen to third place in China, roughly on par with Huawei. Coming up, we'll have more on Tesla's chaotic year next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Now, Novartis shares are up after the Swiss drug maker raised its forecast for the year as sales of its blockbuster medicines for heart disease and psoriasis outpaced expectations. Now, Novartis is pushing for growth after years of successive revamps as the chief executive cuts jobs and spins off units. Now, joining us now is Sam Fazeli, our senior pharmaceutical analyst from Bloomberg Intelligence. Sam, finally, thank you for joining us. Finally, it's working at Novartis.
Yeah, it looks like, the guidance, first they beat, but they did that last year too. Pretty much every quarter they beat and raised. And what we've also got is the significant upgrade to guidance for the full year, especially on the core operating margin, profit margin. And that, to us, looks like it's jumped 2 steps. Normally, companies go from high single digits to low double digits. These guys have gone high single digits to low double digits or mid-teens, which is significant.
But this is what, mainly on cost cutting. There's not a new drug discovery that's a game changer.
This isn't driven by any of the pipeline. I mean, the pipeline drugs and the drugs that are on the market are doing fine mostly. But this is, we think, the main difference here. What has changed is perhaps their confidence in how they'll protect these products, the two products that are going off patent. So that's Promacta, which is a cancer drug, and Entresto, which is a cardiovascular drug. And these two, each quarter that they can protect it or stop a generic coming in, obviously very high margin drugs, it really impacts the operating line.
So how's Novartis doing compared to some of their competitors?
Yeah, I mean, in terms of pipeline, they're doing a great job. They've been one of the more acquisitive companies, which all pharma have to be, because they can't just make these drugs all by themselves. And they have an interesting pipeline of drugs coming up that I think will be driving the growth. The question is, how will that fit with these two drugs specifically going off patent? How quick can you really fill the gap, or will it be a year or two of treading water before you see the upswing again?
Okay, Sam, thank you so much. Sam Fazeli, their senior pharmaceutical analyst for Bloomberg Intelligence. Now, engulfed in turmoil over the last week, Tesla is set to report first quarter results later today. With shares down some 43% year to date, Elon Musk is making a big bet on autonomous vehicles, with the robotaxi taking priority. Well, joining us now from Berlin is Bloomberg's Oliver Crook. Ollie, good morning. So there's so many threads to follow at Tesla. What are investors most focused on?
Yeah, so many threads, and even in the last week, the news flow has been absolutely terrific. I mean, listen, in terms of the numbers themselves and what we're expecting, we already got the first quarter sales. They were down for the first time in 4 years, so we know that that is not going to look great. We're expecting a revenue decline, which would be the first since, the pandemic. All of these are sort of first for Tesla, and significant operating profit could be down as much as 40%. And that's really the sort of numbers story there. But I think what's more important for investors and for many people is, what is this business going to be going forward? There was an answer to that at the beginning of this quarter, and that was a cheaper car. That answer seems to have changed over the last couple of weeks, with Elon Musk saying basically we are potentially shelving the cheaper car, and we're actually going to focus all of our energy into the robo-taxi, something that apparently there has been a lot of disagreement in terms of the strategy within Tesla. And we saw some senior executives leave. We obviously saw the job cuts. 10% of the entire workforce is going to be cut. We got that news out just the weekend before last. Apparently Elon Musk wanted to cut 20%. He had to cancel his trip to India. So you have all of this just absolute huge volume of flow. But what the investors want to know is, what is the focus going to be going forward, and what is going to drive the growth? Is it going to be autonomous driving, as Elon Musk promises, or does he really need to focus on that cheaper car to compete with these Chinese automakers and many of the other EV players that are coming to eat his lunch, basically?
Ollie, thank you so much. So all eyes, of course, on exactly, one of the big seven in Tesla. We'll be doing a little bit later. Oliver Crook. Coming up, after months of wrangling, Rishi Sunak's flagship Rwanda deportation bill is set to become law. So we take a look at what happens next. This is Bloomberg.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything. Bloomberg Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back, everyone. The UK Prime Minister Rishi Sunak's flagship law to deport asylum seekers to Rwanda has cleared its final hurdle in Parliament. The government says the first flights are planned by July. Well, I'm delighted now to be joined by Alva Ray with the very latest. Alva, I mean, to a lot of people, it's amazing how much political will actually the Prime Minister spent on this. Does the deal actually mean that deportations are now a done deal?
No. I mean, they are much more likely today than they were yesterday, now that this has passed Parliament. But there are still some logistical issues which the government are hoping that they can fix by the time this is due to happen in July. So just some things behind the scenes, getting airlines, getting the staff. And I think then they are expecting some legal challenges, but they're trying to bolster the legal teams to make sure that that doesn't affect it.
So why did the Prime Minister spend so much time on this?
Well, he's struggling in the polls, and we know that immigration is an issue that really matters to the voters that the Conservatives and Labour are fighting over the most. So it's not actually the top issue for the UK population in general. The economy and healthcare are sort of above that for the population in general. But in the key seats, the red wall, where Boris Johnson won in 2019, immigration and illegal immigration in particular is the burning issue, and with these crossings across the channel rising in recent years, the government has felt it has no choice but to crack down on this in a sort of big policy like this.
But Alva, so what's the calculation actually of the PM, that he's trying to, you know, basically shorten that gap with Labour, or are they actually thinking that they can win at the next election?
I think that's exactly right, the right question, because they're really just at this point, frankly, trying to stem the level of defeat that they suffer. They're 25 points behind in the polls. They're losing a lot of their base, or a lot of their core voters might just stay at home. They're losing a lot to Labour, but also to Reform, the Nigel Farage right-wing party. So they're just trying to build back a little bit of that, save some seats. But I don't think privately in the Conservative Party, they're not really expecting a win in the next general election at this stage.
So interesting. Alva, thank you so much. Alva Ray there with the very latest on the UK. Coming up, we discuss the oil and energy outlook with the top commodities analyst Jeff Curry, now at Carlyle. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
Your earnings season gets underway. Swiss pharma giant Novartis raises its forecast as sales of its blockbuster drugs outperform. Renault of France also exceeds expectations. Now, Apple falls to number 3 in China's smartphone market after iPhone sales plummet 19%, and Euro area private sector activity advances to the highest level in almost a year, driven by a buoyant services sector and Germany's return to growth. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, energy and commodity markets have been volatile over the past few years against the backdrop of higher for longer rates, the economic slowdown in China, and 2 wars on the global stage. Well, in just a moment, we'll be joined by commodities veteran Jeff Curry for a deep dive look at what's happening in the sector and what's coming next. And then a little bit later in the show, we'll also look at commodities and inflationary pressures. But let's begin with a focus on the oil markets. Now, prices have rallied since late last year on escalating tensions in the Middle East. Some analysts say that $100 a barrel is back on the cards. Well, joining us now, I'm delighted, is Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle, a former head of commodities research at Goldman Sachs. I mean, you understand. Welcome to the program.
Great.
Jeff, you understand these commodities really like no one else. I want to get your thoughts on oil off the highs. Does that reflect the fact that traders are less worried about the Middle East and escalating conflict, or is it supply and demand issues?
Well, obviously, if you look at the pullback recently, we're back to levels before the events of what happened between Iran and Israel a week and a half ago. But more importantly, everything's off. Commodities are going through a consolidation period. We were beginning to price in equities, everything, this idea of rates being higher for longer. But let me remind everybody, we're talking about rates being higher for longer because growth is so good. I mean, the things you just went over just now. Private sector activity in Europe, the highest level in a year. We're seeing a reacceleration of growth across the board. And so when I think about what's going on oil specifically in commodities, and I'll put Bitcoin in there and all the physical assets, is they're going through a consolidation period. These assets, these physical assets, are tied to underlying growth and inflationary pressures. In the bottom line, retail sales was smashing that we saw last week. You have unemployment still at very low levels. CPI surprise to the upside. Chinese manufacturing beginning to accelerate. Europe, Germany accelerating. The list goes on. This is classic late cycle expansion that you and I were talking about 3 months ago.
So what you're telling me is that there's a shift basically in the supply-demand equation. Is that right?
Well,
so where do we end up?
I wouldn't say it's so much a shift today as it was when we were talking 3 months ago. What we went through in 2022 and 2023 is your classic mid-cycle pause. Yeah. The economy adjusts to the higher rates,
and the higher energy and commodity prices. It went through that adjustment. Manufacturing slowed down. Now we're coming out of it. And is this thing any different than previous cycles? No.
But Jeff, if you look at the rates expectations for the Fed, right, higher for longer, and I know this is because growth is wrong, but does it have a harmful effect on commodities at all? Looking forward.
This is why why you want to own commodities in this environment, because if you don't have a situation in which you're raising rates because of strong underlying growth, means commodities are going higher, and that's what's going to force their hand to raise rates. And if they do cut rates, you're adding more liquidity into the system, which means higher commodities. So commodities are a win-win in this situation. That's why they nearly always outperform all other asset classes in this environment.
But I'm looking at the IEA. They're predicting further slowdown in oil demand growth next year to just 1.1 million barrels a day, right, as we get closer to peak demand. Do you agree with that assessment?
By the way, when we look at late cycle commodities, there's a really important point. It's not the growth that matters, it's the level that matters. And why do I say that? Is because as the level of commodity demand goes up, it stresses the underlying supply level. So yes, the growth rates are going to slow,
right?
And that's what you happen to late, but the level could continue to grow, stresses the system, puts upward pressures on prices. So that, and by the way, the equities, which are tied to growth rates, they begin to come down. So this is what I always argue over and over with commodities. They are tied to the level of activity, while financial markets are tied to the growth rates of activity, which is why you get the outperformance.
OPEC Plus has kept supply tight.
Yes.
Is this about to backfire?
No, when we look at where, well, first of all, everybody's talking about all the spare capacity in the system. It sits in Saudi Arabia and UAE. Right. That's it. And they have more market power today than they've ever had because of a lack of investment in many of the different non-OPEC countries. And yes, you're probably going to respond back that rapid growth in the U.S., but compared to what's going on more broadly, it's relatively small. Then I think the other issue that gives them market power is that you have inelastic demand, because we've taken out all the low-hanging fruit. So that group that sits on that spare capacity has more market power today than they've had since the existence of OPEC.
So does oil, is it $80 or $100 next?
We're far closer to 100. I'm not in the forecasting business anymore, but everybody goes, wow, we're going to hit 100. By the way, the one thing I learned in all my time of looking at these commodities, trade the wings. This thing's going to, when it goes, and when it drops, it drops. And you've been doing this as long as I have. So the odds of this thing going over 100 are extraordinarily high. The question is, how high can you get before you start to see OPEC begin to adjust the system? By the way, I want to say this, and this is just history in the 40 years of OPEC history and where we are in the cycle. Never has OPEC ever been able to bring on supply as we go into the final stretches of a economic expansion and tame the oil price. What happened? Let's go back. Were they able to do it in 2018? No. We got it up to $88 a barrel. And then we had the waivers on Iran. We could talk about that later. That's a very similar risk here, but I think it works to the upside this time around. 07, 08. And then you can go back to 01, 2000. I can keep going back all the way back to the existence. They never, because here's the point. If the rise in production misses by just 5 days, what are you going to do? You're going to get backwardation. You got to get that pinpoint, that accuracy, which is always. By the way, if there was a group in OPEC that could actually get this right this time around, I would say this leadership can get it right. But again, I'm going to say you missed by 5 days, because think about what happens. We know that tankers out there in the Gulf, wherever it is, it's coming into the refinery. I don't have crude today. I'm short by, let's say my inventories are 5 days. It's going to be 6 days late. I got a problem. I'm buying crude, and the backwardation goes up. Also on the backwardation, another point I want to emphasize. Everybody's talking about backwardation as an indication of a political risk, geopolitical risk premium. It can't be. I always say time spreads don't lie. They tell you this market is tight. And another point, the market went off the board in backwardation. That means there's no investors in it. It's all physical. You really have a tight market here.
But Jeff, tight market plus geopolitical risk. So let's talk about Iran. Mm-hmm. I mean, could this actually fly through the roof if something happens?
Oh, absolutely. Because the market's unprepared.
But why is it not priced in? The market is unprepared.
But we look at more broadly, I don't care if it's energy equities, energy commodities, or more like it, there's not a large investor participation. And also, money today chases trends. They don't make bets. They don't trade. And so there's no real trend here. By the way, when it started trading, look at copper. Copper overshot the fundamentals near term. They'll trade that trend. But when we look at more broadly, most of the discretionary money can't sit there and hold a position of geopolitical risk premium betting for this thing. That said, there is activity in out-of-the-money options. You know, you go up to that $150, $200 range. People are buying it because they're hedging geopolitical risk, inflation risk, and, you know, equity risk type premiums. So there is that activity, but it's relatively small, and it's located in the options markets.
Jeff, I think JP Morgan is saying that it's time for a reality check on the energy transition. It's slow, costly, and not rewarding for investors. I mean, is that how we should see it?
Well, I think we're going through that reality check right now, and people are reassessing it. Yeah, but when we look at the returns in the green sector, there's two things that are driving it. One, there's a hangover from the big spike we had in 2022. Let's remember that when everything exploded in 2022, coal production, it went up the size of Saudi Arabia, by the way. That's how much coal we added in that environment. Gas prices went negative in Europe, and U.S. NYMEX natural gas and power prices reached an all-time low, 6 weeks ago? That's creating a headwind to the sector. And by the way, because we ramped up coal production. The second factor that's had a big impact on this is China. What is China doing about their property market problem? They're rotating growth into manufacturing of green CapEx goods, and they're pushing them onto the global market. And by the way, the returns aren't that great, which is the problem that the equity market has had in China. But I think the key message here is there's two drivers of that weakness. One, a hangover from that spike in 2022 in what China is currently doing. Both of these are temporary. Longer term, there is a story here. And
temporary a couple of years, or temporary 5-10 years?
By the way, it's been temporary for 2.5 years. If you look at the peak, in fact, by the way, that report Christian did, I thought was phenomenal. But he has a chart in there. Yeah. This has been going on for 2.5 years. It's not something that just cropped up in the last couple of days. So we're going through that rough patch. But I think the longer term outlook is still very positive for the sector.
Okay, we'll talk about that longer term outlook. Jeff, thank you so much. Jeff Curry from Carlyle stays with us for a look at some of the broader commodity themes and sectors, including also the rallying gold and metals. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
What happened was you were offered a money-losing women's basketball team And you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Welcome back to our deep dive on the energy and commodity sector. We've looked at oil. Let's now talk about the rallying gold and metals. Now, the index of all 6 base metals on the LME has gained more than 13% this month on a better global manufacturing outlook. Investors, though, remain cautious on future moves by the Fed. Meanwhile, gold extending losses after its biggest daily decline in almost 2 years following a stunning rally in the Haven asset. Now, let's bring back Jeff Curry from Carlyle. Jeff, I want to talk to you about copper. Gold. What is gold right now?
By the way, gold is a mystery. I'm not going to say I got to, and understand it, because if you look at the drivers, fundamentally, usually what drives higher gold are lower real rates or a weaker dollar. What are we actually seeing? We're seeing higher real rates and a stronger dollar, and typically gold goes down that. When we look at it, clearly there's a mysterious buyer out there. You can see it in the physical premia. It's most likely coming through Dubai. You see it in the OTC market. Historically, when we see that, and you get the data 3 or 4 months down the road, you find out it was an emerging market. Probably unlikely Russia, they just dig up their gold, put it into the central bank because they got so much underneath the ground. But is it China? Is it India or somebody like that? Who knows? We'll find out.
Is this a play against treasuries or trying not to buy treasury, or could it be completely separate?
I would argue it's probably an inflationary hedge. I want to emphasize gold traded like this in the 1970s. So what we're seeing here in this dynamic is not completely unfamiliar territory. You just got to go back 4 decades to see a period similar to this. So I would argue, and you look at Bitcoin too. Both of them are, the strongest performers out there. I argue they're pricing in inflation risk. No. But the other thing both are pricing in is liquidity problems, liquidity risk, particularly in the financial markets.
Yeah, which have come to fruition, or it's something that they're just hedging in case something's slowing down the road?
In fact,
we haven't really seen anything.
One thing I can say is Bitcoin's a measure of liquidity out there, and part of the reason the volatility you've seen across the space, not only in commodities but in financial markets, liquidity still remains low.
Jeff, talk to me about copper. So it's had quite a strong run. I think it's right on the cusp of $10,000 a ton. We talked about the energy transition. I mean, is this a signal that we could be there? I know you said, we've been waiting for 2 years and a half.
Yeah.
Like, how do you time it?
By the way, I want to point out, we got bullish on corn in 2006 off of the biofuel story. Corn didn't perform till 2012, but it went straight up. By the way, copper typically trades like a stair step, and we just went through one of the stair steps. So now the difference between copper and oil has backwardation. That's telling you it's fundamentally tight on the front end. And again, I'm going to emphasize, it went off the board in backwardation. There's no investors going off the board in backwardation. In copper, we're in a little bit of contango on the front end, which is telling you it's pricing medium to longer term stories. So yes, you've had the upward draft of everything under this higher for longer, growth surprise that we're dealing with. I'm not going to call it a surprise. It's your typical late cycle.
Well, you called it.
Yeah.
not others.
But in terms of thinking about what copper and the metals are pricing, it's pricing a more medium, longer term story, which brings us back to the whole question around energy transition, because we've always been making the argument, going back, copper is the new oil. I stand by that view, because we're going to electrify everything. You're going to need the copper to do it, and so most likely it's pricing that in. But even there, like oil, that's going through a consolidation period because the price got ahead of the fundamentals. But longer term, absolutely believer in that. And by the way, underlying demand for copper, despite the weakness in the property market in China, is still healthy. Because think about what we were just talking about. All of those green CapEx goods in China that are being subsidized. And then you have all the investment that's occurring in the West. And it really starts to accelerate in 26 and 27.
If you have the energy transition and you have AI, so as we use AI, our mobile phones get more complicated. We're also going to be, using some of the rare earths, or even some of the things that you follow very close, some of these metals. Like, how do you see that complex changing?
AI is chips and copper. And what are the chips? Gallium and germanium. So it is basically critical metals and copper. So that is the bottleneck to really be able to make the investment in AI. In fact, everybody goes, well, AI and energy are the two most investable themes. Well, energy is more investable than AI because you need the energy to get to the AI. And here's a stat for you. One GPU, one of the NVIDIA GPUs, consumes as much electricity as the average American household. Now let's go start building enormous data centers. You could be up to 100 megawatts of the demand out there. So this is significant, and I really believe when we think about the forward demand or the structural story, it's more bullish today post this AI boom that we've seen over the last 12 months than it was 18 months ago.
But after decades of underinvestment, is there now danger that they're overinvesting and actually we'll have too much of it?
Absolutely not. And by the way, here's a point is, people say to me, oh, look at all the investment in green energy. And I'm going to cite a number, I think it was 2.3 trillion in the numbers that Christian, in that report he did. When you look at the need, like I know Goldman put out a number somewhere around between 15 and 20 trillion dollars this decade alone. You're not even scratching the surface of how much investment we actually need to be able to achieve this. So I stand by the underinvestment thesis. And also remember, green represents somewhere around 18% of the overall energy. Brown represents 82%, and we have not been investing in that. We're underinvested, and that's really the core of the super cycle story, or the revenge of the old economy, is that lack of investment.
Finally, I could speak to you for another 3 hours, but I know you do have business to do. Gasoline prices in the U.S., are they critical in the U.S. election year?
Absolutely, yes. And when you look at what are the most important issues facing voters, particularly in the U.S., the dominant one is the economy and inflation. And by the way, the one thing nobody's been talking about that is in that aid bill, that $95 billion aid bill, more sanctions on Iran, around vessels, refining, and how they handle the Iranian crude. I would say the one way out, waivers. And remember we started this, 2018, what did Trump do? Waivers will be able to manage it as you go into that election.
So interesting. Jeff, thank you so much, as always, for giving us a little bit of your time. Jeff Curry, there's Chief Strategy Officer of Energy Pathways at Carlyle. Coming up, that recent commodities boom is feeding into inflation, threatening to keep it higher for longer. So we'll have plenty more on what that means for inflation and central bank monetary policy next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and
boom in commodities is complicating anti-inflation efforts by central banks. Now, uncertainty around oil and rising commodity prices may derail prospects for significant rate cuts anytime soon. Well, we're now joined by Noor Al-Ali from Bloomberg's MLive team. Noor, if you're a central banker right now and you look at inflation, you're looking actually at the price of oil and geopolitical tension. So how does it feed through their thinking?
Yeah, absolutely. And you've seen in the past few sessions how a lot of these prices have actually come down. So we're looking at oil, we're looking at gold. So some relief here, but there's a little bit of debate whether that rally has actually run out of steam or there is more to it. It looks like there is more to it. Now, ECB's Valerie did come out yesterday and say, look, it's not really going to deter our path. June is there. We're definitely going to cut, or, that cut is a lot more into consideration. PMIs today that came out of the euro area did point to wages pressures, right? Mm-hmm. So that's something that's in the concern for the ECB. We'll get, first quarter data later into June, and that's hopefully going to feed the picture. But what comes after is definitely something that we have to pay closer attention to. We're seeing it in the U.S., obviously completely different dynamic, as Bailey did say. Inflation dynamics are very different, but that resurgence of inflation is concerning. And it'll perhaps not point to the, central banks won't suddenly start hiking. Maybe there's that question for the Fed, but for the ECB and the BOE, the question is now more tied to what the pace of that easing is going to look like.
But Nora, when you look at, so how does actually inflationary pressure from energy feed through, for example, in the UK? So we had that number that kind of freaked out markets and traders. But then Andrew Bailey tried to reassure everyone that actually the inflation number will probably come down in the next month.
Yeah, absolutely. So the UK is a very different kind of economy than it is, for instance, in Germany, than in France. Germany relies a lot more on manufacturing. The UK doesn't have that kind of storage of natural gas, that Germany or the euro area has done quite successfully so since Russia invaded Ukraine. And so in the UK, that feed-through might be a lot more, that lag might be a lot quicker. Mm-hmm. But there's also the monetary policy transmission lag as well. So they've tightened quite aggressively. So hopefully in a scenario where policymakers would say, sure, we'll start easing, but the impact of the tightening is not fully felt through. So hopefully that will offset that feed through from prices should they continue persistently and rise in a pace that will start impacting prices.
Nora, thank you so much. Nora Al-Ali there with the very latest, of course, on some of the nuances when it comes to central banks and, of course, the price of oil. Now, we had a great conversation with Jeff Curry looking at the undersupply in the markets and, of course, some of the dynamics that we've seen also with regards to oil and the price of copper. Now, Germany seems to rebound some of the Eurozone activity. This is actually at the highest, this activity from Germany in the last 11 months. I think Euro area private sector activity advanced to the highest level in almost a year, and that's again thanks to the services sector and Germany's return to growth. So that's it for our energy special. Bloomberg Brief is up next, and this is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning from our global headquarters in New York. I'm Manus Cranny with Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
It's Musk's moment of truth. Tesla kicked earnings season into high gear after the market close. More bad news for Apple. iPhone sales in China fell 19% during the March quarter, the worst performance since 2020. And the FTC sues to stop Tapestry's $8.5 billion takeover of Capri, alleging the deal will harm the luxury goods market.
Are you ready for the busiest day of this week? Nearly $17 trillion worth of equity will report. The stock market just clinging by its fingernails. We've done the Bloomberg poll on MLive. 2/3 of the respondents, of over 400 respondents, say the earnings will give us a nice kicker. Goldman Sachs, they've been doing the hedge fund analysis. The hedge funds have been the biggest notional buyer of equities in more than a year. As the rest of you were selling, the hedge funds were getting in there and bidding up. Are you ready for your two-year auction today? $69 billion worth of twos will come to the street today. It's not expected to see any indigestion. I love what Bob Michael had to say yesterday, which was he's hanging on with his fingers and his toes in terms of his long bond positions, but he wants to see a little bit more inflation print before you add duration. Euro is bid this morning up an eighth of 1%. The French PMIs show a little bit of price pressure, and German manufacturing back in the expansion territory. Keep an eye on Apple. Danny, we've just had a little bit more data in terms of the shipments in China. They are down, or the sales in China down 19%. The stock is down 0.5%. Good morning, earnings.
This is one of those things that if you told me the news before, I would have assumed Apple would have been down a lot more. But Manus, perhaps it's because this is nothing new. We learned from IDC not that long ago that their overall shipments had fallen by 10% in the first quarter. But this is the bad news. So many people had pinned this earnings season on the growth and the revival of tech. That'd be the thing that would save this equity market. Already we have a blow to Apple.
If you strip out NVIDIA, you're left with a very different complexion in terms of the technology earnings. It is NVIDIA that will skew the earnings. By the way, on Apple, what poor timing for Bank of America. What tragic timing for Bank of America. But they're there, which is it's still their top pick. They talk about the cash flow. And don't forget, this is a stock that does dividend and buybacks, and it's got a gusher of money on its balance sheet.
They're among those that stand alone on the sell side. Both Morgan Stanley and our Bloomberg intelligence analysts say China is the reason that Apple cannot be as strong as it once was. But man, as I said, it's a big week for earnings, a big week for tech earnings. More than 40% of the S&P's market cap is going to be reporting. We're going to have a spotlight on the Magnificent Seven. Joining us now is Kevin Munn, President and CEO of Hennion & Walsh Asset Management. Kevin, I loved during the break when we were talking about Apple, you're like, maybe we're down to Mag 5 now.
Yeah.
I mean, how much shine is being taken out of these stocks like Apple, Tesla, especially as we're about to hear their numbers?
The Mag 7 is very important to the psyche of the investor because most individual investors hold one of those 7 positions, as do fund companies. And I think to this earnings season, how important it really is. According to FactSet, the information technology sector is expected to grow their earnings by 20% year over year, communication services by 20% year over year, but the rest of the S&P 500 by just 0.5%. Tech earnings are incredibly important to the psyche of the market and where we go from here. Of course, we have to talk about the Fed too, because they're pretty important.
Yeah, I mean, there's the macro, but since we started on AI, you're both gonna have to help me now with the sport analogies.
Yes.
I don't know whether you're on cricket or baseball.
Baseball.
She can
he's a
interpret.
cricket guy.
I'm not a cricket guy.
So as far as AI is concerned, we are in the artificial. So what inning are we in within the artificial intelligence AI game? This is what you had to say. I would suggest that we are just in the batting practice and that AI, before the AI double header. So what exactly is, if we're in batting practice, what is the double header?
Yeah, there's so much more runway ahead for what artificial intelligence can actually accomplish in our society. Yeah. Last quarter, we learned that 36% of all S&P 500 companies actually use the terminology artificial intelligence or AI in their quarterly earnings reports, the most on record. We've learned that Blackstone and Digital Realty have announced a $7 billion joint venture to build data centers all across the world in cities such as Paris, Frankfurt, and even the northern parts of Virginia. We heard Microsoft announce that they're building over $2 billion worth of data centers in Japan by the end of 2025. Artificial intelligence isn't just some hot new fad. It truly is transformative, and there's going to be more and more investment dollars chasing that elusive technology.
But maybe Tesla is a lesson not necessarily in AI, but you can promise all the growth you want, all the spending you want, and if you don't come through with profits, it's not going to benefit you. So in this earnings season, if we are just at batting practice, how much can you really trade on it? Do you need to see the actual fruition of some of these AI projects before you say those valuations are worth it?
You can't wait too long. NVIDIA is an excellent example of that. Unfortunately, NVIDIA doesn't report till May, but I do think that will be the tide that lifts all the other ships as well once we get to May. Tesla can't seem to get out of their own way, right? They've cut jobs, they've cut prices, they've abandoned the production of their lower cost vehicle. And now we've learned, at least last quarter, that global deliveries fell for the first time in 4 years. Their stock doesn't meet our selection criteria. Let's them take them out of the Mag 7 altogether. I still think Apple has a lot of promise going forward, but Microsoft, NVIDIA, those are some pretty strong names, and they're going to compete and probably be 2 of the winners in the overall AI race.
I like your punchy approach. Just get them out. Chuck them out of that Mag 7.
See you later.
You talk about your analogy. I was just listening to Jeff Kerry there just before we came to air, and he's talking about the commodity evolution co-joined with AI. But when you look at AI, you talk about the brain, the heart, the limbs, and the nervous system. Do you equally allocate across the functional body, or where do you skew? I mean, I hope you give a little bit more to the heart.
So to kind of expand upon that, the brain, that's the software, the algorithms, and the models that AI uses, right?
Yeah.
Then you have the chips and the semiconductor. Everyone talks about NVIDIA, but how about Taiwan Semiconductor? 60% of the global market share and the world's largest chip foundry, and they also just got a grant from the Chips and Science Act because of their Arizona subsidiary. Then you look at the hardware. Companies like Vertiv. Who's ever heard of Vertiv? They're industrial companies, but you know what they do? They provide the power, the infrastructure, and the cooling solutions to the all-important data centers. And the data centers are really the nervous system that make all of this work. Companies such as Equinox, Iron Mountain, and of course, Digital Realty. And guess what? All those data centers come from the REIT asset class. REITs actually pay pretty attractive dividend yields, and Digital Realty has a 3.4% dividend yield. So you get to play in the AI ecosystem, but you also get some income too.
Kevin, as you said, it's not just the earnings, it's not just tech, it's also what the Fed does.
Yeah.
And here there does seem to be a divide as to whether or not the correction, I mean, we're only down like 3% the past 6 days. It feels like a correction given how calm it's been, but whether or not it will endure. On one side, you have Marko Kolanovic, who basically says it will endure because you have the issue of higher yields, you have the issues of higher commodities.
Complacency.
Exactly. And then on the other side of that, you have Citi, who say earnings are going to save us.
Yeah.
Which side are you on?
I'm in the camp that the Fed hasn't changed since we started this year. other than raising their inflation forecast. They actually raised their inflation forecast for the end of this year, core PCE, to 2.6%. And they don't believe inflation comes back to their 2% target until the end of 2026. Yet they're still forecasting, as of March 20th, 3 rate cuts this year, 3 rate cuts next year, and another 3 rate cuts in 2026. That tells me that the Federal Reserve is more concerned with this economic slowdown potentially dipping into a recession than they are with inflation staying above 2%. Will they go through with those 3 interest rate cuts? I don't know, but there's still a path forward. The way I see it, they don't cut in April, they don't cut in June. Perhaps they cut for the first time by 25 basis points at the end of July. They don't meet in August. Their last meeting before the presidential election is in September. They don't want to appear too political. They pause in September. They don't meet in October, and then their next meeting is 2 days after the presidential election. 1 more cut there, and perhaps 1 more cut in December, and they get to their 3 interest rate cuts. Again, I'm not suggesting that's going to be the path forward, but there is still a path forward.
Well, as you say, this market still has a set of rose-tinted glasses on it.
Very much
a little
so.
bit hope rather than delivery. Great to have you with us this morning. That is Kevin Mann of Hennion Walsh Asset Management, our guest on the markets. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. Euro area private sector activity advanced to the highest level in almost a year, driven by a buoyant services sector and Germany's return to growth. The April composite PMI index increased to 51.4 in April, stronger than the 50.7 predicted by the economists, and above the 50, the important 50 level, that indicating the difference between expansion and contraction for a second month.
U.S. campus demonstrations are spreading as the Passover holiday begins. Columbia University moved its classes online after days of protest roiled its New York City campus. Pro-Palestinian demonstrators want the school to exit all investments that benefit Israel's government.
The Wall Street Journal reports the U.S. is drafting sanctions that threaten to cut Chinese banks off from the global financial system. It's part of the efforts to stop Beijing's commercial support of Russia's military production. Secretary of State Antony Blinken is heading to Beijing today, Tuesday.
Coming up, the U.S. FTC attempts to block a merger between owners of the fashion brands Coach and Versace. We're going to have more on that still ahead.
And the EV maker is consumed by chaos. Tesla gets ready to report its results after the bell. Context matters on Bloomberg.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
This is the period for Musk. Lay it out. Don't just talk, walk the walk. Because the benefit of the doubt's not there. Yeah. And this has gone from a Cinderella story to essentially a Friday the 13th.
Dan Ives saying it like it is at Wedbush there, the analyst on Tesla. That was last week on Bloomberg Brief. So we're kicking off with the earnings today for Tesla after the market closes. Joining us now is Oliver Crook. Crook, good morning to you. I mean, we just had a guest on the show who said Tesla just cannot get out of its own way. There's many threads to follow in this story. What do you think will be the most pivotal for the market to focus on? Good morning.
Yeah, good morning, Manus. I mean, listen, you have to deal with the numbers first as a sort of the anchor to begin the conversation. And we know that in the first quarter, they had the first sales decrease since the pandemic in 4 years. We're likely to see revenue drop for the first time in as long this quarter. We're also expecting sort of the sort of profit outlook, operating profit to drop as much as 40%. And yes, we're going to care about the outlook and all that sort of thing. But as you know, the guests have been saying, it's really a question of what is the story of Tesla right now? The answer to that earlier this year was we're going to build a cheaper car. We're going to actually take a look at the manufacturing process. We're going to do something very different to get that cheaper car to market, and that is how we're going to win. Then we understand Elon Musk basically shelved that idea and say, no, we're actually going to go, quote unquote, balls to the wall on autonomous driving. And that is what he put forward for these robo-taxis. And that is a sort of a Muskian way of doing things, right? There's a lot of competition for cheaper EVs. A fully autonomous robo-taxi would be something entirely different as the sort of initial Tesla car was. But again, that is very speculative at the moment. So what we're all looking forward to is, yes, the earnings out after market today, but really that earnings call where Elon Musk will have to lay out and sort of get a bit of silence and control to try to tell the story going forward for Tesla.
Oliver, some people could argue this isn't just a Tesla story. It's not just chaos at Tesla. The reason that they're having to cut these prices, the reason they're having this issue is that EV demand in general has been struggling. People don't want to pay up for EVs. I know the IEA had an outlook for the sector, for electric vehicles. What does it say, whether this is a Tesla problem or an EV problem?
Yeah, Danny, there's certainly elements of truth to that. But overall, in aggregate, in the first quarter, they said that EV sales across the world rose by 25%. They expect, 1 in 5 cars to be sold this year to be EVs. So that is still a growth story overall. What is interesting is that it is a China story. Almost half of the EVs, 45% that will be sold this year in China, are going to be, of all the cars, are going to be EVs. And that is because they're just a lot cheaper in China. Overall, again, they look at the numbers, 60% is overall EVs are cheaper than they are of combustion engine cars in China. That is very, very rare. You don't have that in Europe. You do not have that in the United States. And what it means is that last year, China became the biggest exporter of autos, overtaking Japan, overtaking Germany. And so all of this is coming to the fore. But yes, it is a China story. And that is what all of these car makers are really competing against, that price point where China is just basically a full head ahead.
Yeah, also in terms of quality delivery in the EV space in your backyard, if you get into a German EV relative to a Tesla EV, the difference in quality is manifest. Let's talk about some of the Americans. GM is going to report their numbers. Now, look, it's not just, let's be fair, it's not just Tesla that's got problems in China. GM's also under a bit of pressure there as well.
Entirely. It's their second biggest market, and there actually have been years where in GM, they outsold the United States in terms of China being that significant a market. I mean, last year, about a third of their sales came from China, but they've really been losing a lot of ground there, right? And that is in part, just that EV story, and that China has really dumped so much resource into their domestic market and really funneling the consumers towards that. So we're expecting to watch, yes, the Chinese market very closely, but pricing is going to be key, right? We had a sort of record for pricing last year. That is certainly coming down. The question is, how soft is it? And in terms of the outlook, I mean, the German car executives I've spoken to throughout this year, they're very reticent in terms of giving clarity on what the back end of the year looks like. Yes, that is a rate story, but it's a very cyclical sector, so it's hard to know exactly what's coming. And we're going to get the earnings out at about 6:30 a.m. New York, and the earnings call at about 8:30. So we'll be watching those points very closely.
Oliver, appreciate it. We'll be watching with you. Bloomberg's Oliver Crook there. Now to other earnings, Novartis raised its forecast as sales of blockbuster medicines for heart disease and psoriasis outpaced expectations. It's giving the stock its biggest boost in 9 months, up more than 7 1/3%. Bloomberg's Anna Edwards spoke with the CEO earlier today.
We're
broadly more positive about the momentum we're seeing in the business. One, we saw very good performance across our growth drivers, both established medicines like Entresto and Cosentyx, but very strong growth from our recent launches, Kesimpta, Kisqali, Pluvicto, Leqvio. So when you have that broad base of medicines all growing really well, it gives us confidence for this year, but also for the years to come. In addition, we saw our performance broad-based from a geographical perspective. Very strong performance, U.S., ex-U.S., Europe, China, Japan, also giving us a lot of confidence. So while there was a small contribution from generics getting pushed out, we're reiterating our confidence in our 5% plus sales growth guidance out to 2028 and our 40% plus margin guidance out to 2027, along with the various guidance raises you just mentioned.
Can I ask you about Pluvicto then, Vas? There's clearly one of the drugs, a cancer drug that you have high hopes for. It does seem as if sales came in perhaps just a little shy of expectations, but I wonder if this reflects a broader concern about convincing the market to pivot towards a new type of targeted radioactive therapy. Are you concerned about how long it's taking to convince the market that this is the way forward, or do you not have concerns there?
No concerns. We feel very confident about the Pluvicto outlook. We saw strong quarter-over-quarter growth, and it's important to note we're just now coming out of a supply disruption we had last year. Now in the first quarter, we had 99.5% on-time delivery of the medicine. We're seeing a broadened base of growth in the United States from treating centers that are getting comfortable with this new technology. It is a very novel approach, and so oncologists need to understand they can refer patients for this therapy, radioligand therapy, for prostate cancer patients. The other opportunity we have in the second half of this year is this medicine will go global. We'll have the opportunity to take Pluvicto outside of the U.S. at scale, and that will give us further growth. The most exciting part of the Pluvicto story and our radioligand therapy story in general is moving into new cancers and new cancer settings. So with Pluvicto, we confirmed earlier this year that we will file for the PSMA-4 setting for Pluvicto. That will allow us to broaden the indication base. And we've also done a number of deals and have in-house programs to bring more radioligand therapy forward, therapies forward. So we think this will be a significant market opportunity for the company.
That was the Novartis CEO there, Vas Narasimhan, catching up with Anna Edwards earlier on. I mean, it seems as if that company has been on a transition, a metamorphosis year after year. I met that CEO on his first interview many years ago, and he is perhaps one of the most convincing CEOs that you will ever meet, completely committed to the change program.
He is, and this is what I would say. It's great to see a pharma company do well, not just based off of weight loss drugs.
There you go, bringing it home. The stock is up. And whoever christened the phrase bolt-on M&A, well done. The CFO says they're still in the market for bolt-on M&A. Quick snapshot of markets, 5:20. We're counting down to Tesla. We're all excited about that. It's the busiest earnings day on the street so far this quarter. SPOOs are up 0.1%.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale
and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Brief, Danny Berger and Manus Cranny in New York. Manus.
Yeah, let's get into the front pages. This is what we're taking a look at. Headlines around the world. First up, Donald Trump's first criminal trial. It began on Monday, Danny. Prosecutors and the defense team making the cases on the former president's hush money payment to the porn star Stormy Daniels. Court proceedings are scheduled to continue later today.
Next up, Manus, the U.S. Supreme Court signaled sympathy for cities struggling with homelessness. This coming from the Wall Street Journal. The court's conservative majority suggested Monday that their current approach intrudes on the discretion local officials need to address the issue. A decision is expected before July.
And investors have slashed the size of their, guess what, risk parity funds. She's written about it for years, by over 70 billion. This was from their peak 3 years ago. And who is the one that's perhaps taking the biggest sting, Danny? It's Ray Dalio.
Right. Well, the man essentially invented risk parity. They don't call it risk parity, they call it all weather. But quants have looked at it from that and said, this is what it is. It's easier to market
all weather, isn't it?
Yeah, risk parity doesn't have the same thing. But what it does is it essentially overweights and it's over-leveraged bonds. So the thing worked really well post-GFC because bonds did really well. But what happens when the bond bull market is no longer with us? Can this strategy survive? That had been the criticism for a long time. And now that it's happened, now that the bond market has turned, people are saying, see, look, this was just an over-leveraged bond portfolio.
Yeah, but I mean, this is the third year in which bonds have simply just not delivered. It was supposed to be the year of the bond, but of course, the stiff competition for the theoretical risk parity is, of course, the other favorite theme of this show, which is private credit. And in terms of diverting your money, if you're not getting your return on your equity within the risk parity funds, you probably see something a little bit more tantalizing with private credit. But it's all about
Tesla. I was just thinking, am I a bandwagon reporter? I did risk parity and then private
No, I would
credit.
never accuse you
Just
of being a
doing all the hot
bandwagon
things.
reporter. You're zeitgeist reporter. That's what you are, not bandwagon.
I'll take it. Okay, Tesla coming up.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
From our global headquarters in New York, I'm Danny Berger with Manish Cranny. Let's set your agenda.
Musk's moment of truth. Tesla kicks off the earnings season to high gear today after the market closes. More bad news for Apple. iPhone sales in China fall 19% during the March quarter. That is the worst performance since 2020. And the FTC sues to stop Tapestry's $8.5 billion deal to take over Capri, alleging the deal would harm the luxury goods market. Handbags would become more expensive. Crisis. Danny.
Because they're not already expensive. They're so affordable now. But man, there's no let up in the calendar today. Yes, we might not be hearing from Fed officials ahead of their meeting next week, but it is a busy earnings season, the most busy week on the calendar. We got Tesla on deck today. S&P cracks the 6th day of losses, gains yesterday, potentially on some algo buying. We're up higher again today, 0.2%. You also get a let up in the bond market too, backing off of 5% on the front end. We're going to get $69 billion of 2-year yields on auction today. Again, around 5% yield, perhaps there will still be healthy demand for it. At the same time, gold. Okay, this thing has been falling a significant amount. It falls a further 1 1/3% this morning. It had been up 16% year to date. It fell significantly yesterday as well. Some folks, there's some chatter out there saying perhaps it's margin calling with the amount that Nvidia fell. Maybe that trickles over to gold because a lot of retail people hold it. But there's an overriding question of, is this the end of gold's run or is this a healthy correction? In terms of a healthy correction, man, is the thing I love. Marko Kolanovic says the U.S. equity correction will continue. There's too many stressors out there for it not to in terms of macro land. Can we call this thing a correction? I think we're down some 3% in the past 6 days. I'm not sure that's a correction.
No, you can't. I mean, you know, when it was down 5.5% in 6 days, you could say we were nervous, but we seem to have re-galvanized ourselves for this earnings season. You're going to have to wait a month for NVIDIA to deliver the numbers for them. In the meantime, we're going to deal with a little bit of volatility from Tesla, from Microsoft, etc. I found interesting Goldman Sachs, they look at what the hedge funds have been doing. And in the 3 weeks that you've all been out there selling and getting incredibly nervous, guess what the hedge funds have been doing? They've been buying. They have been buying the largest notional value in over a year. Of course, they are fast money, and so therefore that leads to some of the movements, but it just shows you what is going on under the hood. And Kolanovic says that this level of complacency will not be, you know, you will pay for that complacency.
Well, the irony of hedge funds buying a lot now is some people were saying with the past 6 day sell-off, you finally get this washout in positioning. Finally, it's safe to jump back in. And of course, it's this very circular argument because it's safe to jump back in. The hedge funds go back in. and hey, maybe this market is a little bit overbought again?
Well, we'll decide whether it's retail on the wrong side or hedge funds. That can be the debate, but it is going to be all about the uncertainty, and the uncertainty around the iPhone. We've just covered that. The sales in China fell 19% during the March quarter, making it the worst performance since 2020. Joining both of us on set this morning is Mandeep Singh, Bloomberg Intelligence. Look, we knew things were bad for them in China, but you know, things are tough for everybody in China in a myriad of different product areas, from autos to GM to Tesla and Apple. But what is the root cause of the problem? Is it pricing? Is it government policy? What is it that has caused them so much angst in China this quarter? Good morning.
Yes, good morning, Manus. And look, I think with Apple, everyone knew that China would be bad, but I think investors are grappling with is it's not going to get better anytime soon. And in this case, you know, Huawei coming up with a phone that's comparable to an iPhone in such a short time just puts into focus how much of stickiness Apple has in the region. And look, the government policy is playing a role over here. But in the end, Apple's revenue growth is driven by iPhone and market share gains. And that's not going to happen given China is a 20% region. And they're losing market share over there.
I mean, the irony is, Manus, you and I talked about this, is literally yesterday, Bank of America puts out their top picks, and Apple is one of it. Not that this would necessarily change it, because as you said, Mandeep, we knew that China was weak. If it is all based on the iPhone now, and Apple keeps looking for its next big thing, it's clearly not cars anymore. They've given that up. They're plowing money into robotics, into AI. Is it clear that there is a next big thing?
Even if there is one, and I bet you, you know, they will come up with a device category that's good enough to, you know, add to their iPhone install base. But China being such a big market for them, I mean, it makes you wonder, has Apple reached peak earnings at least for the next 2 years? And the answer probably is yes, because how do you make for that revenue shortfall? Either you have to make people buy more phones. You and I own one iPhone, probably we should be owning two, or they raise prices. That's the only way they keep growing revenue to make up for that shortfall in China, and that's a bear case.
I've given enough of my life to my to my various phones and various technology devices. With that concept that this may be peak iPhone demand, how quickly can and will India supplant the 20% of revenue that China delivers at the moment? Blow the myth apart.
Well, so look, I'm in the camp that Apple will continue to gain some share from, Samsung or for others in regions outside China. But Apple not only has a revenue problem, they also have a supply chain problem in China. Most of their manufacturing is still done in China in terms of the assembly, and they have to relocate the supply chain. That's where India can be helpful in terms of relocating. But in terms of making up for that lost share, I think it'll be very hard, especially if we are modeling the revenue would go to zero in China over the next 2 years. How do you make up for that revenue shortfall?
Now, in terms of, you know, company spending on AI, I know Meta also, their whole thing is also perhaps catching up with TikTok, having a video platform that can have the same amount of AI. We've been debating a lot about this because TikTok's obviously up for sale, and we want to know, is the algo going to go on sale? So whether or not that's included in the next version of TikTok, is Meta all caught up in TikTok's algorithm yet? Have they made the progress enough?
They have, and look, I think when you look at the numbers, 200 billion views for Reels every day, contrast that with YouTube Shorts at 70 billion, and TikTok is around that same vicinity. It just goes to show that Meta has the family of apps to showcase their short-form video product, and they've done that successfully. It's in the numbers. So clearly, you know, Meta not being exposed to China is a good thing. They don't make any revenue there, and the fact that they have caught up with TikTok from a product perspective really helps them kind of navigate this environment much better.
It's an amazingly interesting, you know, differential, isn't it? Not exposed to China, not dependent on revenue for China. Therefore, the differentiator, the divergence will only ever grow. But you talk about how they use the AI capacity in terms of driving the advertising narrative, and it's so much sharper. It was always sharp, you know, Facebook and Instagram, but it's even more defined with the AI iteration.
Yeah, and look, Meta has their own large language model. I mean, there are only 3 companies among the hyperscalers that have their own large language model when it comes to generative AI. Meta has actually open sourced their Llama model, and they're trying to build a community. So clearly a lot is going right for them in terms of having that infrastructure, the GPU allocation from NVIDIA, and then using it to build their own large language model. We don't know if Amazon has one yet of their own large language model. We definitely know Apple doesn't have their own large language model. So they are in that race where they have caught up with Google and Microsoft OpenAI, and they're right up there when it comes to generative AI.
Mandeep, that all sounds wonderful, but the issue with us, macro obsessives is that, every time we look at an ad giant like Meta, we think, well, surely they will be dependent on the health of corporate America, the health of the corporate world, and we have surveys showing, corporate confidence for small businesses at multi-year lows. Is that going to affect them this quarter and the willingness of companies to buy ads?
You're right. So Meta is exposed more so to small businesses than some of the other hyperscalers. So from that perspective, ad pricing probably will be muted when it comes to, the prior comps that we have seen. And look, there are only two companies where you want to spend your ad dollars still. It's Alphabet and Meta. And that hasn't changed. The smaller ones are struggling more, the likes of Snap and Pinterest when it comes to ad targeting and ad pricing. So in this case, yes, if the overall digital ad market is down, then it will affect Meta, but they're still the best exposed when it comes to the rebound that will happen at some time.
The debate in the quarterlies up until now has been, how splendid Meta is, how outstanding Microsoft is in their space, but perhaps the laggard is Alphabet, owner of Google. Now, what is going to drive that stock? Is it going to be the cloud, which is the traditional sort of thing that they lean on, likewise with Amazon, or are they in the catch-up game and therefore their capex is going to outweigh any alpha in the cloud?
Yeah, so look, Alphabet is still a digital ad company. If the search segment doesn't do well, they're going to not do very well with their numbers in terms of where consensus is. So that reliance still remains, but what they've done well is YouTube. That actually should come out better than Netflix based on our estimates, simply because YouTube has got a nice traction in terms of converting their freemium users to subscriptions. And if the ad market is coming back, especially on that brand advertising side, I think YouTube should do very well. And then cloud, as you mentioned, they have a lot of the NVIDIA GPUs that they can rent out because they rely on their own chip for training large language models. So that should actually help their cloud revenue, but we have to see it in the numbers. Microsoft quantified that AI growth on their cloud business about 5%. We want to see that higher for Alphabet, given they have more GPU allocation that they can rent out.
Right. Well, we'll get both those numbers Thursday. Meta tomorrow. Mandeep, good luck for it. I hope you sleep well this week because it's a busy one for you. Mandeep Singh there of Bloomberg Intelligence. Okay, coming up, the FTC sues to block a merger between two fashion houses. We're going to have more on that next. Context Matters on Bloomberg.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
This is Bloomberg Brief. Danny Berger and Manish Cranny in New York. How about a little bit of affordable luxury? Well, it's going to stay small because the FTC has sued to stop fashion group Tapestry from acquiring its rival Capri for $8.5 billion. Bloomberg's Kimberly Adam joins us now for more. Kimberly, this really is, isn't it, the first time that regulators have stepped in to fashion, have stepped in to luxury. So what does it mean to have this deal blocked?
First of all, this isn't the first time Tapestry has done this, believe it or not. So Tapestry doing this, the FTC has ruled that they're going to block this deal. They filed complaints in the House and federal court in their house. This is going to raise prices for handbags, accessories, and luxury items, and it's also going to harm consumers, believe it or not. One other thing, it's going to harm the 33,000 employees that work for both of these companies because they compete intensely on everything from design, promotions, etc. So it's not necessarily a good thing. We have Tapestry, they're in charge of, or they own at least Coach, Kate Spade, Stuart Weitzman. Capri controls Michael Kors, Versace, and Jimmy Choo.
So what are the companies saying? I mean, you know, the FTC, for the FTC to step into luxury good deal is really quite shocking. I was at home yesterday afternoon, and that's why I sent it through and said, let's spend a little bit of time on this. What is it that the FTC are accused of not understanding?
Well, they don't understand why this whole deal is happening right now. They believe that, especially when you go down to the quote from Henry Liu, he says this is going to further entrench the stronghold in the fashion industry for Tapestry. Henry Liu, he is the FTC's Bureau of Competition. He's in charge of that. That's what he said. This combined Capri thing would be the second largest personal luxury goods company in the U.S. behind LVMH. So,
but see, this is the thing. Okay, not to speak ill of these brands, but I look at them: Kate Spade, Stuart Weitzman. That's not exactly a stronghold in luxury goods. Again, if you compare it to someone like LVMH, who owns so much, I mean, is there not an element that this deal would help American luxury compete with European luxury?
We're talking about two companies, and we're talking about this merging of all these, just one huge brand, and it's Tapestry. They've done it before, so that the FTC has had their eye on that. So here we go again, and they're trying to have this stronghold on the entire fashion industry. It's going to really make them strong, the second largest brand.
Okay, well, let's keep an eye on it. I mean, the issue is this, is that when you go into a store, and you look at the various brands, you go into various brands at various stores, most people don't actually know that it's one holding company that actually owns all of the brands.
Yes. These guys have become like the streaming services. You don't know. They're all in bed together. It's like you turn on one channel and you don't know who owns what. It's the same thing now with these companies, right?
Yeah, and you find yourself buying all of them.
But this is a first.
All the platforms, all the handbags.
Shopping too much. Shopping too much luxury.
Me, never.
That's not bad.
Handbag wars at dawn on Bloomberg Brief.
It's not a bad thing.
Kimberly, thank you very much. Kimberly Adams tracking the deal blockers at the moment. Let's turn our attention over to the banks. Goldman Sachs is going through another bit of a shake-up. This time they're closing down an entire unit while expanding their team in Europe. Bloomberg's Charlie Wells joins us now. So this is about robo-investing. This was all part of the great dream of Solomon, which was going after the retail consumer, the retail customer, and a little bit of robo-investing. That is now moving along and out of the family, so to speak. Good morning, Charlie.
Good morning. Yes, Manus, that's exactly right. So, this represents a winding down of that consumer effort. Goldman has struck a deal with Betterment, which is a $45 billion digital investment advisory platform, and they're going to be moving Marcus Invest over to Betterment. And now this, as I said, represents a winding down of an attempt that they tried to bring the little guy into the firm. So with Marcus Invest, which took flight in 2021, the idea was that customers with as little as $1,000 could get some investment management advice. That is now going over to Betterment. But the more popular Marcus savings accounts that Goldman has had, that is a separate issue, and those are going to stay with Goldman for now. Goldman actually has $110 billion in deposits from there, and that is a rare success from this consumer foray, because that gives Goldman cheaper funding from unsecured borrowing that they needed. So this is a real boon for them. But that investment management service for the everyday person, that's going over to Betterment.
Yeah, I mean, I remember when they did this deal, when they partnered with Betterment, and everyone was, I mean, robo-investing was so hot then, maybe not so much anymore. And Charlie, elsewhere for Goldman, I mean, you'll know this story so well. The narrative goes, post-Brexit, everyone will flee London's financial services. Everybody will go to continental Europe. Instead, it's been more of a drip feed, but we're getting more drips from Goldman. What changes are they making?
Yeah, so this is maybe more of a bigger drip, I'd say. So their head, hard to describe a bigger drip, maybe a little bit of a drop, exactly. So Dirk Lievens, the head of financial institutions deal making in EMEA, is going to be moved from London to Paris, and we know that his team is going to double in size in the French capital. And Lievens, in an interview, said that there was a Brexit component to this, but this is also a part of the financial institution deal making acceleration that we're seeing over here in Europe. So we know here that a lot of banks, a lot of insurers, they've got extra cash from these higher rates, and they want to do something aside from buybacks. So what they're looking to do is to do some M&A, to do some deals, and actually there's stuff to buy. I'm thinking about some banks like Societe Generale, which are going through some reorganizations. They want to sell some of those units, and they've got willing buyers. So this certainly has a Brexit component, as Lievens himself said, but it's also a part of that larger move of that deal-making acceleration on this side of the Atlantic.
We're also getting a little bit of news flow on UBS in terms of strategy on mainland China. This time, they're going to step back from building their own wholly owned mutual fund business. Why? Is there a big crossover with Credit Suisse? What is the rationale?
This is really interesting. And look, the mutual fund market in China is worth $3.73 trillion. So people want to get involved here. But what people familiar with the matter have been saying is that UBS is going to shelve plans to build a wholly owned mutual fund firm. If you look at other U.S. financial firms that have been trying to get into that mutual fund space in China, you see that this UBS move is more conservative. And the idea here is that it's just incredibly expensive and that the profit outlook is not positive going forward, so UBS will rely more on some of its local joint ventures. Now, I said this was a little bit more conservative. When you look at Morgan Stanley, when you look at JP Morgan, they have now taken control, whole control over those joint ventures. When you think about BlackRock or Fidelity, they built mutual fund firms from the ground up. So for UBS, this is the scaling back, and Manus, you mentioned Credit Suisse. Yes, this is more of a reliance on some of those joint ventures that both UBS and Credit Suisse had in mainland China.
Well, you talk about them pulling back because of the expensiveness of it being more conservative, but at the same time, Charlie, they're going to Silicon Valley, a place not known to be cheap for both real estate or talent or competition. It's going to open an office in the Menlo Park. It's going to open a Menlo Park office, rather. I mean, what do they do here? It's not like there's a lack of bankers in the area.
Huge amount of competition, and I think the word on the street is that, look, IPOs and deal making in Silicon Valley are going to come back. UBS, we know Sergio Armati has, the United States as a growth geography in his mind, and so we do know, according to a person familiar with the matter, that they have hired Sean Lynch from Barclays, who covered Tesla and covered Uber, and they're going to be trying to scale up and trying to bring in more of that talent. And look, UBS is a global firm, but we also know that one way that they could potentially differentiate themselves in a very crowded field in Silicon Valley, which also, I should say, is an incredibly global space, despite the fact that, we're talking about Sand Hill Road, which is where a lot of venture capital firms are. We have a lot of U.S. focus there, but they could potentially really sell that global presence that they've got.
And, maybe there's some ex-SVB bankers floating around who might be willing to get a job. Charlie, thank you so much, Charlie Wells there. Okay, coming up, it's a busy day. We're going to look at some of the earnings. Coming up, Context Matters on Bloomberg.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I played drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Question. Best question I get all night.
Bloomberg, top experts, great questions.
The market's going through a transition right now.
We've had so many people chasing these rate cuts, chasing these higher valuations, that I think we're due for that correction.
It's impossible to believe they're going to hold rates at these levels forever. But the timing question is a big one.
Higher long-term rates are something we can learn to live with.
You can live with slightly higher inflation and a slightly higher Fed funds rate.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
In some ways, earnings season begins right now. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market on the S&P 500 snapping that 6-day losing streak in yesterday's session. On the S&P this morning, positive by 0.1%. One stock that did not snap the streak was Tesla. 7 days of losses going into earnings a little bit later on this afternoon. On the month, down by close to 20%. Bramo, year to date, down by more than 40.
It has been kicked out of the Magnificent Seven, but more importantly, the idea of profitability in China has been wiped off the table with the latest price cuts. We have a company that is fighting a sentiment wave as well as the very real wave of competition in China during a fraught moment for the electric vehicle market.
The list of issues is so long: pricing, leadership, product release, competition in China. We're trying to figure this out. I think we've asked this question a few times on this program over the last few weeks. Anne-Marie, what is a Tesla problem and what is just a broader industry problem right now?
Well, it's a great question because you're seeing this EV demand really wane around the world, especially in key markets like China. The issue is you do see China national companies like BYD doing very well. The issue seems to be in other places, especially in the likes of the United States. When it comes to Tesla, though, Jonathan, the problems just continue. And overnight, we even had an exclusive story about the newly formed marketing team is part of those company-wide layoffs. And this was supposed to be to get the message out in advertising. Because once you saw the Inflation Reduction Act come out and those tax subsidies, a lot of people went out and bought EVs. But now that demand is really starting to wane.
We've heard about problems in China for a while, not just for Tesla, but for Apple as well. Waking up to another story on Apple, more bad news for the stock. This time it's Counterpoint Research, Bramo. iPhone sales in China falling 19% during the March quarter, the worst performance there potentially since COVID back in 2020.
And it's losing market share. And I think this is the more important point, the idea that the Xiaomi's and Huawei's of the world are taking over, which raises this question: how do they get a foothold in a country that is going to push its own brands? This is the reason why Apple, Tesla, they're kind of in a world of their own. They're dealing with the China question in terms of demand, but they're also dealing with this broader demand question for their products, which is the reason why increasingly we're seeing this fissure in big tech earnings between the Microsofts, the Googles, even the Metas, versus, say, the consumer-facing ones, as Mandeep was talking about yesterday?
The more interesting number was Huawei, in contrast, climbed almost 70%. You see Huawei and these national champions in China doing very well at the expense of the likes of Apple. And this report comes after Gina Raimondo went on 60 Minutes and said, actually, we're out-chipping you. We're better than you. Our product is better. And you have to think, is it? Because Huawei in China is taking Apple's market share.
Lisa nailed it. This is not a market problem. This is an Apple problem. And you see that in the numbers. This is a growing market and they're losing market share. You see it against the likes of Xiaomi, Huawei, all rising to the top. My favorite story this morning, though, none of these. It's not Tesla, it's not Apple, it's this one right here. The US Federal Trade Commission suing to stop Tapestry and its $8.5 billion takeover of rival Capri Holdings. So this is Coach going after Versace, looking for a piece of Jimmy Choo. And the government's worried about more expensive handbags. Are we for real? Is this a story?
They're suing this, and FTC voted unanimously on this. What I take question of, and Capri put this out in the statement, is why was this able to get through the regulators in Europe, which is a highly regulated place, and Japan, yet it cannot get through the US FTC? And this remains a question of, can any deal get through with this antitrust enforcement individuals at the top?
Come on. You need your Jimmy Choos, less expensive.
It's
we've
ridiculous.
seen real inflation in luxury. You know, it's time to target it, the price gouging in the luxury sector.
I thought we're building the economy from the middle out and not the top down.
Well, this is helping all.
What is this?
This is evidently, you know, honestly, Michael Kors handbag, your shoes, you know, they're going to be a little bit cheaper now, maybe. Who knows?
I think it's affordable luxury, right? So maybe that's the
entry level.
Entry
Okay,
level.
we care about entry level. This is ridiculous. More on that story a little bit later. Plenty of earnings this morning. Let's kick things off with UPS. Those numbers just dropped moments ago. Adjusted EPS, Lisa, coming in at 143. The estimate was 130. I understand they've reaffirmed their guidance this morning as well.
Yeah, talking about average daily volume in the United States showing improvement and expecting a return to volume and revenue growth. When you look under the hood, there's a lot of cost cutting, not necessarily as much of in terms of growth of just the overall, but this doesn't necessarily speak to some sort of massive slowdown in the consumer spending or even in the goods sectors, considering that they're going to bring back to some sort of normal level in the near future.
Stock is up in the pre-market by 1.4%. The broader market, if you're just joining us, welcome. Equity futures on the S&P 500 shaping up as follows. Futures pushing higher by 0.1%. Yields just a touch higher by not even a basis point on the 10-year, 461.69. PMIs in Europe coming in just a little bit better. Doesn't really buy you much euro strength, up by not even 0.1% now. That move faded ever since that data came through. 106.61 on euro dollar. Coming up this hour, Steve Chevron of Federated ahead of Mag 7 earnings. Bloomberg's Ender Curran as iPhone demand plunges in China. And Andrew Honhorse of Citi explaining how the Fed may still deliver 5 cuts in 2024. We begin with our top story. The S&P 500 bouncing back above 5K as Mag 7 earnings kick off a little bit later this afternoon with Tesla. Steve Chevron of Federated saying this: while we recognize markets may be choppy in the near term, we view pullbacks as attractive opportunities to add to equities as the market marches towards our longer term 6,000 target. Steve's with us in New York. Steve, good morning to you.
Good morning.
Last time we spoke, you said back in March that it was hard to sell this market. Is that still true?
Yeah, I think that's right. I mean, you had the ingredients for a pullback. I think we're probably in the middle, not at the end of one. But it's probably not tradable. I mean, I think you've got a lot of folks that are itching to get in the market. And when I hate to say this because it's an old term, but cash yields have probably peaked, right? We think that you're still going to see some rate cuts in the offing. Again, it's probably 1 or 2, which has been about where we are. There's a risk of 0, which is not a zero risk. So you got to be mindful of that. And with the market repricing higher, bonds aren't all that attractive here in a rising rate environment. So you look out. You saw the UPS numbers. The economy's still relatively strong. The consumer's hanging in there. Earnings are doing okay. How do you not want to own equities?
You're making quite a powerful point with a 2-year close to 5% and a 10-year through 460. Are you saying that doesn't provide much competition, or that competition is in the process of peaking?
Yeah. I think when you look at where cash yields are going to be, when you get rate cuts, those yields are going to come down. As you look at where the 10-year is, you know, from our perspective, it's hard to envision a world, even if you got 2 cuts, but you had a little bit of steepening of the yield curve. This 10-year looks fairly valued to us, somewhere between 4, 4.25, maybe even as high as 4.5. So it doesn't I mean, there's some value at 460, but it's not like a pound the table screaming value there.
One thing,
no,
it's just amazing to me that everyone was talking about it broadening out, that was the way to go. That was where the value was. Now we see sticky inflation, the idea of rate cuts being priced out of the market, and it strikes me that in that environment, you stick with the big behemoths that have cash, that are going to do just fine, and the smaller companies are going to keep struggling.
So we're not there yet. We came into this year with a kind of 1 to 2 cut forecast, despite futures pricing in 5, 6. Right. Well, no, but the question is, are we going to be 2 right? 1 to 2 is fine, right? In a 1 to 2 cut environment, if that's, leading into cuts in 25, I think then you still get that broadening out. And the underperformance of those parts of the market through the first 4 months of this year will have been a nice buying opportunity if you weren't in it. If that ends up being 0 cuts, and now you're questioning 25 cuts, then I think all bets are off. So from our perspective, because we still do see kind of 1 to 2 cuts, at least at this point, we still think that broadening out trade will ultimately be right. But if it's 0, then probably that's pushed back.
Can you give us a sense of what you've been doing over the past couple of weeks? Is this basically seeing Mag 7 fall out of bed? You're aggressively buying, you're getting ready for that to still be the leadership, or are you basically just sort of watching this all and saying, I'm not going to do anything, it's just noise, we're still marching towards 6,000?
So at the risk of sounding right again,
how could you?
We've been I'm not going to lie.
That is quite a line, Steve. That is beautiful.
Carry on.
Well, there's a live TV moment for you. We've been underweight the Mag 7. We've been underweight growth. We came in this year with this idea of a broadening out. We took a little bit of pain in the first part of this year on that. But the idea was, one, when you look at the relative earnings growth, it's going to decelerate for that Mag 7. And it's going to be overtaken by the forgotten 493 as you get deeper into this year. And given valuations, given names that ran hard in earnings, and given this idea that if we do get rate cuts at some point and the economy is stickier, that there's some catch-up play. And so we haven't done anything in the last couple of weeks. We've debated, we've talked, but the market's kind of come to our positioning.
What do you make of some of the noise that some are saying, and even the options market is starting to price in, I think, a 20% probability that there actually could be a hike?
Yeah, we're not there yet. I mean, look, I think this Fed would be loath to hike. I mean, they've gone through so much of the political capital work here in preparing the market for cuts that now I think they're frustratingly being delayed and putting through. To do an about face, I think you'd really need to see inflation not just be sticky, but reaccelerate. And that's the big question for us right now, and I think for the market. Is what we've seen inflation that's sticky within a range, or is it truly reaccelerating? And we're asking that question, but we're not yet ready to say, okay, this is reaccelerating and we're back in a hike scenario and all bets are off. We're not there yet.
Just to be clear, if it's sticky, that's still a buy on this equity market. That's good for stocks.
Yeah, sticky's okay because look, sticky means that you're in a range, you're probably grinding lower, rate cuts can come, you can get that broadening out, and that's better than plummeting inflation in the face of a growth scare. But reaccelerating inflation, which brings hikes back on the table, that's a very different scenario, and I think that challenges multiples.
Is there anything in the growth inflation mix right now that you think risks squeezing margins for corporate earnings going forward from here?
Yeah, we were talking about this just yesterday. I mean, you've got, if you think about where you are versus the beginning of the year, you've got energy prices that are probably higher than you would have expected. You've got overall inflation, particularly goods inflation, which is at least stabilized and kind of ticked higher. And then the question in the earnings estimates are how many rate cuts are priced into those bottom-up estimates. And if they're not going to come through, there's an interest expense there. So we've been bullish on earnings, but that's something that we're sharpening the pencil on and trying to understand, could there be a little bit of a downside surprise?
John, to that very point, average daily package volume for UPS came in above estimates, but revenue per package came in below estimates. So kind of very much speaking to exactly this point. I would hate for you to have to leave without commenting on expensive handbags and what you feel about the consolidation in the fashion industry and whether you think that this is going to harm the American consumer. How do you sort of factor this into your investment thesis?
Well, given the mood around this table before going on the air, I wouldn't dream. I wouldn't dream of supporting.
You can't discuss that.
The
Carry on.
The FTC here because I might incur violence. No, I mean, look, I'd say it this way. I mean, I do think that there have been a number of merger and acquisition opportunities that have been blocked at the FTC for companies that I think from our perspective are folks that are trying to stay alive and trying to improve a competitive position that are not really in danger of creating any kind of monopoly position. I would agree that this is one as well. Now, you know, it's not necessarily a pocketbook issue, but it's a handbag issue for many American consumers.
Nice, Steve. Did you do that on the spot?
I did. I did.
That was good.
And so I think it's terrible, and handbags should be much cheaper.
I think we're on the same page, Steve. Totally agree. Well said. Steve Chevron, Federated. Steve, thank you. That was perfect. More news for you. Earnings, PepsiCo, beat on the top and bottom line. Core EPS coming in at 161, the estimate at 152. Pretty solid international growth as well. Not a big move in the stock. The stock at the moment, a little bit negative, softer in the pre-market on PepsiCo at the moment, down by about 0.5%. More earnings throughout this morning. Let's get you some news elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. UBS is pulling back on plans to build its own mutual fund in China. Sources say the Swiss bank will instead rely on existing joint ventures. It cited high costs and a dim profit outlook. UBS had been contemplating a standalone fund platform since 2020 when China lifted foreign ownership restrictions. Tesla is being sued by a former employee who claims the company's decision to lay off 10% of its workforce in a global retrenchment broke the law. According to the complaint filed in a California state court, by not giving 60 days notice per state law, Tesla, quote, acted intentionally and with deliberate indifference and conscious disregard to the rights of its employees. Apple is close to inking a deal with FIFA to get rights for a new month-long World Cup-style competition, that according to the New York Times. The tournament is scheduled to be held in the U.S. next summer. It would be Apple's latest venture into soccer following a 2022 deal when it secured a 10-year contract for the worldwide streaming rights to Major League Soccer. That's your brief, John.
Danny, appreciate it. Thank you very much. Up next on the program, U.S. tech struggles in China.
The China shock continues. What you've seen is something we've seen over and over again, creation of excess capacity, overproduction that brings down prices.
It has been pretty shocking for the likes of Apple, that conversation. Up next.
Could face bigger challenges next.
Was going to keep Rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Earnings season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Bouncing back from 6 days of losses on the S&P 500 in yesterday's session, attempted to add some weight to that. Equity futures up by 0.2%. The bond market pretty stable, 461.48. It is all about the earnings this week. Under surveillance this morning, US tech struggles in China.
The China shock continues. The Chinese double down on their what we call non-market practices, their state investment in a strategic emerging sector. And what you've seen is something we've seen over and over again, creation of excess capacity, overproduction that brings down prices. It's a kind of predatory pricing practice.
Here's the latest this morning. Apple iPhone sales falling in China by 19% during the March quarter, according to Counterpoint Research. That marks the iPhone's worst performance in the region since 2020. This as the company faces increased competition from rivals like Huawei and Xiaomi. Bloomberg's Ender Curran joins us now to discuss. Ender, let's talk about some of the complaints. Excess capacity, overproduction, heavily subsidized product, and then just fierce competition. And this story with Apple feels a lot more like fierce competition than anything this government is complaining about. Can you walk us through the forces that are holding back some US tech firms?
Well, I think there's one stat that speaks to your point, Jonathan. Huawei sales in the quarter rose 70%, even as Apple shrank. And that speaks to the idea that China is innovating and driving its homegrown technology now that can compete with the best of the best. Now, at the same time, we did, of course, have some other detail within that reading on Apple's earnings in China over the quarter, which is that it came against the backdrop of the Chinese New Year, which is meant to be the time of year when consumers are buying and spending. When it's clear they were buying and spending, they just weren't buying US phones, they were buying Chinese-made phones. So I think it does lend itself to the idea that there is a homegrown base. Now, we're seeing that among electric vehicles as well. Tesla there discounting its vehicles in an attempt to generate sales at the same time because they're facing fierce competition from homegrown Chinese technology. And also, it should be said, ahead of Blinken's visit to China, there was a very rare briefing from the Chinese government to our colleagues in Beijing where they pushed back heavily against these US criticisms of overcapacity and the like. They accused the US of naked economic coercion and bullying. So I think two things coming out of these tech earnings at the moment, John. One, speaking to rising Chinese competition, no doubt about it. And then secondly, China's pushing back hard in this idea that they're exporting a spare capacity to the rest of the world.
Let's just sit on the former before we get into the latter. I want to talk about that increased competition. You alluded to it, and nationalism. The consumer choosing Chinese brands over American products. It's not a new shift, and do you just sense it's gathering pace, looking at what's happening with Apple, with Tesla?
Look, there's clearly explicitly part of the story is nationalism because the government, for example, has put restrictions on which kind of companies can buy Apple iPhones in the first place, Apple devices. You know, state-owned companies, government agencies are not allowed to hold Apple phones. That is naked nationalism, there's no doubt about it. Now, it's obviously harder to discern that among the consumers, but as I said to you, the data for that quarter speaks to the point when you see Apple losing market share, but at the same time, Huawei gaining ground there by 70-odd%. That speaks to the idea that money is there, consumers are still spending and willing to buy these devices, but Apple's losing out. Now, of course, the tech experts will say to you the real test will come in the fall when Apple's launching its new devices. It will be interesting to see then if it can rebound, and that will tell you how much of this is nationalism or not. But there's no doubt at the moment there are tensions, and that is being reflected in demand for Chinese versus US goods.
Commerce Secretary Gina Raimondo on 60 Minutes on Sunday evening, quote, "We have the most sophisticated semiconductors in the world. China doesn't. We've out-innovated China." Well, the data clearly shows they haven't, Enda. Is that correct? China is almost on par with the US when it comes to at least the chips that are needed in smartphones?
Well, look, there are tech experts who will make the same point that China isn't quite along the spectrum of technological innovation that the US is yet. But equally, though, there are critics of US policy who will say that all that the US is doing is accelerating China's own homegrown technological innovation, forcing it to double down on R&D. And we're seeing that in the pronouncements from the central government in Beijing over the last few months as they set out their economic policy for this year and the years ahead, making it clear that technological innovation and high-end manufacturing is a top priority for the government, probably ahead of lots of other traditional areas that drive economic growth. And that's what critics say is one of the spin-offs from the current US policy. You're just doubling down, forcing China to double down on where it's at, and eventually they will make some breakthroughs. And as we're seeing, Huawei gaining ground there in that first quarter, partly in the back of that revived model that they launched last year.
And you mentioned Secretary Blinken's travels. He's going to be leaving today to go to Beijing. When you look at this relationship, the Chinese government is certainly going to complain about potentially the EV tariffs, more of them that are coming down the line, the probe into the shipbuilding sector, the TikTok divestment or ban that potentially is going to get a vote today in the Senate. Which is top of mind for Beijing?
There's no doubt about it. On paper, this, Anne-Marie, the relationship is stable right now. It's probably been the best it has been in a couple of years. Officials are going to both capitals for talks. Yet, as you say, these measures continue, especially on the US side, continue to try and double down on punishing China where they can. But we're now starting to see a hint of pushback from Beijing. As I say, there was that rare briefing from Chinese diplomats ahead of Blinken's visit, and they're pushing back hard against these charges of overcapacity, in particular, for example, making the point that, as I mentioned earlier, they're accusing the US of naked economic coercion and bullying. These are pretty harsh and striking words that the Chinese are using, and I think it's the harshest rebuttal so far to the overcapacity story. So that one does seem to be striking a chord perhaps above all else, and I think it'll be very interesting to see how these talks with Blinken goes, both in terms of overcapacity, and we've reported that Blinken plans to make clear in terms of his views in terms of China's company supports for Russia too. So there's two prongs where we could see tensions flare anew on the back of this trip.
One thing that I find striking is a lot of U.S. officials have met with a lot of Chinese officials. There have been a lot of talks. Do the diplomats and other officials in China speak with Xi Jinping after speaking with U.S. officials?
Look, I think there's no doubt there's hardly a unified approach when it comes to dealing with China on this, on several issues, be it on economics or be it on national security. We saw last week with the German Chancellor's visit to China, plenty of analysts saying mixed signals coming out of that, not necessarily on the same playing field or the same hymn sheet as the US, and that's a continued process. We see the US taking steps that in some cases are unilateral, sometimes with EU or broader backing, and sometimes without. So I think if you're talking about a unified approach to China on economics or on national security, I don't think it's there yet, Lisa.
And great to catch up, sir, and the current there of Bloomberg on two big issues there, what's happening with US tech into China and also the tension in the South China Sea. I think we all saw that quote overnight, Bramo, increasingly concerning.
Especially at a time where it seems like, and this is the reason why I was asking about this, Xi Jinping has aims that are somewhat divorced from economic growth or what's happening currently with the economy, which is the reason why there's so many mixed signals for private companies, international companies that want to go into China. Do they want them or not? Because right now, it's not clear where the priority is.
So this line from the outgoing head of the US Indo-Pacific Command, we all need to understand that it's moving very fast. The build-up of military power despite a bad economy, the increased narrative of all things inside the 10-dash line, a Chinese sovereign territory, then the actions that are going towards enforcement. There's a lot there, a lot to unpack. It's a long list of concerns.
And it's also why potentially you see the United States today and the Philippines conducting military exercises near the disputed South China Sea and Taiwan. This is certainly going to get the backs up of the Chinese delegation, though, as Blinken arrives in Beijing.
That's the latest on China. Coming up very shortly on this program, Dominic Assam of SAP on company earnings and the growth in AI from New York City this morning. Good morning.
Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Equity futures doing okay, positive by 0.2%. A bit of a lift yesterday, bouncing back from the longest losing streak we've seen in quite a while. Certainly the longest losing streak so far this year, 6 days of it on the S&P. A small bounce yesterday relative to the losses we've built up over the last week or so. On the Nasdaq, positive by 0.3%. The Russell just about positive as well, up by 0.1. Lots to talk about in the earnings front. We'll do that in a moment. Kicking things off is Tesla a little bit later on this afternoon. If you switch at the board and get to the bond market for the 3rd time in about 2 weeks, breaching 5% on a 2-year yield briefly. We're back down to 498.26, up a single basis point. And a conversation earlier on this morning already about how much competition, Lisa, that provides to the equity market and whether maybe we're seeing the peak of that competition. Certainly the view of Steve Cheveron of Federated.
If you think that yields are going to go lower from here, maybe slowly, but albeit lower, then the opportunity in cash becomes less. And then suddenly that wall of cash needs to go somewhere. A lot of people talking about yesterday, the bid into stocks was supported by the fact, to your point exactly, that crossover 5% was brief. It didn't stick. And there was a feeling that at least there was some sort of floor under Treasury valuations for the time being.
Unlike back in October, we haven't seen that sustainable break of that so-called line in the sand. Let's take the bond market action, fold it over to what's happening in foreign exchange. The euro just still stuck around 106. It's interesting to see this play out, 106.59, positive by not even 0.1%. Data was decent, I mean, relative to expectations of where it was before. Upside surprise on the PMI. I think the Eurozone composite now, 11-month high, Lisa?
Yeah, although it's driven by the services, because what you saw was manufacturing came in below expectations. And really, it's kind of a question of, okay, how long can services growth continue to fuel an economic trajectory without inflation that could be punitive and lead the ECB to keep rates higher for longer? It's a mush right now. And frankly, when you look at the euro, it's in the same place. It moves just incrementally. Elsa Linos thinks that there's actually signal there. She was saying that yesterday, maybe that means that actually pretty much all the dollar strength has been baked in. I get the sense people just don't know what else to do right now. Because what direction are we getting right now?
Pause to reflect or pause to get confused? Isn't that what Kit Juice of SocGen said? The more I pause and look at the euro, the more confused I become. The euro 106.58 at the moment. Under surveillance this morning, Mag 7 earnings kicking off today with Tesla after the closing bell. Investors will be looking for details on Elon Musk's robo-taxi announcement, as well as plans for a new cheaper vehicle. Results from Meta, Alphabet, Microsoft round out the week. Next week, we'll hear from Amazon and Apple. Right now, we're hearing from GM. Raising their full-year guidance. They now see adjusted EPS at $9 to $10. That's the new range. The old range was $8.50 to $9.50. The stock is up, Bramo, 3.4% in pre-market.
Yeah, what's interesting to me is they sort of kitchen sinked it, right? They were talking about how they were going to be cutting back some of their expectations for electric vehicle production, et cetera. Now they're raising full year guidance. This is a view they can see. I think the fact that they even have guidance is really telling. They have moved out of no man's land if we don't know what this is going to look like to, yes, this is going to be good. Why? Because truck sales are continuing. The China slump doesn't affect them as much because of that. This isn't driven by electric vehicles. This is driven by their bread and butter, and their bread and butter is doing just fine.
These are the cars Americans want. the EV almost feels like we hit the peak when after the tax subsidies came out, there was some move towards it, but there still is a ton of work to do in that space. And until they can get a EV truck or hybrid truck that people like, this is the demand, what the people want. And the fact that even though they're continuing to struggle in China, but they're still able to beat because of that demand when it comes to things like truck, I think just shows where the market is right now.
This could be the potential distinction a little bit later as well. If you can overcome the slump like GM just has in China, that's the question I think for Tesla a little bit later, which has clearly struggled. Can they do the same thing?
Well, frankly, GM didn't hinge its sort of truck, to put some random phrase out that absolutely made no sense, to China, right? Basically, we're talking about a company that really kind of relied on the U.S. Buyer base, and so they are winning as a result of that. Tesla is not that case. Neither is Apple, which is the reason why we keep linking the two.
GM is up by more than 4% in the pre-market. Elsewhere, the latest here, Columbia University announcing classes will be held remotely as anti-Israel protests continue on campus. Yale and MIT experiencing similar demonstrations. President Biden telling reporters, quote, the following. Here's the quote, Bramo. You tell me what you think about this. I condemn the anti-Semitic protests, and those who don't understand what's going on with the Palestinians, I condemn them too.
I can't explain it exactly because I interpret it in lots of ways that probably are my interpretation. Look, this is a very difficult moment for him in terms of how to message it, because you've got one wing of the Progressive Party that are very much in the camp of some of these protesters, and then you have a lot of people who think that, if people's personal safety is being threatened in any capacity, that's a line that should not be crossed. The bottom line to me, and I'm sorry, but I see the protests, and part of me is like, free speech, I totally adhere to that, but each university should have its policies, and if someone violates those policies, it is private property, they can enforce those policies. And if it's civil disobedience, you have to basically adhere to those policies. The idea of making a free space and a sort of feeling of safety, I think, is fine from a physical level. Emotionally, universities should challenge people.
These Biden statements come after we heard from the White House over the weekend, a lengthy Passover statement from the president himself, and then Deputy Press Secretary Andrew Bates had this to say, talking about blatant anti-Semitism, the issue with these protests, beyond free speech, the anti-Semitism, he says, unconscionable and dangerous. And the reason why this is going to get very political is you have senators coming out on the Republican side telling Biden he needs to bring in the National Guard when it comes to some of these universities. When you look at what's going on in Columbia, and then very late last night, a lot of individuals were arrested outside NYU by the NYPD for protesting. This is going to become an issue because these protesters are the youth. And that's kind of the issue here. They are going to lean mostly to the Democratic Party, but Biden is trying to tell that line, really, in terms of making sure he's on the side of Israel and anti-Semitism, but making sure also he speaks to the youth vote.
We'll talk about that story a little bit later. Let's move on to this. The FTC is suing to stop Tapestry's $8.5 billion takeover of rival Capri. This marks the first move of its kind by the Biden administration in the fashion industry. Regulators alleging the deal would harm consumers and workers. The Tapestry CEO saying in an interview that shoppers have a wide range of brands and price points to choose from. It's unbelievable we're having this conversation. Let's just go back to the question we've asked repeatedly, regardless of the industry we're talking about. Has this government just decided that any consolidation is just bad? Bottom line.
This is the question that a lot of executives are asking, and we've heard from Brian Moynihan, we've heard from others that basically a lot of companies are not really going to begin engaging with M&A until they have a better sense of what the framework is. This just adds to those questions.
Talking to some of the forces we've discussed over the last 30 minutes or so, some of the challenges, you'd think this would be somewhere near the bottom of the list, the price of handbags, but that's where we are. Elsewhere, software company SAP gaining this morning after reporting earnings boosted by artificial intelligence. Europe's biggest software firm posting record growth as it looks to move customers from its legacy business to the cloud. Dominic Azam, the SAP CFO, joins us now for more. Dominic, I'm sure you're in a good mood, so thank you very much for being patient and waiting for us to get to you. Let's talk about these numbers. This growth is coming at a time where there are some concerns on this side of the Atlantic about cloud growth for some big tech players. Where is your growth coming from? What are the tailwinds through 2024?
Yeah, of course, the advent of AI has clearly propelled the story of the transformation to the cloud to move our customers from their on-prem installations onto cloud, resulting in an uptick on a constant currency basis by 25% in our cloud revenues. Our more forward-looking so-called CCB, which is basically the 12-month ahead subscription revenues we've already contractually locked in, is even growing at 28%. That's a record growth. And all that is driven really by the core offering we have in the cloud, which is called the Cloud ERP Suite. That offering has actually generated in excess of 30% growth for 9 quarters in a row now.
What is the demand, Dominic, in terms of the specific applications of artificial intelligence in the cloud that you see most commonly invested in by the companies who are your clients?
Well, it's a broad set of applications throughout the enterprise, on HR, on finance, on the supply chain. So there's actually no exclusion, I would say. It's really, really broad. We have brought about 30 use cases recently to the market. We are planning another 100 to come. We already have more than 27,000 customers using AI-powered use cases in the corporation. The 300 million users we have by now in the cloud are really benefiting to make themselves more productive and to fight, for instance, rising inflation and salaries.
How much are you winning market share versus simply just capitalizing on the incredible demand that we see right now for artificial intelligence?
Well, undoubtedly on the Cloud ERP Suite, we do win market share. I mentioned the 30% plus growth we have. The market is more in the low to mid-teens. So that's a very tremendous outperformance. It's like more than twice the performance of the market.
So from who? Who are you gaining market share from in particular?
Well, sometimes it's kind of homemade solutions we are displacing. Sometimes it's also against our key competitors. It's also the fact that SAP has been more focused on the on-prem installations, i.e. software deployed by the customers. Now we're really moving to the cloud. So we can convert that huge customer base on-prem into the cloud, and that drives the growth that I mentioned.
German Chancellor Olaf Scholz was recently in China, and the head of your greater China region for SAP was talking about how this was a good thing and potentially there could be more of an expansion of SAP in China. Are you concerned when you see news coming out like Apple overnight about how they have this diminished share when it comes to Chinese revenue?
Well, actually, if you compare us to other global tech players, we have actually a relatively moderate share of revenues in China. We do see growth opportunities, but honestly, there are other markets which move the needle much more for us. So we're not really concerned on that front.
What other markets are moving the needle?
Actually, we have been super strong in Asia-Pacific outside China. Also, Europe, good old Europe is doing quite strongly. And last but not least, the biggest market for us is the United States. And we've also great traction here in the United States.
Dominic, at the start of the year, you announced a restructuring back in January. It was set to affect something like 8,000 jobs. I think initially it would give the impression that maybe you were consolidating and pulling back. And that's not what I hear from you right now. Are you hiring in certain places, and where are you?
Yeah, we are actually hiring as we speak. I mean, the restructuring program is now on its way. You mentioned the 8,000 people we are going to reduce. And this is really to focus all our resources on those strong growth markets that really matter, to invest $1 billion into AI in 24-25, to accelerate, to spin the flywheel. On the other side, there are areas which don't grow, which are actually in decline. So we have to make that adjustment and really are in the middle of that. So execution now is key to deliver the financial performance we have kind of indicated.
Well, it was certainly a good quarter based on the numbers, Dominic, and you're having a good day so far. The stock is higher. Dominic Azam there of SAP. Dominic, thank you, sir, for joining us. The stock is higher by something like 44% over the last year or something. So decent run.
It's the part of the granola that's working, because some of the other parts of the granola, the big shares in Europe that have been really outperforming, faltered a little bit, but they seem to be continuing to outperform.
That's the latest from SAP. If you are just joining us, equity futures right now on the S&P 500 positive by 1/3%. That's European tech. We'll talk a whole lot more about US tech through the week. We're going to hear from Tesla a little bit later after the closing bell. Then on to tomorrow, we'll hear from Meta. Then it's Microsoft and Alphabet to round things out on Thursday. Looking ahead to next week, Amazon and Apple. You work your way through May, we're going to hear from the likes of NVIDIA. So it's the first one out the gate of the Mag 7 a little bit later after the close. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. Let's catch up with Danny Berger. Hey, Danny.
Hey, John. We're going to stick with Europe, where Euro area PMI suggests that a recovery is gaining momentum. The readings hit the highest level in almost a year, with strong services and Germany's return to growth. Now, it's the kind of data that will likely strengthen the case for the ECB hawks, that potentially, after well-broadcast June cuts, that there should be a pause. The U.S. is reportedly drafting sanctions that would cut off Chinese banks from the global financial system, that according to the Wall Street Journal. The effort is to stop Beijing's commercial support of Russia's military. Secretary of State Antony Blinken is headed to Beijing today. Shares of Spotify higher in the pre-market, 8.25% after their earnings. They reported paid subscribers that rose 14% year over year. Now it sits at almost 240 million. Spotify had raised prices and plans to do it again for the second time in just a year. That's your brief, John.
Danny, thank you. Up next on the program, the Fed can still deliver.
The Fed is really determined. And that, to me, is the difference between really staying on hold or deciding that they want to take this plunge into the rate cut pool.
Citi's Andrew Hollenhorst thinks they will. He's making the case for 5 cuts in 2024. That conversation is up next.
On season 2 of The Circuit, we're walking with the titans of banking.
You guys love these meetings.
Yes, we do. And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Stocks near session highs, positive by 0.3% on the S&P 500. Equities just pushing a little bit higher. Yields going absolutely nowhere on the 10-year, 461.27. Under surveillance this morning, the Fed can still deliver.
The Fed is really determined. And that, to me, is the difference between really staying on hold or deciding that they want to take this plunge into the rate cut pool. It would take a really big revision higher in their sort of R-star estimates to get us to a place where they really feel comfortable staying on hold. I get caught in this sort of question of, do I think they should cut or will they cut? And again, it just seems like really the best argument today is that they want to.
They want to. Will the data cooperate? That's a question we've heard asked a million times on this program. Here's the latest. Investors looking ahead to Friday's core PCE data for clues on when the central bank might start cutting interest rates. Citi's Andrew Hollenhorst saying this: we continue to see the most likely first cut in June and project core PCE inflation to fall to 2.7% year over year next week. Our base case is for 125 basis points of total cuts delivered this year. Andrew is with us around a table. Andrew, sticking with June, looking for something like 5 cuts in 2024. I imagine you've had some pushback after the data we've seen over the last month. Why do you still believe the bar's pretty low for that first move?
Yeah, we've definitely had some pushback regarding the view. I think if you've been following the Fed, though, this is a Fed that wants to get to that first cut. Now, absolutely, the data have not cooperated with that. We've had these 3 stronger core inflation prints. But what we bring it back to is this idea that inflation is higher. We think it is structurally higher, but it is also more volatile. And if it's more volatile, it means we're going to get some stronger prints. We're going to get some softer prints. We've had some stronger prints. We're probably going to see some softer prints, and that will be enough. And I think it goes back to the discussion you were having with the prior guest. Should it be enough? I'm not sure, but it probably will be enough for the Fed to say, okay, we can get started with these rate cuts.
As you know, it's been whack-a-mole over the last 3 months. Every single data point we get, it's like something new is popping higher, and the Federal Reserve needs to talk about why it's going to go lower again. What is it in the basket right now that you see sort of fading, that you see disinflationary tailwinds continuing through 24?
Yeah, so I think there are a couple things that can help the Fed out. And again, I want to emphasize, it's really optically we'll probably get some softer inflation prints. I am pretty convinced that inflation is not returning to 2% in any kind of stable, reliable way. But in terms of kind of optically what can help them out, one thing is car insurance. Car insurance has just gone up by leaps and bounds over the last year. That is a real phenomenon. I will say my car insurance went up by approximately what's reflected in the CPI basket. But we know that auto prices have peaked. Auto prices have actually come down off of that peak. So that's one component that can slow down. That's in core services. That's in that super core. Shelter, again, there are inflationary pressures that are still there in shelter. We've had house prices that have just really run up, but we should see some slowing, at least in shelter prices over the course of the year. So I think those things should help out the Fed.
Does it make you feel better that the inflation that you're seeing in your auto insurance has peaked?
It makes me feel like at least my lived experience is consistent with the data.
See, right now, just to give you a sense of how much you actually are counter consensus, there's only a 14% chance of a rate cut now priced into the market in June. What's the fear factor for you that if they do go ahead and cut and use any excuse to cut rates in June, it fuels another leg of this rally that we've seen in equity markets, even in some bond markets, that a lot of people argue has contributed to the stickiness of inflation we've seen so far this year?
Yeah, I think those people are not wrong. I think that's a valid concern. And I think that's part of what we're seeing now is we're seeing, some of these PMI numbers that are coming in more positively, some of the corporate earnings that are coming in more positively. We have to think back to what happened 6 months ago. We had a big dovish pivot from this Fed when they really went into this mode of we're looking for the data that can deliver us what we need to see to get to that cut. And we had equity prices that ran up very significantly. That is a big positive stimulus into the economy. That helps to protect growth, but it is doing that at the expense of higher inflation. So I do think that's the risk that the Fed is running.
If the Fed were to cut rates with your base case of 5 times this year, how much does that keep inflation at 3% or 3.5% for the foreseeable future?
Yeah, so to get to the 5 cuts, I think we're going to have to see something weaken in the activity data, in the labor market data. Frankly, we haven't seen that yet. We have a lot of forward-looking indicators that tell us that we may see that later this year, especially in the labor market. But so long as that's not happening, I think the Fed will be a little bit more careful, gradual, as they've talked about. And that would mean maybe cutting rates at a quarterly pace. So you're cutting, 25 basis points in June or July, and then again in September, and then again in December. So, three cuts this year. We have seen equity prices that have peaked and come off of that peak. So I'm starting to feel a little bit more comfortable that maybe we will get some tightening of financial conditions. But absolutely, that's the risk that they run. And that's exactly what's going to be very difficult about this year. Is you're navigating between these two mandates. You have inflation on the one hand, and then you have growth, employment on the other hand. And it's probably impossible to get that balance right.
Matt Lazzetti of Deutsche Bank joins us a little bit later, and he's changed the framing of this conversation around the Fed. He's talking more about mid-cycle adjustments, just a cut here and then a cut there, and wait and see, against maybe a backdrop what I think of is a dominating conversation about a rate-cutting cycle, very different to a mid-cycle adjustment. Would you begin to frame it as a potential for a mid-cycle adjustment, maybe away from this more aggressive call of 125 basis points? And what would it take for you to shift from one to the other?
Yeah, that's going to come down to the activity data, to the labor market data in particular. That's where we think that we're seeing some signs that things like hours worked that are going down and part-time jobs that are coming up, some kind of latent weakness in the labor market that we think is going to kind of emerge more clearly in the data. If that doesn't happen, then I think the Fed is talking about this more in the framework of a mid-cycle adjustment. The idea that your Taylor rule would tell you that inflation has come down. If inflation has come down, your real rate is moving up and you just need to adjust lower.
It sounds like the conversation has shifted based on the communication. I think just in the last week, you can feel that shift. And I don't disagree with you. This Fed clearly wants to cut interest rates. But when they start to wander out loud about not being tight enough, to Lisa's point, don't you start to think the conversation on the FOMC is shifting away from we want to cut, we want to cut, we want to cut at all costs?
There's definitely been some shift, and I think that's partly been the inflation data. It's also been the activity data, right? When we get strong activity data, they are telling us that probably doesn't push them to hike, right? That probably doesn't push them to actually move more restrictive in terms of policy rates. But what that does do is it really reduces any kind of urgency, right? That's the other thing that we keep hearing from them. There's no urgency around cutting. As long as there's no urgency around cutting, then you can have these discussions about, are we really restrictive enough? How long do we need to stay restrictive? And that's exactly the standard monetary policy cycle, right? You get rates to a level that's somewhat restrictive, then you talk about, is this where we should be? And you wait for the data to show you something. That's where we are now.
Andrew, Mohamed El-Erian was on the show a few weeks ago, and he was talking about the fact that everyone got it wrong in 2021 when it came to this transitory inflation, because they weren't listening to the earnings calls, what the CEOs were saying about actually they had inflationary pressures. Has there been anything in the earnings that you think show that those inflationary pressures are starting to wane?
It's not that clear from the recent earnings calls that you're really waning in inflationary pressure. I mean, clearly we're not where we were a year ago or 2 years ago in terms of very high inflation. But what you are hearing is consumer demand that's held up better than a lot of people expected, particularly on the services side. I think when we get the GDP print, we're going to see this week that goods spending has really been flat or maybe even declining in real terms. Services spending has held up, and we had this wave of disinflationary pressure, which largely came through goods. When you listen to some of those service sector firms, it sounds like they still feel like they have pricing power, and that's really an issue when you're trying to bring inflation down.
My Bloomberg is lighting up with questions for you from different watchers who are thinking to themselves, could this be real? Because we've priced out so many of the rate cuts. I'm sure I can only imagine some of the calls that you get. One viewer asks how much probability you put on the possibility of a Fed rate hike. Is it 0%? Do you basically say that that is not on the table despite all of the discussion, even John Williams giving a nod to it?
I think a rate hike this year, so could we eventually get to a rate hike? We could, right? We could stay at this level, and then we could realize that really policy rates aren't that restrictive and they have to go higher, and you have inflation picking up. That's the key is, do you have a real acceleration in inflation? And remember, I mean, kind of per your comment, we were at about 5% inflation a year ago. Now we've come down to something that by most measures would be, at least 3 to 4% inflation. I mean, we're not at 2, but 3 to 4%. I think that's giving Fed officials a lot of confidence that policy rates where they are at least restrictive.
So 0% chance.
So essentially 0% for this year.
Andrew, thank you. Andrew Honhorst of Citi. This is sounding more and more like post-GFC in reverse. We've talked about this a few times around this table. The calls for cuts now sound like the calls for hikes coming out of the financial crisis in 2009. They were always 12 months away. And it was sort of a rolling 12 months and kept getting pushed back. And I heard Michael Gapin over at BFA sort of flirt with the same idea, talking about 2015 in reverse. 2015 in reverse, where we got that first hike and had to wait another 12 months before we got the next one. This is how slow this process could be.
And it's the reason why there is zero conviction right now when you speak to a lot of people. We don't understand the inflationary regime that we're in. We didn't understand it in the post-GFC where inflation didn't come back. And frankly, I'll speak for myself. It is very hard to understand where we are now, whether we really are in a substantially higher inflationary environment for the foreseeable future.
I think a lot of people listening to this program equally as confused. Coming up next on the program, in the second hour of Bloomberg Surveillance, we'll catch up with Darryl Cronk of Wells Fargo, Jeanette Lowe of Strategas, Bloomberg's Craig Trudell, and Zach Griffiths of CreditSights. Your equity market in this session high is positive 1/3%. Live from New York, this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings, and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms. And he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching the China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Data could continue to surprise to the upside.
The data is glaring. It's right there. Corporate profitability looks good.
We've had this easy financial condition environment that has basically fostered equity prices, fostered asset prices across the board.
The performance, obviously, of Mag 7 has been unbelievable.
Balance sheets are actually really, really quite strong. Although the environment is very tough, I think it's also posing quite a lot of opportunities.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Navigating weakness in China, the big challenge this earnings season. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance with your equity market near session highs up a third of 1%. Tesla, the longest losing streak since 2022. 7 days of weakness. This morning, the stock higher by 0.6%. They report later on this afternoon. Just a flavour of the auto market, Lisa, earlier this morning.
Yeah, we got a sense from GM that things were just great if you focus on the U.S. and you focus on trucks and you put electric vehicles to the side. Basically, everything that Tesla is not right now. General Motors shares flying up almost 4%. Also increasing their forward guidance. What this shows is the distinction between the U.S. market and the rest of the world, that exceptionalism we just keep hearing about.
Will we see that from industry to industry, away from the automakers? Need to talk about tech and the likes of China and Apple. Apple is down year to date by almost 14%, negative by 13.86%, and it's more bad news, this time from Counterpoint Research. Anne-Marie, iPhone sales in China falling 19% in the first quarter of this year.
This is very worrisome for China, given the fact that China, for Apple, is about 20% of their market, where they should be bringing some hefty revenue from. And at the same time, this is what Enda Curran has said as well, Huawei, in contrast, climbed with their revenue profit 70%. So you could see the Chinese market, Chinese consumers still want iPhones. They're just ditching Apple for a national champion like Huawei.
There's growth there. Bramo, there's growth there, and they're just not getting the market share at all.
So where's Apple going to go? This is what I'm looking for. Are they really going to try to compete in India? Well, they got to pull down the prices. Are they going to try to expand elsewhere? Are they just going to jack up prices in the U.S.? Do they have enough of a monopoly? And oh yeah, what about AI? Can they compete with Samsung as they release their AI feature later this year? It's going to be fascinating. I'm actually really looking forward to this.
Big report coming up just next week. Apple just a little bit softer in the pre-market, down 0.1%. Coming up on the program through the next hour, we'll catch up with Darryl Cronk of Wells Fargo, with stocks snapping a 6-day slide. Bloomberg's Craig Trudell previewing Tesla earnings, and Zach Griffiths of Credit Sites on why he's sticking with a June rate cut. We begin with our top story, stocks bouncing back as big tech earnings kick off. Darryl Cronk of Wells Fargo writing this: we reiterate our focus on quality and reduced risk in portfolios and expect to see broader opportunities in U.S. equities over the next 6 to 12 months. Darryl's with us here in New York. Darryl, good morning to you.
Good morning, John.
What are the opportunities right now? Not the next 6 to 12 months, like right in front of me on the screen right now.
I think right now you've still got, you still have to focus on places that have shown the quality leadership: industrials, energy, materials, some of the pro-cyclical nature as the economy does recover. We're fading a little bit more of technology. We think financials may be a little bit overbought here. They've had a really nice run. So I think, you've got to look for those select spots where you're not paying up in valuation. The earnings season will be interesting. So if you look at just quarter over quarter earnings, there's only 2 GIC sectors in the S&P that are going to actually show positive sales growth from last quarter to this quarter, and that's financials and utilities. Everything else is down, and something like tech is down 8% on sales and 20% on earnings quarter over quarter.
This is the equity market. Why isn't the bond market just a screaming buy right now? If I said to people back in December who missed out on the juicy 5% yields of October, you're going to get a second bite of this in March, April time. Do you want it? They'd say, yes, absolutely. Give me a second bite of that. Here it is. People don't come on the program screaming, buy bonds, buy bonds. Why is that?
Well, 2 points there. One is I do think you're starting to get duration to be a good buy. It's a little bit of equivalent to picking up pennies in front of a steamroller, right? People are grabbing for basis points on the short end of the curve, right? Everybody's crowded the short end of the curve, and you're grabbing for 5, 10, 15, 20 basis points. But if I've got a bond portfolio that has a 8 duration, let's say 7 or 8 duration, and rates do drop 1%, I make 700 or 800 basis points, right? So the point on duration is the right one, right, to start extending here. The most important point, I think almost entire Wall Street's missing right now, is the yield curve has changed metamorphically, and nobody's talking about it, right? So if you talk about the 5-year out, we're almost tabletop flat, right? 5, 7, 10, and there's only 5 basis points of difference between the 5-year and the 30-year with just very mild steepness, right? So you're getting a little bit of steepness, the long end of the curve still buying into the soft landing. Where's the short end of the curve? Killingly inverted, right? 3 months to 2 years, 40 basis points inverted. That is tabletop inverted. That's telling you a different story, and a lot of the historical studies that you would look at will tell you that the signal versus noise, the front side of the curve tells you much more information than the back side of the curve or the tail of the curve. So pay attention to the short side, because that side is still telling you you've got some tougher waters to navigate ahead, which brings us full circle to where we think you'll get some better entry points down the road.
In particular, you said fading tech, which was compelling to me, because that seems like actually one of the stalwarts that a lot of people were talking about, and that you see more downside to go. Can you talk a little bit about where and specifically you do see that? I mean, is that just sort of focused on the Tesla Apple stories that we were talking about, or is this a broader just, things have gotten overbid, valuations are too high, they got more room to fall?
I think a little bit of the latter, right? I think the valuations are stretched here. I mean, when you look at tech, I mentioned a moment ago about, 20% quarter over quarter drop in earnings, 8% decline in revenue. So they're going through some challenging times. Lisa, I think what people are also missing under this heading of kind of big themes and changes, massive change inside of tech over the last 6 to 12 months, which is everybody now, and we think investors should be chasing hardware, right? There's been this big shift from capital light, software intensive, cloud, to now it's all about, AI data centers, hardware. Even the big Googles, the Microsofts are investing, hundreds of billions of dollars in that type of thing. That's a durable trend, we think, for the long term. So within tech, if you're going to get exposure, I think people are still missing the kind of inflection point we've hit from the last 10 to 15 years of software and capital light basically being all the rage. I mean, think about Google. Google started with $100 million and 1,000 employees, right? And has probably become one of the greatest firms on the planet, right? Now it's going to be all about who can invest the most money in hardware and infrastructure to build for that next generation.
It strikes me that everyone who comes on this show has less and less conviction as time goes on. When was the last time you had this little conviction about the direction of travel for prices, not necessarily for some of these larger stories of what to look at?
Yeah, so here's what, a little bit goes back to John's point. I think what you're starting to see, and I think Andrew talked a little bit about this on the prior segment, there's this bifurcated economy out there, right? And some have talked about it, you know, the high-end consumer versus the low-end consumer, big business confidence versus small business confidence, right? Tech manufacturing spend versus non-tech manufacturing spend. Services versus goods, right? So you've got to think about when you're putting your investments in places, I'm oriented towards those places where strength resides, right? And I'm fading those places where the weakness is at, right? The reality is there's still just so much liquidity you guys talk about all the time in the marketplace. It's driving all asset prices higher, right? Regardless. I mean, look this morning, the FTSE setting a new all-time high, German DAX at an all-time high, Nikkei overtook 4,000. You got gold at 2,400, right, which is typically a risk-off asset. S&P was sitting on all-time high, credit spreads at tights, right? There's just liquidity chasing everything. Doesn't matter if it's risk-on or risk-off assets at this, at today's level. So at some point that starts to separate and you start to understand, okay, where do I really want to have exposure over the next 3, 6, 9, 12 months? And we think that bifurcated economy theme continues to play.
And around the world, where do you want to have exposure? I know you love the U.S., and
Yes.
you're shrugging off EM, but where in the developed world?
I think if you're going to have exposure in developed world, you still want to be Japan is probably the best country there. It'll be interesting to see if the BOJ has to intervene here at some point to defend the yen on a 34-year low this morning.
We thought 152, then 153, then 154, and now we're basically at 155.
Yeah, I think you've got a bunch of you've got the PBOC that is trying to defend the red line on the Chinese yuan. You've got the BOJ trying to defend the yen. But equities there are doing phenomenally well. And I think Europe is an interesting case. It's a little hard. You almost kind of have to look the other way and hold your nose a little bit, right? When you go to invest in Europe, because when you drill down into the fundamentals, you're not going to see particularly great things. But the markets there continue to do well, and I think for the first time maybe in a decade, you might have this case where developed markets start to challenge the U.S. The first quarter, most people don't realize, developed market equities actually outperformed the S&P by 0.2%. It wasn't by a huge margin, but first time in a long time.
The psychology around Europe always makes me laugh. I remember when I first moved here and someone said, it's good for vacations, terrible for investments. And I think people still feel that way about Europe. When you're looking abroad, you're thinking of two things right now, I think, at the moment. One is the strength of the US dollar, and the other is what's happening in China and how and if I want exposure to that story. How are you navigating those forces at the moment?
Yeah, the king dollar is just, I mean, we talked about 34-year low on the yen. Against the pound sterling, it's really troubled. The euro is weak. The Chinese yuan is weak, right? There's just no good place to be there from a currency standpoint, probably that makes sense unless you're just deep value hunting. It's interesting, to your point on China, John, if I go back and look at China over the last 2-3 decades, China's never been a good investment. It's been a good tactical trade, right, at moments in time. But if I pull out any, give me a Chinese indice and show me the last 20, 30 years, and I would show you that it's not been a great, sustainable, durable investment, right? Something has to inflect and change there to get us terribly interested there, notwithstanding second largest economy on the planet. So you always, as a lot of people have done over the years, you can play China indirectly without having to have the direct exposure to China. So you play the benefits of the Chinese economy spilling out into the global marketplace.
Just before we let you go, this is a massive week. We get a lot of earnings. Tech earnings really kick off. We get PCE as well as personal spending and income on Friday, and then we get a host of auctions, including today's record $69 billion of 2-year notes being sold at 1 p.m. What do you think is going to be most instructive for you to get a sense of whether we're starting to inflect to that divergence that you've been expecting?
Auctions are always key, right? Because it's the theme of liquidity, right? You hit on this all the time, right? I mean, and the bid to cover ratios have been weak. I guess if I'm watching one thing there, it's not PCE on Friday because we think we kind of know where that's going to come in, 2.7, 2.8. And you're still a full point difference between CPI. It's earnings, right? We get 30% of earnings this week, which puts you at the 50th percentile mark. If I were to say what's a theme of earnings season so far and what we've seen for about the quarter of the market cap that's reported for the S&P, it is this. It is weak topside demand with a good defense of margins at this point, right? I mean, so it's a good news, bad news, right? You can clearly see demand is softening and weakening. Companies are doing a great job controlling the cost line and defending that margin line, but you can only do that so long. You do need top line growth to keep driving. And so if we're gonna get to this 11.5% consensus earnings, bottoms up, top down, that everybody believes the S&P is gonna give us this year, we gotta go. Like, we gotta get the engine humming here, because first quarter is not looking particularly good. It's looking more like a flat to maybe slightly up, 3-4% on a beat.
We got to go. Daryl, this was solid. It's good to see you. Daryl Cobb there of Wells Fargo. Equities at the moment positive by a third of 1%. Let's get you some stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. I'm sure this will come as a shock to you, but JP Morgan's Marco Kolanovic is warning of further downside in stocks. He wrote to clients yesterday saying that the slide is just the start of a sell-off that he thinks is likely to get worse because of macro risks alongside higher yields, a stronger dollar, and elevated oil prices. He, of course, has been calling downside for some time. And he also added that, yes, U.S. earnings could temporarily stabilize the market, but it doesn't mean that stocks are out of the woods. Shares of JetBlue lower in the pre-market trade by 7%. They forecast second quarter revenue falling by as much as 10.5%. It saw full year revenue down in the low single digits. The airline said that, quote, significant elevated capacity in our Latin region will likely to continue to pressure revenue, and we expect a setback in our expectations for the full year. Amazon has introduced a new grocery delivery subscription, priced at $9.99 for Prime members. The subscription offers unlimited grocery deliveries on orders over $35 from Amazon Fresh, Whole Foods, and some local grocery and specialty retailers on Amazon.com. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for bringing up the Marco note as well. The list of concerns in that note yesterday, here's a flavor of it. Concerned about continued complacency and valuations, inflation staying too hot, further Fed repricing, and a profit outlook where the implied acceleration this year might end up being too optimistic. It's a long, long list from Marco Kolanovic over at JP Morgan. Up next on the program, the Senate taking up the foreign aid package.
The aid package certainly passes. There's also an awful lot of sanctions and foreign policy matters that pass. Beyond that, on TikTok, I don't think, honestly, we know yet.
That story up next, live from New York this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Lots still to come this morning. 9:45 Eastern Time, we'll get US PMIs. Bramo went through the auction, $69 billion of two-year notes coming a little bit later on this afternoon, and earnings from Tesla after the closing bell. Going into all of that, equity futures positive by 1/3% on the S&P. Yields a little bit higher again by a basis point or two, 462.51 on a 10-year maturity. Under surveillance this morning, the Senate taking up the foreign aid package.
The aid package certainly passes. Ukraine, Israel, the Indo-Pacific, read Taiwan. There's also an awful lot of sanctions and foreign policy matters that pass. Beyond that, on TikTok, I don't think, honestly, we know yet.
Here's the latest this morning. The Senate voting on a foreign aid package for Ukraine, Israel, and Taiwan, as well as a bill forcing TikTok parent ByteDance to divest the platform or face a ban in the United States. Jeanette Lowe, Strategas, a Baird company, joins us now for more. Jeanette, it's going through the Senate. Can you walk us through what you think will pass and what won't?
So we actually think that everything is going to pass the House. So there's going to be the package for Ukraine aid, for Israel aid, and for the Indo-Pacific, as well as this other, what they've been calling a sidebar package that includes the potential ban of TikTok if it does not divest from ByteDance. It includes the Repo Act, which allows the U.S. government to seize Russian assets and use those proceeds to pay for rebuilding of Ukraine. It includes Iran oil sanctions on vessels and ports that help transport Iranian oil. All of those things we actually do think gets through the Senate. This was a package deal. The House put everything together to also try to force the Senate to vote on some of these things. As we all know, the Senate has been holding up a vote on the TikTok ban. The House deliberately put it into this package to make sure that the Senate would vote on it. And that's why we expect everything to pass this week in the next day or two.
Do you think we could see any amendments, though, to this large package?
I think it's pretty unlikely. If they did do any amendments, would have to go back to the House. The House is technically currently on recess. That would mean you'd have to pull them back. We already had a lot of turmoil in the House just to get this package done in the first place. That would just create more turmoil. I don't think that's what the Senate is looking to do. They're looking to get the Ukraine aid package out the door, and I think that they're willing to support all of these other pieces, even though there would probably be some changes that certain members might like.
One provision in this package is the idea that the president can apply sanctions more sharply when it comes to Iranian oil. But Jeanette, do you think in actuality that's going to happen with this Biden administration?
Right. I mean, so one of the things that's important is this. So this is a bill that it's called the SHIP Act that was included in this foreign aid package. It had passed the House previously last fall. In the fall, that bill had a 90-day window for it to be enacted. That was now increased to 180 days when it was included in the foreign aid package. That means that if it was to go into effect, it would basically butt up right at the presidential election in November. So we don't expect any push on sanctions before the election. This might be something that the president can then do afterwards. We'll kind of see how the geopolitical situation is then, and maybe things might take a turn at that point. But right now, they've kind of set it up so that we really don't have any impact on oil sanctions before the election, and so it doesn't hurt the president's numbers.
It seems like a lot of people are expecting the only big move to come from the Biden administration ahead of the election is a slew of tariffs to come against Chinese goods in particular. Do you expect that the recent trip by Tony Blinken to China, I believe he leaves today, is going to yield or pave the way to some of those tariffs that people have been talking about?
Right. So, I mean, Secretary Yellen, when she showed up in China, I believe a week or two ago, this is one of the things that she was kind of focused on, that China is trying to export more of its surplus right now, and that could lead to a lot of dumping, not only in the United States, but also in other countries. And then you had President Biden say that he wants to increase tariffs on Chinese steel and aluminum. A lot of other countries are also concerned about what might be coming out of China, what those low-cost exports will then mean for their own domestic economies. So I think that's going to be on the radar screen. Blinken, I think, also in part is trying to focus on the fact that China is trying to supply Russia with some material that helps its war against Ukraine. It also wants to focus on some of the other issues that they've had in the relationship. So tariffs may not be something that goes into effect as quickly. We had the U.S. Trade Representative say that she wants to apply solar tariffs, but I don't think you're going to see as large of an impact from that. But this is kind of the constant dance that we're having with the U.S. and China, where they're talking a lot, but at the same time still taking lots of actions against one another, and that is going to continue.
How much do you think that the pressure of the election, of the potential that President Biden is not going to be the president after November or after the transition date in January next year, that's actually bringing Europe and the U.S. together in a way to come up with some sort of cohesive plan against China, which we hear bandied about a bit in a number of places?
So it's interesting. I mean, one of the things that we do think when we look at this election is we think about whether or not it's not whether we're going to deglobalize or whether we're going to pull back from China, but rather the extent to which we would do that. Obviously, President Biden is much more willing to have alliances, really work with our European partners, work with others around the world to try to get the same policies in place with regard to China. Trump is much more of a go-it-alone style. So I think you'll still see hawkish moves with regard to China if Trump becomes president again. But Biden is really kind of working on trying to build a foundation, having alliances, having similar structures so that the policies will be more impactful. And I think that the Europeans, at least in this current effort, are trying to play along to some extent, trying to be on the same page as much as they can, though I think you also kind of do see some other things because you had the German chancellor go over to China and then was also focused on business deals as well. So there's a little bit of straddling that has to be occurring, but I think that especially with regard to Ukraine, that's where the biggest concern that the Europeans may be having about whether or not Biden is still in office or whether Trump is in office and whether any aid for Ukraine would continue.
Jeanette, that's exactly where I wanted to go. How awkward is it for Blinken saying that they are going to have this multilateral approach, the Europeans are on board, but oh wait, are they? German Chancellor Olaf Scholz was just there with a ton of German executives, what looked like a very friendly meeting to make sure that trade continues, even though we all know that China is helping Russia in their war effort.
Right, and so this is something that they are definitely having trouble probably straddling. Blinken has been trying to be rather forceful, with being the representative of the United States to try to bring the partners along. But you do have these, Europe doesn't want to be seen as just towing the line that the United States proposes. But at the same time, there is this dichotomy where it seems like China is able to maybe woo France, woo Germany, to try to have some better trade deals, better business opportunities, but yet the U.S. is continuing to push to move away from that. So this is definitely a delicate balancing act that he has. Obviously, I think that his hand would be stronger if there was a much more forceful effort, but the U.S. is definitely going to continue on its path. There is going to be this continued decoupling from China, both from the administration, both from Congress, and I think that they just need to see how they can get the Europeans to get on board slowly but surely.
Jeanette, thanks for joining us this morning. Appreciate the input. Jeanette Lowe there, a strategist on the latest developments down in Washington, D.C. Given how divided Washington is right now, I think for a lot of people in this country, it's kind of surprising that we've managed to find an agreement on foreign aid. And we're sitting here and we still haven't got any agreement whatsoever, or dare I say, even a conversation about addressing what's happening on the southern border.
Yeah, well, that's very true, Jonathan. But I think what you saw at the House of Representatives, they knew if they put the southern border into that agreement, then the whole package would have been blown up.
Coming up on this program, the not-so-magnificent Tesla kicking off Mag 7 earnings. The stock down close to 43% this year. Bloomberg's Craig Trudell joining us on the other side very shortly. Equity futures positive by 0.25% from New York. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the program. Equities positive by a third of 1% on the S&P. On the Nasdaq, positive also, up by a third of 1%. On the Russell, the small caps just about unchanged. JP Morgan, Marko Kolanovic says this sell-off's got further to go. Even with that bounce yesterday, I went through the long list of reasons as to why this sell-off's got further to go. Lisa, let's talk about them. Complacency in valuations, inflation too hot, further Fed repricing. I'm not sure how much more you can reprice the Fed, but okay. And a profit outlook where the implied acceleration this year might end up being too optimistic.
Well, look, Marko Kolanovic is a divisive person, and people can target some of those things. I want to just stick on the earnings issue, because we heard that from Daryl Cronk, too, that basically if you look under the hood of earnings that have come out so far, what they show is there is a more tepid consumer, and that they're managing it on the other side in terms of corporate executives by cutting costs. We're seeing that at UPS. We're seeing that in other places, too. JetBlue had a rough time. So that, to me, might be the standout aspect of this earnings season.
JetBlue needs a rebrand. Said that a million times.
Yeah, so what do you think they should be called?
Catch up with JetBlue. JetBlue just gives people the impression they're a budget airline, when actually JetBlue is actually really, really decent service when you get on board. There's nothing budget about it.
So what would you call it?
I'm not sure.
You call it, Jet Extravagant.
Just
Jet Jimmy Choo.
It just needs a rebrand. That's why I never
Blue.
understood the potential acquisition between them and, was it Spirit?
Well, Spirit is its own ball of wax.
That's sort of like turning up the volume on being budget, right? You're going after Spirit.
Honestly, though, if people can't get new planes, that basically you're going to have, a questionable ceiling, then potentially, budget's okay. I agree with you. But at the same time, JetBlue is trying to cater to the family that wants to go on vacation to a warm island, which feels really nice right now, it sounds it. But to me, it sort of raises this question, what kind of appetite is there for that type of travel? And we're seeing a bit of a diminished capacity and a diminished demand.
I'm not sure how we got there, but more on the JetBlue rebrand a little bit later this morning.
With your JetBlue rebrand.
We're not.
Carry on.
Equities are positive by a third of 1%. Switch on the board and get to the bond market. Yields a little bit higher by 2 basis points. On a 2-year 4.9913. Just in and around 5% going into PCE. This is the wait and see. Bob Michael, JP Morgan Asset Management. This program yesterday. Wait for PCE. Wait and see, look for a washout into month end, then start to buy fixed income again. How much more yield do you want at the front end of the curve?
How about 5.5%, and then I'll buy? No, I mean, look, this is really the key question. Yesterday, people were saying that the reason we didn't stay above, the reason why we saw some sort of bid to equities is because we didn't see that 2-year yield stay above 5% for any protracted period of time. Let's wait till 1 p.m. today. I actually think that might be more interesting when we get $69 billion of 2-year notes that are sold. How easily is that digested at a time where you even have the likes of Bob Michael, a big bond bull, who's on the sidelines waiting for PCE?
More supply coming tomorrow and the day after as well. Going into PCE on Friday. Let's turn to foreign exchange. The bulk of G10 right now, just looking at the screen on my terminal, the bulk of G10 positive against the dollar. Bear that in mind when you look at the euro. The euro's positive by 0.1% at 106.71. Data better than expected, but just talk about the relative low bar, better than expected. PMIs have been dreadful for months, Bramo. They're starting to look better, and you pointed out the distinction. It's not manufacturing, it's services doing the important heavy lifting.
Which raises a lot of questions to me, especially for Germany, because that's the manufacturing hub of Europe. But it's definitely bifurcated. So it's good, but is it good enough to be sustainable, especially for the largest engine of growth, supposedly, in the region?
The euro just about positive. Under surveillance this morning, our top stories, a first Senate vote on the foreign aid package set to take place today. The package includes aid for Ukraine, Israel and Taiwan, and a bill that would force ByteDance to divest from TikTok. President Biden telling Ukraine Zelensky aid will flow quickly if the Senate approves the package. Anne-Marie, base case today, approval or no?
It looks like base case it will be approval, or potentially this bleeds into a little bit later down the week, but it's going to happen this week. It looks very likely. And then with President Biden getting on the phone with Zelensky saying we can get that aid too quickly, the administration has been preparing for this moment, so they really can get it out the door quickly. And one U.S. official speaking to the Financial Times recently was talking about the fact that a lot of these supplies are right over there on the border in Poland. So the second they say the Senate confirms it and you have Biden's signature, that ammunition is over the finish line.
As soon as that happens, is TikTok shelved as an issue? Is it something we no longer talk about? Does it just sit there for the next 12 months?
No, I think we're going to talk about it around this table, but they'll have a year. They have a year to deal with this. And that basically means you'll start talking about it after November 5th.
I love this. Honestly, it's politically brilliant. You basically say, we're going to deal with it, but we're going to push it out. We've dealt with it, so it's not a problem. Don't worry about it, but you're still using TikTok, so you can't complain about that either. Hallelujah.
It's beautiful.
It's really, it's
Then they start to appeal, and as the president, you say it's in the hands of the courts.
100%.
I've done my bit. I signed the bill.
Basically, this extension of time frame. Mwah. Political brilliance.
Did you see what the former president said about it? The former president, Donald Trump, who, by the way, tried to do exactly the same thing, was then basically saying, just remember, when you lose TikTok, this is why you lost TikTok. Politics drives me insane. Have I ever said that before? Drives me insane.
Stick to the rebrand.
Okay, let's turn to Apple. Shares of Apple falling after the iPhone sales in China fell 19% in the first quarter, according to data from Counterpoint Research. Apple resorted to rare price cuts in the region in January to spur demand, apparently not working out. The stock, Anne-Marie, is down a third of 1%.
Demand is there. Huawei sales up 70%, while Apple sales are moving backwards. This is a huge issue for Apple, and I don't think it's about the consumers don't like this product. This has to do with nationalism, and the fact also that in Beijing, if you work in a government office, actually you can't use an iPhone. So the message is there on the wall for these Chinese consumers, and I think that's why you're seeing a lot of that demand shift to Huawei.
This has been building for a while. I don't think this is new. We're just starting to see it in a much greater way. I think we spotted this, and to your point, as soon as you start to see the government organizations start to ban the use of the iPhone, we knew where this was going. And now you've got some decent competitions from the likes of Huawei. This is the point that I think you raised earlier, Lisa, that I think is the most important point. The fact that there is a market that is growing and they're getting a smaller and smaller slice of it is a big problem. It's not like EVs for Tesla, where EVs more broadly are struggling. The smartphone business in China is not a struggle right now. There's growth there. They just can't penetrate it.
Which raises the question, are they going to start saying the quiet part out loud? Last week when we were at the IMF meetings, it was the quiet part that was actually being spoken out loud. For Tim Cook over at Apple, there's been a question, how quickly can you move manufacturing out of China? How much can you reduce your footprint? How much can you basically count out growth in that region? Will he be forced to really address that at this point? Because frankly, it looks like there's real competition. So suddenly he has to start thinking, okay, well, what's my growth market? Is it India? Is it pockets of the US that we haven't penetrated yet? These are the types of conversations that finally people are starting to have out loud.
That's Apple. Let's talk about Tesla, a massive report coming after the close. After the closing bell a little bit later this afternoon, the company cutting prices, shedding staff, and facing waning demand for its EVs. The stock is down close to 43% so far this year. Bloomberg's Craig Trudell joins us now for more. Craig, wonderful to catch up with you, sir. You said it. Get the popcorn out later on this afternoon. What's the big one for you? What are you focused on?
Well, I think there's been so much noise around this stock and a lot of attention around that noise, and for good reason with the strategic changes that Elon Musk is wanting to push through. But we shouldn't lose sight, too, of just the fundamentals and to what extent, you know, the noise and the collapse of the fundamentals are sort of, you know, interplaying with one another. Is the fact that revenue and earnings and gross margin and free cash flow all trending in the wrong direction, you know, leading to Musk, you know, taking these drastic measures. And, you know, to what extent is that, you know, just going to become a sort of, you know, self-fulfilling, you know, cycle that we get into, where as earnings, you know, underperform, does Musk, you know, sort of, you know, go even more extreme and rattle people all the more?
Craig, I remember, was it Wells Fargo who talked about how do you value a growth company with no growth? Craig, is that what we're going to hear later? Basically, the prospect of no growth for the next 12 months and a carrot over the stock, which is Robotaxi's announcement later on this year.
Yeah, I mean, I think in the past we've seen, you know, the stock work really well when we've had an event, you know, months out to get excited about. I think back to the year 2020 and when Tesla scheduled Battery Day for the fall of that year, the stock just absolutely ripped going into that event. It helped, of course, that they were scaling up the Model Y. But you know, this is, you know, a very different company at this juncture. You know, this robotaxi coming in August is maybe something to be optimistic about. And yet there are real questions about, you know, just how real that is when this, you know, this CEO has been talking about robotaxis for, you know, going on 8 years at this point. And so how real is it? How soon can they commercialize it? You know, what the risk is in terms of execution and regulatory approvals. All of those things are really difficult for the street to get their arms around.
Craig, I have my popcorn out, and it's not to look at margins. It's to really see which Elon Musk comes out. Is he coming out swinging? Is he going to be aggressive? Is he going to try to put on corporate executive suit and come across like a diligent executive? How important is it, the tone in which he takes at this press conference?
I think that's a really good question. You know, we joked during the break about this idea that you know, in the past, this is a CEO who's referred to analyst questions as boring and boneheaded. You know, when that happened, the stock did not perform well the next day. I think, you know, there needs to be, you know, some understanding that, you know, what he's trying to do here is really, you know, kind of out there and difficult to kind of wrap your head around. And if there's just a sort of, you know, you guys don't get it, but this is, you know, blindingly obvious, I don't think that's going to be well received. He absolutely needs to sort of change the narrative around, you know, can this company grow or not, to the previous question, and, you know, can it grow without new product? And I think that's one of the other things that everyone's come to grips with is, you know, this quote unquote Model 2 is not coming. It is definitely not coming soon, and it may not be coming for, you know, several years if it comes at all.
The divide between bulls and bears on Tesla often is this a car company or is this something bigger? The cult of Elon Musk gone extreme. How much have we had the cult of Elon Musk sort of priced out of the shares over the past 40% decline that we've seen so far this year?
I think it's still priced in there. You know, the stock is absolutely getting beat up, but this is still the world's most valuable car company, despite the fact that it's, you know, still much smaller than, say, a Toyota. And so there is, you know, some room left for this to go lower if, you know, the street is not able to get comfortable with this idea of you know, kind of stopping the bleeding in terms of the fundamentals of the business and growing again. And so, you know, there absolutely has been some shine, you know, lost over the last, you know, few months. But this is still a company that's valued very richly in terms of forward earnings.
Well, Craig, doesn't that just bring up the point that this is an industry-wide problem? And I looked to GM earnings this morning, and their primary driver of growth was sales of trucks. And it didn't really matter what they did in China because they were driven by this insatiable demand in America for gas-powered SUVs. Isn't that the problem Tesla fundamentally is facing?
I think that's absolutely right. And when you compare how this company is performing relative to manufacturers that are still making gas cars, more importantly, big gas trucks and SUVs, I think we're seeing, you know, GM and Ford perform really well. We're also seeing, you know, Toyota, I mentioned earlier, you know, the hybrid strategy that they've, you know, very much stuck to despite the real criticism of, you know, are you guys going fully electric fast enough? They really kind of stuck to their guns and were stuck in on this goal of electrifying, but doing so in a sort of piecemeal fashion, going along with the consumer. And, you know, lately that really looks like it's you know, paying massive dividends.
GM high this morning by more than 4%. Tesla has struggled over the last week. Craig, thank you, sir. Craig Trudeau there breaking things down on what to look for from Tesla later on this afternoon. Remain in the team. We'll break that down after the close a little bit later. Equity futures on the S&P positive by 0.25%. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The FTC has sued to stop Tapestry's $8.5 billion takeover of Capri. It alleged the deal between the owners and licensors of Coach, Michael Kors, and Versace would raise prices in the affordable luxury sector. It's the first time the Biden administration has used antitrust enforcements in the sector. More problems now for Boeing. It faces supplier shortages on key parts of its Dreamliner aircraft. This comes from Reuters, who reported that Boeing expects a slower increase in 787 production and deliveries. Boeing, for its part, says it was producing 5 Dreamliners per month in the last quarter of 2023, and it still does plan to steadily increase deliveries due to strong demand. Apple is getting close to inking a deal with FIFA to get worldwide television rights for a new month-long World Cup-style tournament in the U.S. That's according to the New York Times. It would be Apple's latest venture into soccer following a 2022 deal when it secured a 10-year contract for the worldwide streaming rights to Major League Soccer. That's your brief, John.
Danny, thank you. Up next on the program, the case for buying bonds.
We're really close. We're really looking at levels both in government bonds, more importantly in credit, and we feel this is a pretty good opportunity to get in.
Our next guest looking for 375 year-end on a US 10-year. That conversation up next.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Equities positive by 0.2%. Check out the bond market, yields higher by 3 basis points on a 10-year maturity, 463.75. Under surveillance this morning, the case for buying bonds.
I'm trying to hang on to all my fingers and toes and keep my discipline into month end. This feels like a real month end washout. You also still have a lot of investors wanting to take profits or a lot of momentum investors yet to cash out. So we're really close. We're really looking at levels both in government bonds, more importantly in credit, and we feel this is a pretty good opportunity to get in.
That was Bob Michael at JP Morgan. Here's the latest this morning. Treasury yields holding near year-to-date highs. Traders awaiting a flurry of Treasury auctions and Friday's PCE data. Our base case is the Fed begins cutting in June and delivers 100 basis points of cuts this year. We view several drivers of recent upside inflation surprises as lingering COVID effects and not indications of broad demand pull inflation. That quote from Zach Griffiths, the head of IG and macro strategy over at CreditSights. And I'm pleased to say that Zach joins us right now. Zach, you've got a target at 375 year end on a 10-year. So you're bullish bonds. Walk us through why.
Yeah, John, we think that inflation is going to continue to come down and perhaps more so in the second half of this year that allows the Fed to start bringing the policy rate lower in a manner that doesn't really adjust the real policy rate majorly. It just takes it down in line with inflation. And so we think that with that, given what the market is pricing right now, that would cause yields to fall quite a bit relative to what's priced by forwards at this point.
So, Zach, are you looking for that classic sort of bull steepener? Is it economic weakness that leads to those cuts? And I would have to ask sort of how many cuts, because, Zach, only 2-3 months ago, 3, 4, that sounded almost, I would say, hawkish relative to what the market was priced for, which was 7. And now we've closed that gap, and 2-3 just sounds really, really dovish, Zach. So what do we get?
It's been a huge swing, John, and we're expecting 100 basis points of rate cuts this year, with the first one coming in June, and we think that bull steepens the curve more than the market prices right now. We're looking for the curve shape to be about 25 basis points on 2s, 10s at the end of this year, and it really comes down to economic growth falling below potential. The Fed expects it to remain above potential. We were surprised to see that adjustment to the summary of economic projections. And so we think with that below potential economic growth backdrop, you have another leg lower inflation that allows the Fed to start normalizing policy, not in a way that takes it back to anything that looks accommodative, but just moving back toward neutral by the end of this year.
Zach, I wonder if underneath your projection, there is a belief that we are going back to an inflation rate, just a base rate in this economy, similar to what we saw before the financial crisis, basically 2%, but nothing extraordinarily high.
Yeah, Lisa, that's our base case. We move back to around 2.25% at the end of this year, and maybe we're not all the way back below 2% at an extended clip like we were in the 2010s expansion, but something in the 2 to 2.25% range we think is a win for the Fed. And so when we expect the policy rate to move back toward that 4.5% by the end of this year, that's really not a real policy rate that's anywhere near neutral in terms of going back toward the zero or very low level that we experienced in the 2010 decade.
That view would suggest that the current rate is sufficiently restrictive and then some, right? And I do want to go into this kind of concept. What are you seeing in the economy that gives you any sense that we're actually constricting growth with rates where they are currently?
I think it comes down to what you're seeing in the lower income and lower wealth cohorts of the economy. You're starting to see some of the fiscal buffer come out. And when we listen to earnings calls or check in with our analysts that are listening to the earnings calls, we're starting to see a normalization in consumer spending trends and an uptick in value-seeking behavior. And so we're really looking for the U.S. consumer that's been the engine of growth since COVID. We're at about 1 percentage point above the trend line pre-COVID for personal consumption expenditures, while we're about 1.5% below the pre-COVID trend line in terms of the economy overall. We're just looking for a normalization there, and we are starting to see signs of that, especially as we go through the consumer side of the economy.
Zach, you're a credit guy. What typically happens? Can you do some scenario analysis? What typically happens to credit when the curve starts to bull steepen? And is there any reason to believe that this time is different?
It's a positive backdrop for credit, John, and we are expecting that bull steepener is generally conducive to a carry environment for corporate credit. So we're not looking for a lot of spread compression from where we are today. Our year-end targets on investment grade are 100 basis points, and for high yield, we're at 350 basis points. So that's unchanged from where we were coming into 2024. I'd say some of the performance that we had expected this year got squeezed out at the end of last year and in the first couple months of 2024. So not looking for a ton of further spread compression from where we are today. We do have a scenario where we get all the way down to 75 basis points on IG and 275 on high yield, but that's not our base case.
The way I typically think about it, Zach, is that typically when you get a bull steepener, which is basically the front end rallying more than the long end, it's off the back of a rate cutting cycle that's triggered by economic weakness and generally not conducive to equity markets and risk assets doing well. Am I thinking about it the wrong way?
No, you're not, John. But when we think about what we're going to see at the end of this year, it's more of, I think you were talking earlier on the show, a mid-cycle adjustment in terms of policy. So we're not really looking for a rate-cutting cycle going all the way back to zero. We might not be all the way back to accommodative by the end of this year, certainly maybe not even by the end of next year. And so when we think about these rate cuts, it's more of a policy normalization, a recalibration to recognize that the economy has normalized a bit coming out of COVID. We have growth slowing below potential, and we just don't need a policy rate as high as we've been at. And if you look at just how much inflation has come down with above potential economic growth, if we start to get that below potential growth, we think it comes down more meriting an adjustment to the stance of policy.
Just for the sake of scenario analysis, let's say the market's right and we only get 1 or even 2 rate cuts this year. What does credit do?
We think spreads widen a little bit from where we are today. We could see IG moving to 130 basis points, maybe a move up to 500 basis points on high yield. So not retesting the recent wides, but a drift wider. And so I think that when you consider policy not adjusting the same way that we're expecting, it will cause spreads to drift a little bit wider. And that concern that we all had coming into 2023 about a hard landing, I think comes into greater focus if the Fed leaves policy more restrictive than we're anticipating. I think the big driver here is, does inflation come down as much as we anticipate? If it does not, perhaps the market pricing is correct, and you don't necessarily have to have a huge recalibration in terms of spreads.
If there is that situation where rates stay pretty much where they are, just go down just a touch, that mid-cycle recalibration, Do we start talking about wait until 25 or survive until 25 one more time, and this idea of the companies that finally have to refinance at rates that become punitive for their leverage structures created in a very different rate cycle?
Yeah, survive till 25 is one we've heard a fair bit. And when you think about some of the deals that have gotten done this year, I think investment grade has done incredibly well. We've seen a huge amount of deal flow, and we've even seen that in high yield with the lower rated market opening up quite a bit. And so I think so far, even with rates staying elevated and the expectation that rates could stay elevated for quite a bit longer, we're getting deals done at good execution and tight ends of initial price talk. And so I think so far concerns on the primary market side aren't there. Maybe that picks up if we get to the end of this year and we have no rate cuts, but that's not our base case. I think that does come back into play and probably has a bigger impact in the high yield market than investment grade around the end of this year moving into 2025, Lisa.
Hey, Zach, this was interesting. Always great to catch up. Zach Griffiths there of Credit Size, looking for 375 on a 10-year by year end. 10-year right now, 464, looking for something like 100 basis points of cuts coming through this year and some steepness breaking into the curve. Coming up in the next hour, just want to go through this lineup for you. Mike Wilson of Morgan Stanley, George Ferguson of Bloomberg Intelligence, Matt Lazzetti of Deutsche Bank, Vijay Rakesh of Mizuho. We'll talk to Vijay about the earnings coming a little bit later from Tesla. Need to talk to Matt Lazzetti about something that Zach just alluded to, the prospect of a mid-cycle adjustment, maybe one cut at the end of the year, December. That's the call from Deutsche Bank. And maybe you've got to wait a while to get another one.
This is the world going to Stephen Stanley's way, right? If that's basically what he was talking about months ago. Here's a question. If that's the case, how many market assumptions are just wrong? Because that's not exactly the Goldilocks that everyone was talking about with enough rate cuts to really fuel another leg of this rally. A really curious moment where we're really getting such disagreement on the paradigm we're in. Are we in a highly inflationary one, or are we in the Zach Griffiths world of going back to where we were before?
I want to get into Mike Wilson's world in just a moment over at Morgan Stanley. My favorite notes on the South side are when they put out a note and ask themselves their own questions, because then I just go through the note and write the questions down. Don't you do the same thing? I want the answers.
No, okay, all right, but he gives the answers.
My favorite question in the note was, are we early cycle?
Yeah.
Given the amount of rolling corrections we've had.
It's
a conversation we can have next.
And he answered it.
Yeah, and he can answer it some more. Isn't it worth talking about? I think it's worth talking about.
Yeah, maybe he needs a friend, you know.
The third hour of Bloomberg Surveillance up next. Are you suggesting he needs a brand?
No, I'm saying that you're in the business of doing that right now.
For airlines, not for strategists.
We can discuss.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The market's going through a transition right now.
We've had so many people chasing these rate cuts, chasing these higher valuations, that I think we're due for that correction.
It's impossible to believe they're going to hold rates at these levels forever, but the timing question is a big one.
Higher long-term rates are something we can learn to live with.
You can live with slightly higher inflation and a slightly higher Fed funds rate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, and earnings season kicks off in a much bigger way later on this afternoon with Tesla earnings on deck. From New York City this morning, good morning, good morning. Your equity market positive by 0.2% on the S&P 500. The fate of this market this week, not in the hands of Fed speak. Isn't that a beautiful thing? They're in a quiet period. In the hands of tech earnings through the next couple of days.
Especially given the fact that that has been the area of so much angst over the past couple of weeks with the pullback that we've seen. Just the dissonance between all of the tech earnings are going to be interesting. The Tesla-Apple story, very different from the Microsoft-Google story, and that's, I think, what a lot of people keep talking
We've
about.
talked about it through the year so far. The not-so-magnificent Mag 7, and two of those names jump out. One's Tesla, another's Apple, both down by double digits so far year to date. And those two names both speak to one theme, the struggle for U.S. tech firms in China.
It's a huge struggle right now for Tesla and for Apple. And Apple overnight, the data we got ahead of these earnings is that they're seeing this weakness in China. What is so remarkable, too, is it comes as China was celebrating the Lunar New Year, when people would normally go out and buy things like iPhones. And then Huawei sales, they're up 70%, while Apple's down 19%. The demand is there. The issue is doing business in China.
I'm actually more interested in the 493, the forgotten 493 as people talk about it, because frankly, that's going to give you more of a sense of where the consumer's at and how much pushback you actually get. So far this morning, the likes of GM with American exceptionalism, the likes of UPS with cost cutting and efficiency, these are interesting stories. The story that they tell together, very confusing, so good luck with that one. But it definitely gives you a sense of just some of the cross currents and the rolling different cycles that we keep getting.
GM doing better this morning, that's for sure, off the back of those numbers. Equity futures right now on the S&P positive by 0.2%. The stage set as follows, going into those numbers later on this afternoon. Yields are higher by 3 or 4 basis points. The 10-year 464.36. Coming up this hour, Morgan Stanley's Mike Wilson on why he's overweight energy. Matt Lazzetti of Deutsche Bank on his call for a single rate cut in December, and Mizuho's Vijay Rakesh on weakness in the EV market ahead of Tesla earnings a little bit later. We begin with our top story. Stocks higher after the S&P 500 snaps a 6-day losing streak. Morgan Stanley's Mike Wilson saying this: we believe equity markets have been trading poorly in April, primarily due to the repricing of Fed cuts. With 10-year yields now well above our key 435-440 target, stock appreciation from here would largely have to be earned through earnings upside rather than multiple expansion. Mike, I'm pleased to say, is with us around the table. Mike, good morning to you.
Good morning.
How high is the bar, or low, for those tech firms through this week?
Well, it's mixed, as you were saying. It's not all one trade anymore. It's sort of the magnificent 3 or 4. Some are falling by the wayside for fundamental reasons. Some are falling by the wayside for rate reasons. And look, they've got tougher comparisons now. So I think that, look, as always the case, right? It's not so much about the earnings results. It's about the reaction of the stock to the earnings results. And I think that's what I'm really fascinated to see, how much goodness is already priced into even the winners. And there are some big winners in that group. I agree with you, Lisa. I think what's more interesting is what's going on away from those stocks. That will inform us more about what's actually happening in the economy, you know, what the expectations are around Fed, for example, and also some of the geopolitical risk, which I think, you know, that's not our number one concern, but it's also one of the reasons we're overweight energy.
You said we can learn something from the earnings themselves and how the stock responds to them. What have we learned so far as we get deeper into earnings season?
Well, it's about 50-50. So 50% have been up, T+1, 50% have been down. That's worse than normal. This is in line with what we've been saying for quite a while now, as we think now we're in a period of multiple contraction, right? If you think about the last 6 months, all that really happened was, you know, the Fed pivoted, Treasury, I would argue, sort of squeezed the bond market. We had a duration rally into year end, and that affected a huge multiple expansion. You know, it doesn't get a lot of press, but 2024 estimates for the S&P 500 haven't really gone up, okay? They've been sort of flat over that 6-month period. It's all multiple expansion. So our call basically is that first of all, we thought 7 cuts was silly. I think a lot of people agreed with that. And now we're down to 1.5. So why wouldn't multiples come down in that environment? And I think that's what we're facing now during earnings season, is you've got to really put up a serious beat and a revision to the upside for the stock to go up. I'm very curious to see how that plays through the next 2 weeks.
What we're seeing right now in the earnings is not a cohesive story. I mean, honestly, you're seeing some areas where it's cost cutting that's keeping margins afloat, and other areas where you see, you know, for example, demand for trucks in the U.S. going gangbusters. Are you seeing any themes that you can kind of grab onto so far?
The theme is that it's a very unbalanced economy, and that's the theme we've had for a while. So post-COVID, it's just been a very unpredictable environment for a lot of reasons. Some of those things we got really right, some of those things we got really wrong. And I think we're trying to figure out kind of what the next stage is. Let's look at the last year as an example. So a year ago, hard landing, recession was the consensus view. Market overpriced that. Then we got a soft landing priced in 2Q. Then we had a sort of a fiscal sustainability problem where growth got too hot and rates went up and we had a big correction. Then we went back to the soft landing, and now we're in no landing. So this is our view at the beginning of the year. Is like there's a 33% chance of all 3 of those happening. Soft landing, no landing, hard landing. And I think it's the same. So in other words, right now we're trying to price that no landing scenario, but I'm not confident that we're going to stay in that environment. And companies are a reflection of that, right? Some companies do better in that scenario. That's why they're doing better, things like energy, materials, financials. But is that sustainable? We're going to find out.
You know, you said that we're going to see how much multiple expansion can continue and whether we see multiple contraction. The multiple expansion has been really concentrated in big tech. It has been really concentrated in some of the quality names that you like. It has not been concentrated in the Russell 2000, which has not experienced that same kind of run. Do you start to like some of those areas because suddenly it is an economy that's okay, maybe supported by a couple rate cuts, and frankly, you haven't seen that multiple expansion?
Well, we did. I mean, November and December was one of the biggest short squeezes I've ever seen in the lower quality parts of the market. So we did absolutely see multiple expansion. Now we're giving some of that back, right? And that's our call, which is that I don't really want to go to the low quality world, okay? And that includes small caps. Not all small cap companies are low quality, just to be clear, but as a group, okay, Russell 2000 is a low quality index. And that's why it's underperforming again, because rates are too high for them, right? Like R-star, people talk about R-star, okay? Well, R-star is different depending on who you are and what kind of company you run. It's extremely variable, and the market's been really efficient, Lisa, in saying, look, rates are too high for a majority of the economy, whether it's consumers or small businesses. So we're sticking with that. Until rates really get cut, we think that the trade is still, you got to go with self-funding businesses that have idiosyncratic kind of growth opportunities or pricing power, and it's playing out again this year in spades.
A lot of people think about you as a bear because yesterday, for last year I should say, you were really calling for some sort of downturn in the economy. Where are we in terms of that cycle, in terms of just how close we are to a downturn? Are you basically saying, you know what, this isn't something you can really call with any definitive conviction, that you have to sort of just look at specific companies and stay away from that stuff?
Yeah, no, it's a humbling business. And I think 70% of the street, I think, was in the recession camp a year ago. Our economists were not, but like a lot of people were in that camp, and we had to reprice that out. So where are we? We think we're still very much late cycle. I heard you all chatting. One of the questions we've had is, well, why can't it be early cycle? Okay. Well, there's a lot of reasons why we don't think it's early cycle. Labor market's very tight. The yield curve is still inverted. We don't have a lot of supply in the labor market. We have immigration maybe supporting that, but generally it's a tight labor market. Margins are still at record high levels. So all of the things that we would look at from an early cycle perspective are just not there. So we're still late cycle. And what does that mean? It means this could last for another 2 years, or it could be over tomorrow if we have another shock. So we're probably going to we're not going to be as aggressive trying to make that shock because we don't know what it is. We thought it was a regional banking crisis last year. Turned out to be not the case. The economy turned out to be stronger. I would also argue that we have an incredibly imbalanced policy mix, which has helped the economy to sustain itself. So economic data does not look like the earnings data to us, okay? Economic data is much stronger than the earnings data. Why is that? An enormous amount of fiscal support into the economy is keeping the economic data looking strong, which is preventing the Fed from really cutting rates for an early cycle rotation. And we're just kind of stuck in that. And we could be there for a while. Like, I don't see that breaking. I don't see any discipline in Congress. We're spending more money this week with this bill. I mean, so that is where we are. The question is that overpriced? And I think it is, because should I pay a higher multiple for what I call low quality growth, government sort of driven growth? I would argue no. For some companies, you can pay a higher multiple because they're idiosyncratic to that. And that's what's happening. Companies that don't need government support are doing better. Companies that are getting constrained by higher rates are underperforming.
Let's talk about fiscal and the fact that it doesn't matter who wins the election. There's going to be more money coming out of Washington. It's one of your questions you ask in your note. How are you thinking about the election as a driver of markets this year? Is it too soon to start preparing for November?
Yeah, I mean, historically, we put this in a note. I mean, typically the volatility of the market picks up 2 to 3 months before the election. My experience is that until we have the conventions and we really see the platforms at the stock level, we don't see a lot of action. Now, interestingly, this year, the market has rallied in the beginning of the year. Typically, it doesn't do well in the first half, and it does better in the second half as it becomes more clear. So is that going to reverse this year? We have a tougher second half? Maybe. But I agree with your first sort of position, which is I don't see a lot of difference between these two campaigns in terms of the fiscal and even the monetary mix. The one thing I would say is focus on the areas where the president can do things that are executive order, okay? And the biggest one in my mind is immigration. And tariffs, that's the second one. So tariffs and immigration can be done without congressional voting. So that's where I think, because I'm not confident that we're going to get a sweep either way. That's probably the least likely outcome. It's probably a 10% chance. It's going to be very close. But to get one party as a sweep, I think is going to be challenging. So the executive order lever, if you're thinking about Trump or Biden, that's where the action is going to be.
I just want to work that through an extra step. Are you suggesting that maybe if we get a President Trump Volume 2, that this supply side nirvana that some people in the world of economics are embracing might be threatened?
I think that's exactly right. I would argue that there's a chance that maybe something is done prior to the election for political reasons, because this is a hot issue for the election, right? Immigration is a hot topic. And the question is, do they try to curtail some of that inflow prior to the election? I have no idea. But we're going to learn more about that, I think, in the conventions in terms of how they're talking about it.
To your point then, Mike, this could change quickly in the space of a couple of months. I'm just trying to work out how quickly that would show up in the data, how quickly the market might respond to that change.
Well, here's the real takeaway, John. I feel like there's been a lot of marking to market going on, right? Okay. So I would argue everybody's been wrong about the fundamental picture in many, many ways over the last 2 years, including ourselves, okay? And that marking to market, all of a sudden you mark yourself to market. Why are you any more confident you know what's going to happen next, right? And that's where we have a problem with valuations, is there seems to be this perceived certainty again being priced in. It's like, I'm not certain at all. Maybe I'm the dummy in the room. I don't know. But like, I feel like there's a little bit of complacency around just knowing what's going to happen. By the way, that's not all bad. There could be some positive surprises. But those positive surprises may lead you to a different group of assets that you want to own, okay? I mean, I think bonds are, just to spend a minute on bonds.
Sure.
Like, my goodness. I mean, this is one where I literally could flip a coin and I would, okay, that's it. You know, because I could see rates higher from the standpoint of fiscal sustainability problems. We have a term premium increase like last year. Or I could see things slow down again because rates are now higher, right? The wealth effect is kind of being priced out of the market, and maybe things slow again. Our house call is we're going back to sort of 415. I think you just had a guess saying 375.
Yeah.
I mean, 375 would argue that we're probably back into a soft landing or hard landing scenario. 415 is kind of more of the things just kind of slow down a bit.
Can I put you on the spot just a little bit? Is it easier to foresee them being 100 basis points lower than being 100 basis points higher? Or you actually think it's a coin split? Yeah.
100's big.
Okay.
And those are the tails, right? So 100 on the upside would be the market is really concerned about funding sustainability, almost like the UK, okay, 2 years ago. And I think 100 basis points lower from here is kind of a hard landing.
Give me the next 50.
Yeah, so 50, I'm still leaning to higher. Okay. But our house call is lower, so and I got to go with the house call. Because,
not trying to cause trouble here, Mike.
No, they're bond, but the bond guys. I mean, that's their job, and so I got to bet with them. Okay. And so that would be okay. So what happens in that scenario for stocks? Well, all of a sudden, our no landing scenario probably isn't the case, and we probably would downgrade energy, and we probably would go back to some of the things that were doing better last year. And so it's just, I think you just got to keep a really flexible, open mind. That's what we try to do now with the stock picking. We haven't really talked much about index in the last 4 or 5 months because we're trying to focus on the relative value trades, and we've gotten a lot of those right. And hopefully, knock on wood, we can continue to do that.
Stick with us, Mike. You're going to stay close. Mike Wilson there of Morgan Stanley. Equity futures fade just a touch as Mike speaks. Positive by 0.1% on the S&P. Let's get to the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Biden has weighed in on anti-Israel protests on college campuses. The president told reporters yesterday, I've set up a program to deal with it. I also condemn those who don't understand what's going on with the Palestinians. Columbia and Yale are cracking down on the protests. 100 students at Columbia were arrested and 60 at Yale. GM shares higher pre-market, up about 4 1/3%. It lifted profit guidance for the year with robust truck sales. The company's sales and earnings in the first quarter both came in above estimates. That lift in guidance, it overshadowed a slump in China, where GM lost about $100 million last quarter, and it's a region that which won account for $2 billion a year in profit. Amazon has introduced a new grocery delivery subscription. It'll cost you $9.99 if you're a Prime member. The subscription offers unlimited grocery deliveries on orders over $35 from Amazon Fresh, Whole Foods, and some local grocery and specialty retailers on Amazon.com. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, U.S. aviation facing headwinds.
If you think about 100 aircraft removed out of Boeing's forecast to start the year, that could translate into a big price momentum for the U.S. airlines, which have been suffering.
More on the U.S. airlines up next. Live from New York this morning. Good morning.
Was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities fading just a touch. We're positive by 0.1% on the S&P, going into the open in about 1 hour and about 12 minutes away. Yields are higher by 4 basis points, reapproaching 465 on a US 10-year. Under surveillance this morning, US aviation facing headwinds.
Boeing is sort of in this purgatory right now. They're at this very low production, and that brings us to airlines. In a way, capacity is being is very tight in the U.S. If you think about 100 aircraft removed out of Boeing's forecast to start the year, that could translate into a big price momentum for the U.S. airlines, which have been suffering.
Here's the latest. Boeing set to report earnings and issue guidance tomorrow amid a slew of issues and investigations. Meanwhile, JetBlue, those shares are falling in the pre-market. The airline disappointing on second quarter and full-year guidance. That name is down by almost 11% in the pre-market. George Ferguson of Bloomberg Intelligence joined us now for more. George, let's talk about the airlines because it's not one big, broad story. Talk to me about the names that are doing okay, doing well even, and the names that are struggling.
Sure, yes. So good morning. So far we've seen United and Delta report, and they were pretty decent reports, as well as Alaska. And they were decent reports, and it was all built on the strength of revenue. And those are airlines that have a good component of premium in their revenue mix, right? Front of the cabin, higher price point seats. This morning we saw JetBlue report. JetBlue has Mint. But they have more of a mix of Caribbean, which we know there's a bunch of weakness. There's a lot of capacity going into Caribbean and Latin America, and so it looks to us like this is more of a story of that basic part of the cabin is a much more difficult place for airlines to get any decent price out of, and so that's kind of hurt profits during 1Q, and the 2Q guide was for revenue falling more than capacity is falling, which is telling me that yields, fares are falling faster. So it's sort of a bad sign. So I kind of chalk this up to, again, that basic economy section of the JetBlue airplane, as well as some of the mixed Caribbean, creating some problems for JetBlue.
George, we've been talking about this for a while, the idea that an airplane perfectly represents the bifurcated economy, with the people up front doing just fine and the people in the back really struggling, particularly with pricing. This came in worse than expected. What does it say for other airline earnings expected to come out?
So we're about to go in to earnings for the lower cost airlines. We'll have Frontier, we have Spirit. Spirit's already given us a bit of a guide. And we've got Southwest. So I think what it indicates to us is, again, we're going to see it's going to be a rougher story for those airlines and earnings because they just don't have the premium content to bolster revenues. And so, what we're hearing from every corner of this market is if you could find a way to create more premium content, you will. Frontier's even creating premium content by taking out the middle seat in some of their airplanes. So, meaning taking out blocking the middle seats, you have someone sitting next to you. So I think, again, where we're going to end up is airlines will step on that premium seating, demand as hard as they can. We're seeing that everywhere in the market until that probably breaks down a bit too. But if you don't have a lot of premium seating, you're going to have a real hard time maintaining revenue, and that's going to hurt earnings.
You lost us at Frontier and Premium, George. You've got to go. George Ferguson of Bloomberg Intelligence. George, thank you. Not to be a snob at all. Morgan Stanley's Mike Wilson with us around the table with thoughts on this. Mike, let's not talk about this. Let's talk about your overweight on energy and what it means for your view on the U.S. consumer and discretionary at the moment. How does one inform the other?
Well, look, it's self-correcting. This is probably more of a trade than sort of a secular call. I mean, look, energy got killed last year. It was a major underperformer. What we noticed was that the revision factors were actually starting to turn up. Crude leads revision factors by about 4 months. So this, from our standpoint, this is a call about earnings revisions, not about geopolitical risk. But the geopolitical risk is still there, and it's a nice hedge in case something bad happens in that world. So from our standpoint, it's probably 50% done with this trade on a relative basis, but we think it can carry into the summer. It's a revision call. The oil prices don't need to go up for this to work because crude leads by 4 months, and it's pretty much that simple.
But to John's point, when does this become a tax on the consumer at a time where you do see weakness elsewhere?
Well, I think at oil at these prices is fine. I mean, gasoline at $4 is typically the threshold where the consumer starts to really push back. We're kind of up around that level now. But look, crude has come down in the last week. I mean, we're 83, I think, on WTI. That's down about $6 from the peak. And so that's informing me that we're okay for now. If we were to shoot to 95 or 100, oh yeah. And by the way, as part of this trade that we put on, we are underweight consumer discretionary. Okay, so we think the consumer is weaker for other reasons beyond, gasoline prices. We think a good chunk of the consumer is, hurting. I mean, this gets back to the comments on the airlines. It really is a have and have not world. Okay, it's playing out everywhere we see. And the consumer right now is being very judicious with their pocketbook. They're borrowing a lot in credit cards, but that's getting expensive. and we're seeing some delinquency action there. Nothing recessionary, but like at the margin, it's just harder to get that dollar to your company. So consumer discretionary is going to be difficult.
In the energy space, what else do you like outside of crude?
Well, within energy, well, I mean, anything that's levered to crude. So basically, and this is an important point I want to make. When we upgraded energy, we said, look, you still got to stay up the quality curve, right? This is not a situation where we think, you want to be going down the quality curve to the bad balance sheet. So integrated, some of the higher quality E&Ps, and we mentioned those in the note when we upgraded the group.
And what about gold? I feel like we have to talk about metals.
Yeah, we're still pretty positive on gold because, this gets back to the issue of the fiscal sustainability. And we haven't talked about this yet, but fiscal dominance is a topic we brought up almost 4 years ago. And we think we're in a fiscally dominant policy world. It gets back to, fiscal's too heavy, which is keeping the Fed tight, and then liquidity has to come in and fund that. So at the end of the day, gold is telling you that the markets are starting to worry a little about fiscal sustainability, maybe more than what you're hearing in the press. It also started, if you think about gold, how it's traded relative to real rates, that's probably your number one signal. Real rates have gone up significantly in the last 2 years, and it's kind of a vote against sovereign. I mean, that's what's going on. Central banks are buying gold, and we think it's a really good hedge against fiscal sustainability becoming a problem.
There's one piece missing. It's the dollar weakness that you'd anticipate off the back of those questions around fiscal sustainability. Why is that piece missing?
Because everybody's got the same problem. I mean, tell me a major country that doesn't have the same issue. So all of the currencies are depreciating against gold or crypto. It's the same trade. And by the way, it's sustainable. It's not like the end of the world necessarily tomorrow.
You like Bitcoin?
Well, the market does.
Do you?
I like gold better because I think it has a longer standing sort of view, or it has a longer standing sort of history of being a good place to be in this outcome.
This was really thoughtful stuff, Mike. Got to do it again. It's been way too long. Mike Wilson there of Morgan Stanley, particularly the last call, Bramo, on gold. We're always looking for the Bramo cam. I can tell you I've got a live feed. It's constant. Bramo's face lighting up the moment Mike Wilson talked about Bitcoin.
Well, he even mentioned, Bitcoin, yes, because I'm just curious whether he's a Bitcoin bull, but also this idea, he brought up the Liz Truss moment that a lot of people mock, right? I mean, obliquely, but there is this question about when this becomes a real issue. Everyone says, not a big deal because of the dollar strength, which is exactly your question, John, and rightly so. At the same time, that telling gold, fascinating, one to watch.
The gold this morning, just a little bit softer. Up next on the program, Deutsche Bank's Matt Lazzetti looking ahead to GDP and the Fed's preferred read on inflation a little bit later this week. Equities positive by 0.2%. This morning, looking at the bond market, yields drifting higher by almost 4 basis points. Now let's round it up for you on a 10-year, 4.65 from New York. This is Bloomberg.
happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Equities positive here by 0.2% on the S&P 500. Just a little bit of a lift, no drama here. Up by 0.2% on the Nasdaq 100 as well. The Russell pulling back. It's been a struggle over the last month, as you all know. We've been down much more than this, that's for sure. Down by a third of 1% on the Russell. The small caps just a little bit weaker. Turn to the bond market. Here's the story for you. Going into the PMIs about 1 hour and 15 minutes from now. Yields are higher by 4 basis points. 464.36 on a 2-year high by 2 basis points. Threatening to break through once again 5%, like we did briefly in the last week a few times. 499.13. Lisa, as you said, supply is very much the focus over the next few days, and the front end of the curve is going to be where that supply lands.
$69 billion of auctions of 2-year notes being sold today at 1 p.m. What that take-up is going to look like could dictate where the market goes. Yesterday, some people saying, because the 2-year yield remained behaved, that was the reason why it allowed some breathing space for a rally. How much is it sort of the tail that's wagging the dog of equities?
499 on a 2-year. Lisa went through the supply. 2-year today, tomorrow 5-year, $70 billion worth. I mean, this is serious supply, sort of record issuance. 7-year notes, $44 billion worth. So a lot of supply still to come through this week. Let's take it from the bond market to foreign exchange. I want to talk about one currency pair and some levels. And the levels we were told that were important have turned out to be maybe not so important. 152 was the level for dollar yen, and then it was like 153, and then very quickly 154, and this is going to be a problem. Now we're pretty much at 155, 154.82. So the authority around the currency lies in the finance ministry, and we heard from the former guy, like the old guy, and this is what he had to say. The former vice minister of finance for international affairs in Japan. He said, we are very close to intervention. I want to understand what that intervention actually looks like and whether it's only going to be, if it's going to be powerful in any way, shape or form, powerful enough to do something about this.
Right now, I'm just going to gauge the market's response. The answer is no, absolutely not. Because for the former FX chief to come out and say, it's very close, it's almost there, come on, we're going to go a little bit further, they've lost credibility at this point in terms of signaling some sort of verbal intervention.
Verbal intervention has been hanging over the FX market now for months, and we just keep going through those levels, driven by dollar strength and higher rates stateside. Under surveillance this morning, the FTC suing to stop Tapestry's $8.5 billion takeover of Capri. It's the Biden administration's first antitrust action in the fashion industry. Regulators saying the deal would harm consumers and workers. The Tapestry CEO saying shoppers have a wide range of price points to choose from. Everything I've seen so far has made this sound as ridiculous as it sounds. I'm looking for someone to actually come out with a decent defense of this. Explain to me why this is happening. Are we sort of like avoiding the definition of luxury? Aren't prices meant to be high? Isn't that the whole point?
Yeah, I mean, I think the FTC is going to come out. Well, they did come out, and they talk about workers and the issue of what potentially this could mean in that competition space. What I find challenging is that the fact that regulators in Europe and Japan greenlit this deal. So why is it an issue in the United States? But then you go back to this statistic. Since their appointment, Lena Khan and Jonathan Cantor have brought the highest number of merger challenges since the U.S. began requiring antitrust reviews before deals close in 1976. They just don't want to do deals.
Okay, you asked for it.
Sure,
a
give it
defense
to
of
me.
the deal. 33,000 employees. That's how many people would work for the combined company. And the fear is that you could reduce wages and reduce benefits really significantly if you combine the two companies and create economies of scale. Question really is, how do you compete with LVMH? How do you compete with the likes of Gucci, et cetera, if you are a major luxury brand? I mean, that's sort of the counter argument from the business community. From the Biden administration, it seems like this is more of a worker thing than worrying about your Jimmy Choos.
Okay, if that's the case, if it's not about prices and the consumer, if that's the obstacle to closing a deal in America, we will never close a deal again. They come on TV every time they close a deal and talk about efficiencies and cost savings. What's that really mean? They're talking about job cuts.
I mean, basically, this is a reason why Brian Moynihan was saying a lot of things are getting iced. And I think that you're going to hear that more.
Okay, we'll focus on that story. It's an odd one, that's for sure. Apple facing another setback in China. Counterpoint research data showing iPhone sales falling 19% in the March quarter. Apple losing market share to competitors like Huawei, which saw sales climb 70% in the same period. Lisa, straight out the gate, you said it. The market's growing. It's not a market problem. It's an Apple problem.
What I want to hear next week, what are they going to do about it? Are they basically going to just sit there and take it and say we have to because this is the main source of our production? Or are they going to actually start to say out loud, we're trying to shift to India. We're going to cut our prices further. We're going to talk with the government. We're going to try to divert, different streams of revenue. But this is a huge cloud that's been hanging over the stock so far this year.
It comes as yesterday, Bank of America named Apple a top 2024 pick ahead of these earnings. And they're talking about the prospect for, quote, services revenue growth and margins to remain strong. How challenging is that China story to that kind of outlook?
They might be right. We've reset the bar lower, that's for sure. We've had a double-digit move so far year to date. Stocks moved lower by more than 10%. Earnings about a week away. Data still ahead as well. US GDP coming Thursday. The Fed's preferred inflation gauge, PCE, on Friday. Bloomberg survey expecting core PCE to cool slightly year over year to 2.7%. Deutsche Bank's Matt Lazzetti seeing fewer and later cuts. He writes this: we now expect only one rate cut this year at the December meeting, followed by modest reductions in 2025. Matt is with us now for more. Matt, congratulations, because I think a lot of people have moved to your view of the world. You were talking about a mid-cycle adjustment quite a while ago, and I think everyone else has caught up now. This is no longer about the start of a cutting cycle and perhaps an adjustment mid-cycle. Can you frame the difference and what led you towards that conclusion?
Yeah, absolutely. So we have, I think, two historical examples of mid-cycle adjustments. You had one in the mid-1990s, you had one in 2019. And the logic there is the Fed is cutting rates, not necessarily because we're in a recession, but maybe they're seeing some weakness in the economy that they're trying to get ahead of, or they're seeing that inflation's coming down substantially. I think this cycle was going to be all about inflation coming down and the Fed being able to cut rates modestly in response to that. Certainly we're seeing that get pushed back. But with the labor market where it is, with growth as resilient as it is, with financial conditions as easy and accommodative as they are, there's really no reason for the Fed to guide towards a full cutting cycle at this point in time.
Pre-pandemic, I remember a phrase that Chairman Powell talked about. The objective was to extend the cycle. Is that the objective now? And where are we in the so-called cycle?
Yeah, I think you've seen Fed officials talking about risk management for a long time over the past 3 years. Risk management has meant being hawkish, raising rates in order to ensure that inflation doesn't become entrenched. I think 3 or 4 months ago, we saw better balancing of those risks as inflation was looking softer and the Fed became a little bit worried about growth. I think the past 3 months of stronger inflation prints have put inflation back to the forefront for the Fed. And extending the cycle at this point, I think, does mean ensuring that inflation does not get entrenched, not cutting rates prematurely. We hear more Fed officials talking about the risk that's the bigger risk, cutting rates prematurely, having to re-hike later.
I like Ben Bernanke's idea of scenario analysis. I would like to have a sense of exactly how the Fed would respond if certain things happen, since it's been such an unpredictable cycle. How many hot inflation prints will it take before we start talking about no hikes this year, or no more cuts this year? And how many weak prints does it take for the Fed to cut?
Yeah, I think we're close to talking about no cuts. Our expectation is the Fed only cuts once, and they cut in December. But we also expect that you're going to see disinflation come back over the next several months. So even if you get disinflation, 3 or 4 months ahead, I think the Fed is going to be a little bit more reluctant to cut rates because they've seen a head fake from the inflation data. It's going to take a while to rebuild that confidence. I think if you take a step back, core PCE inflation on Friday might be 2.7 or 2.8. We have growth, which around 2.25%. We have financial conditions that are easy. We have the labor market adding more than 200,000 jobs per month on average with a historically low unemployment rate, there's just not very compelling reasons to cut rates within that environment, and I think the Fed is coming around to that view.
How much are they basically also kind of tacitly admitting that the pivot last year really kind of worked against their goal of disinflation, that might have actually contributed to the stickiness that we're seeing right now in some of the data?
I think perhaps it's somewhat of a contributing factor. I think a lot of this is maybe seasonal, so you do have some seasonal factors that boost inflation early in the year. But what that means is the disinflation we saw last year was overstated. And so overall, inflation is just going to be more elevated than we thought. I think financial conditions will help to boost growth as we look ahead, but I don't think that it's been a key factor for the stronger inflation prints of the first 3 months of the year.
Mid-cycle adjustment doesn't sound like we're near any kind of hard landing, and yet the different rolling cycles that we're seeing in a lot of these earnings reports and what people are talking about, the two-sided economy, it's very real. How do you play that out, given the fact that if rates remain at this level, the lower tier, the lower half, frankly, of the population is going to struggle all the much more so, and I'm talking about both companies and individuals?
Yeah, I think from my perspective, that's returning to more normal conditions. It is the reality of the U.S. economy that you have delinquency rates that are more elevated for lower income households, for lower education households. And so a lot of this is returning to a more normal pre-COVID environment as that excess savings gets drawn down. What we've seen in that environment still is robust consumer spending. We saw it with the retail sales report recently. We see GDP growth that looks quite solid. We see employment gains, which are above 200,000. We see households adding meaningful income growth with decelerating inflation. All of that, I think, is pretty supportive for still solid growth for the U.S. economy and something that the Fed shouldn't be worried about.
What about for 2025? How are you thinking about 2025, given the fact that we might have very different policies, fiscal, maybe immigration, coming out of Washington?
No doubt, and I think it's a key challenge to think that the Fed could cut rates in December. So when we change the view and we have one rate cut in December, I think that could be highly conditional on the election outcome that we get. If you get an election outcome that has meaningful fiscal stimulus and has inflationary policies, whether it's through trade or immigration, the likelihood that the Fed cuts rates in December is reduced. So I do think, as we look about potential to cut rates, the Fed certainly will have to factor in economic policies that will impact inflation, the labor market, and growth. And if those things suggest that they shouldn't cut, then they're less likely to cut.
Let's wrap it up with a counterpoint. Andrew Honhorst of Citi on the program a little bit earlier this morning. He still thinks mid-year. Only until recently, you were looking for mid-year as well. Yeah. You pushed that back out to December. Can you walk me through how low the bar might be to a rate cut mid-year? I'm just trying to work out how this market would respond. Let's say in a few weeks' time, get a really soft inflation print. Do the conversations of the last month just disappear and we start going back to what we were talking about 2 months ago? How does all that work?
Yeah, I think to get a cut by June seems very unlikely at this point in time, absent a weakening in the growth environment. To get a cut by July, I think you need to see a pretty quick deceleration in the inflation data, because we've now had 3 inflation prints that were well above the Fed's objective. We see 3- and 6-month annualized rates, which have been accelerating. It's unlikely you get core PCE inflation down to 2.5% year over year by that period in time. So I think you really need to see a swift and compelling and convincing several prints of weaker inflation data, probably coupled with some weakening of the labor market.
What do you see in the inflation mix right now that makes you think that's very unlikely?
So when you look at things like trim, mean, and median, those things have remained elevated, telling you it's not all about outliers at this point in time. I would also highlight, last week we got this new tenant and all-tenant rent index data from the Cleveland Fed. It has a little bit of a lead. And the all-tenant index actually stabilized at elevated levels. And so that tells us at least through Q2, we're unlikely to see shelter inflation decelerate quickly. If that happens, we're unlikely to get the soft inflation the Fed needs.
Matt, this was smart. Always great to catch up. The brilliant Matt Lazzatti there of Deutsche Bank, looking for the first rate cut to come in December and looking for there to be maybe some moderate adjustment in 2025 and what the team over at Deutsche Bank are calling a mid-cycle adjustment. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of Spotify higher pre-market, almost 10% so. Paid subscribers rose 14% year over year. They're now at almost 240 million. Spotify does plan to raise prices again for the second time in just a year. Shares of UPS also lower this morning. They were higher, down 0.4%, despite the fact that they did beat estimates in the first quarter and reaffirmed its guidance for the remainder of the year. The headcount management and restructuring of delivery routes appears to show through on its bottom line. Apple is close to inking a deal with FIFA to get worldwide television rights for a month-long U.S. World Cup-style competition. That, according to the New York Times. Again, it would be held in the U.S. next summer. It would be Apple's latest venture into soccer after its 2022 deal when it secured a 10-year contract for worldwide streaming rights to Major League Soccer. And that's your brief, John.
Danny, thank you. Up next on the program, all eyes on Tesla.
Tesla needs to be focused on cost instead of focusing on technology for the sake of technology. What I'd like to see is Tesla succeeding to make EVs into the foreseeable future.
Up next on the program, Vijay Rakesh of Mizuho on the blockbuster earnings report. Expecting for later on this afternoon from Tesla.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I would put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
The opening bell about 45 minutes away. Equity futures on the S&P 500 positive here by 0.3%. Yields are higher by 3 basis points. 463, call it 464. Under surveillance this morning, all eyes on Tesla. Here's the latest. Tesla set to report earnings after the closing bell. Shares down nearly 43% year to date. The EV maker at an inflection point as demand falls and investors worry about a shift in priorities. CEO Elon Musk widely expected to ditch the rollout of a cheaper model in favor of developing a robo-taxi. Vijay Rakesh, Mizuho Securities Semiconductors and Automotive Tech Senior Analyst, joins us now. He has a neutral rating on Tesla and a 195 price target. Vijay, we've got some time with you, I'm pleased to say, to work through a lot of issues. And the go-to question for us on this program over the last few weeks has been, do we have an industry problem here or a Tesla problem? Vijay, which one is it?
I think it's a little bit of both. I think in terms of industry, we have seen a very strong adoption of EVs the last 2-3 years. And now you've gone to the first round of early adopters on EVs. So now getting to the second round is a little bit tougher as most of the low-hanging fruit has been taken. So you are seeing broadly EV industry face some challenges, especially even in China, significant price competition. But that said, on Tesla specifically, you have a fleet that needs a refresh. Investors were looking for the Model 2. So that would be the focus of the earnings call if the Model 2 is still on track for second half 25, or do we see that get pushed out to 26, in which case, 2024 and 2025, you don't have a lot of new models coming to market. So I would say a little bit of both.
Vijay, if we don't have growth, how do you value the growth company? It's a question that Wells Fargo have tried to answer. You've raised this question too. What kind of valuations you put on that name?
Yeah, I mean, I think it's really a tale of two scenarios. One is definitely near term where you have challenging growth, expectations because of a fleet that needs a refresh. But longer term, you still have the secular tailwind that electrification is still very much on track, and we will see the global EV market grow significantly as you look out to 2027, 28, because that's where everybody is placing their chips. I mean, all the global auto OEMs, all global economies, everybody is pushing on the EV roadmap. So that's where the trend is. Near term, you have some challenges because you're facing a conundrum of lowering pricing, lowering costs to drive sales, and we are not there yet. The EV market still needs to mature to bring costs down, bring ASPs down. And the Model 2 would have been a very welcome addition to that fleet, but looks like there are some question marks around that. So,
given that, what gets us to $195 a share from the current $142 a share on Tesla as you project?
Yeah, I think a lot of the pullback has been given some of the recent trends in slowing EV sales, but also some doubt around the Model 2 timeline, especially if it's still on second half 25 or 26. I think the more clarity CEO Elon Musk and Tesla can give to the street, the better chance you have for the stock to consolidate or move higher. So I think that's definitely what investors really focusing on. I think robotaxis are a good roadmap, but obviously there are some significant challenges around regulatory compliance, getting the standards there, getting NHTSA to approve it, putting some guidelines around what is acceptable, what is not acceptable in autopilot, etc. So that's still a roadmap that needs evolving. Might be we see something happening by 2027, 28 at the earliest. So near term, the big focus has to be getting Model 2 back on track. So,
Vijay, we were talking about this with our own Craig Trudell earlier this morning about which Elon Musk would show up to the earnings call. How much does it matter to you, his tone, whether he likes you guys or whether he just excoriates you for boring questions?
I think, we have to disassociate the execution from, basically the valuation should be linked to the execution of the company. And so I think as Tesla has done an excellent job in kind of evangelizing EVs and growing that whole market and being first to market, and they have a massive balance sheet. So all those are not issues. Now the focus should be on getting the product roadmap back on track, getting growth back on track. So I think that's where, that's really what will tie valuation of Tesla stock is really the execution on the product roadmap and how that, how that top line margins evolve going out. So,
as it deals with this cost war, this price war in China, was it a mistake to get rid of the cheaper version, $25,000 Tesla?
I think we are not there yet, right? I think there have been, press reports to that model gets delayed. There have been, Twitter posts about not getting delayed. So I'm sure that's where all the investor questions and focus on the call will be. It's much less focus on what the earnings for the current quarter looks like because estimates for the current quarter have come down very significantly. So I don't think, there'll be much of any concern around what the numbers are for the quarter and where the margins are. All the questions will be, how does Tesla get through 2024, 25? Is the low-cost model still on track, etc.? So I think that's really where the focus will be. That's really where all the questions will be based. So.
And as they plan to roll out the robo-taxi in August, you went through a slew of issues that they have to deal with before August. I mean, this doesn't even have government approval yet. What do you need to hear from Musk today to make you think that, okay, August, we can actually see this product?
Yeah, I mean, I think seeing the product is really not a big challenge. I think we can have the product there. The real question would be, okay, what's the execution on it? What's the performance? What's the driver intervention levels? What are the standards we are going to, be guided by in kind of commercializing the robotaxi? How many miles do we have? What's the customer feedback? So there is multiple challenges. There is level 3 autonomy that we haven't even gotten to yet. So I think there are significant challenges to that. And that's why we think any significant rollout will need not just a revamp, an upgrade on the Tesla FSD, but also significant infrastructural upgrades as well. And so it's a route that everybody wants to see happen. We have seen this multiple times before where timelines get pushed out. And at this point, I think it's fair to assume that 2027, 28 is where we think there could be any chance of really seeing robotaxis on the road. That's not geofenced. Having a little bit more flexibility on where you run it, etc. At this point, it's still in the very early experimental stage. So.
Vijay, let's wrap things up by talking about leadership. Elon Musk wasn't always a polarizing figure. He's been highly successful. It's incredibly unique, the amount of success he's had across various industries. If you think about payments in the early days, the time at PayPal, I go back to what he's doing right now, innovations in healthcare. It's unbelievable. At the same time, he's doing things with SpaceX and again with Tesla, and we can talk about Twitter another day. But I think, Vijay, more recently, the experience of Twitter has led to this increased polarization of the man himself. When you have conversations with clients about leadership, do they feel like he's isolating a certain portion of the consumer base?
Yeah, I think, when you look at geniuses, as you mentioned, the list of accomplishments are long. I think they always tend to be eccentric. And so that's exactly why we have to, compartmentalize the execution of the stock and how Tesla itself is doing from personalities. I mean, I know it's very tough to do that, but I think when we look at Tesla and you look at SpaceX, you have to look at how is that company executing? What's the roadmap? Is there something that drives, valuations, what drives accretion in this company, etc. So, but obviously, like we said, I mean, every genius got there because of their accomplishments, because, and none of them seem to be normal people. They all are eccentric, and they all have their quirks. So.